Hello students, good morning everyone. My voice is audible, right? Is my voice loud enough? Hello. Is my voice loud enough? Hello. Okay. Study one scope of management intro to be downloads. Okay. Cost of capital, material to be here, capital structure, capital structure, we'll be starting leverages. Morning. Anyone else joining? Okay, okay. Okay, so we are good to start. Good morning. Good morning, online students. Good morning.
Good morning.
Very good morning, Pa. Very good morning. Okay. So before starting the revision, I just want to ask a question. If anyone has already studied financial management at least once, or no, only classes are? What about you? You have studied or only classes? You're studying, okay. Mm-hmm. So one prerequisite of this class would be that you should have at least gone through the subject once. You should have at least gone through the subject once. Only then you will be understanding whatever I'm telling, because we will not be discussing in-depth explanation, but I'll just give you the logic so as to understand everything. So our agenda for today's class would be to complete how much ever chapters possible. Okay, I will not keep a target that I will complete all the 10 chapters or all the 9 chapters. Our target would be that we'll just go on and we'll complete maximum chapters. And one advantage of this class would be that someone who has already attended the class will have a proper hold over the subject, so that you will get revised everything whatever you did. And second advantage would be it will brush up everything, and I'll be also giving you some tips and tactics that could actually help you solve problems, and that could help you revise, that will help you in your preparation. And this is just like a push to your examination. See, everything depends on you, whatever you are doing depends on you, but what I can do is I can just give you a small push that is required at the time of this preparation stage. Okay. And history is the proof. Whenever I plan a full day class, always rain comes. This is something happening. Whenever online regular students know that whenever I try to have a full day class, maybe it is because I try to extend the class, but honestly today I don't have any intention to extend the class, so don't worry, I leave you early only. Okay, we will not sit till 6, 7, 8. I leave you early. Okay, before 5. Never happened, but before 5. Okay, let's try how it goes. Okay pa. So let's start our revision. Total 10 chapters we have pa. Total 10 chapters we have in financial management. I hope you know that 10 chapters. Okay, now just 1 minute. Total 10 chapters we have. 2 chapters are theory. Okay, 2 chapters are theory. One is Intro to FM, which is the first chapter. Second is Types of Financing. Okay, then I try to bucket chapters under financing decision, investing decision, and dividend decision. And then we have others. Under financing decision, first thing is we are having cost of capital, capital structure, and leverages. Under investing decision, first is this investing decision, which is capital budgeting. The name is investing decision. The second one is risk analysis and capital budgeting. Dividend decision, the name is dividend only. Dividend decisions. And in others, one is ratios, and then we have working capital management. Okay, actually working capital management can also, I can bucket into financing decision, because working capital is a short term financing decision and all these are long term financing decisions. So we have 3 plus 2 5, 7, 8, 9 and 10. So these are the total 10 chapters overview of our subject. Okay, overview of our subject. How many marks FM? 50 or 60 marks? Yo, I'm getting scared. 60 marks FM. Okay, 60 marks is FM. 40 marks is financial management. What should be your target? Okay, sorry, 40 marks is economics for finance. So 60 marks, what should be your target? Minimum 50. Yeah, very good. See, always target very high marks. Always target very high marks so as to have a good preparation level. Because if you're targeting, if I get 40, it is enough. Now your preparation will be very low. So always target as high as possible. Target 60 only. Target 55. So that your preparation level will have you will have an increase. you will increase your speed, you will put more efforts, because when you know that you are not reaching the target, your mind will automatically try to find ways how to work around it. Okay, so always have high target. Now out of those 60 marks, I'll tell you where weightage is more. Okay, weightage is more in capital budgeting. Okay, so we have more weightage in capital budgeting, cost of capital. Okay. And then this theory, we have more weightage. So how we are including theory in more weightage? See, we have theory subject also. We have this is not a completely practical subject. It also includes the theory part. I'll tell you 15 percentage at least. Okay, 15, or you can say some 12 to 18 percentage is theory, and remaining, okay, remaining 80 percentage is practical. Okay, you just keep it 80-20. Okay, 20 percentage at least is theory and 80 percentage is practical. Okay, 20 percentage you will get at least 8 to 10 marks of theory. Out of those 60 marks, if you are getting 10 marks theory na, okay, it is around somewhere around, and some other theory points will also come in different sub parts. So now you have to understand that practical subject, FM being a practical subject, this becomes very challenging. Why I am telling you, in all the other subjects, the theory part is very much fixed and the practical part is very much fixed. But in FM, you cannot say that theory will come only from first two. See, second chapter definitely one theory will come. Okay, second chapter definitely one theory question will come. But theory question can come from capital structure also. Theory question can come from capital budgeting chapter also. Theory question can come from dividend decision also. It can come from working capital management also. So you cannot expect that theory can come only. If you read only these two chapters, there can be a chances that you may miss some theory of 2 to 3 marks. So how to go about it? How to cover this theory? The only thing is that you should see past, some 2-3 years paper to see from where theories are coming. What I have analyzed is 8 marks. Okay, around 6 to 8 marks theory will come from here, and then other 4 marks. Okay, 1 or 2 questions theory can come from whatever I've covered. Okay, cost of capital, sorry, this capital structure, this capital budgeting, working capital management. Working capital management you have to focus more for theory part also, because we have lot of things there. We have MPBF, all these are new additions in working capital management. So working capital alone you have to focus, because I'm expecting one theory question from working capital management in this exam. Fine. Now agenda for today's class. Agenda, how we are going to start. What I will do, just to take the discussion ahead, I will start from introduction. Okay, I know introduction is not required, but just to start the discussion, I will start from introduction, and then I will go on to complete first financing decision, then we'll start with investing decision, then we'll start with dividend decision. These others, I'll just give you an overview. Because my target is to cover 80% of the portion today. My target is to cover 80% of the portion today. All the concepts we are going to cover. Tomorrow we will have some proper problem discussion. We will have some good problems. I will solve the problem and you will see how to solve the problem. I will give you some approaches, I will give you some tips, I will give you some calculation methods of how to solve all the problems. That will be tomorrow's class. Today's class will be mostly focusing on formulas and concepts and logics. Okay, the formulas, the concepts and logics, so as to understand how to solve the problem. So today it is like a weapon to solve a problem. Tomorrow we will actually solve a problem. Okay, so this is the agenda for today's class. Now before starting, is there anyone who is interested in India Pakistan match? So if anyone is interested in India Pakistan, I know, see, because of India Pakistan match, many students didn't attend the class. I know that. Okay, because of India Pakistan, many students didn't attend the class. But see, had you attended the class, I would not have stopped you from seeing this course and all. Okay, but still, what we can do? Exams are more important at this time. India Pakistan will come again. Sorry for all the cricket fans, but I'm not that much fan of cricket. So I can say all these things. Fine. Let us start. Okay, introduction to financial management. Okay, introduction to financial management. One question. Okay, I think some 4 marks. 4 marks. You can have a weightage of 4 marks from this chapter. Introduction to financial. But 2 to 4 marks at least you can have a weightage. I'll just give you all the important points. What and all you have to study. What you can do is you can highlight in the textbook that okay, this is something which is important. This is something which is important, which will help you to revise 1.5 days before the examination. The only objective of today's class is to make you prepare how to revise it before 1.5 days. Okay, 1.5 days of the exam, how to revise, what are the things that you should see, what are the things that you should not see. That is our agenda. So that is something which will add value. That will something which will add value, because CA exam is not only about knowing things, it is also about strategy. How you are strategizing your things and how you are properly planning your thing is very important. CA is not only about if you are very good in theory or if you are very good in practical, there is no guarantee that you will pass the exam. The only criteria for passing the exam is to having knowledge and also having a strategy. Having a strategy is very important. Fine. Now, without wasting much time, let's start introduction to financial management. Okay, financial management. Okay, so if we talk about financial management, what is financial management? It is managing finance. Okay, managing money. Okay, now usually in any company, who manages? A manager manages, correct? A manager manages. What is the work of the manager? What is the work of the manager? The work of the manager is to take decisions, correct? So I can say financial management is a subject which will teach you to take decisions related to money, okay, or related to finance, not only money, relating to whatever is there in finance. If you want to take decisions relating to finance, that is what is financial management. Okay, now what are the decisions that we can take? What are the decisions that we can take which are related to finance? So it is bucketed into three. First is financing decisions. So as a finance manager or as a CFO, you have to take decisions related to finance for a company. Now, what are all the decisions that you are going to take? First is the financing decisions. Second is investment decisions. Third is dividend decisions. Okay, I already said you, if we have a balance sheet, liability side and asset side, liability side is the sources of funds, from where we will fund the sources. It can be equity, it can be preference share capital, it can be debentures, okay, it can be reserves and surplus, which is nothing but retained earnings, it can be through loans, banks, from anywhere. These are the sources of funds. And from these sources of funds, what you have to do? You will apply the funds. So application of funds. Okay, liability side covers with sources of funds, asset side covers with application of funds. So sources of funds, first is which fund you, okay, which source you have to choose and from where you have to choose. Okay, now whenever you are sourcing any funds, whether you will receive money for free, no, there will always be a cost. Okay, now this thing is called capital. Any money which is used for long term in business is called capital. So capital includes equity, capital includes all the long term loans. Okay, Now, any amount that we are taking, will always have a cost, This cost is called cost of capital. So what we'll understand: cost of equity, cost of preference shares, cost of debentures, cost of retained earnings, cost of loans. We have to find the cost. And once we do the weighted average of this cost, what it is called? Weighted average cost of capital, which is also called as overall cost of capital. Okay, WACC, we call in financial management WACC. Okay, now we got the money. What we will do? Will we keep in pocket? No, we will use that money, correct? So what you will do? You will apply that funds. Now where you will apply the fund? That is where we have to do investment decisions. Okay, that is what we do, investment decisions. Usually where we will apply, some project will be having, some business we will be having, correct? Yeah, good morning Vijay. So Vijay sir, yeah, so investment decisions, and investment decisions, what we will have, we will be having to invest somewhere. Where we will invest? We will invest in projects. Okay, we will invest in businesses. Anywhere we will invest. But how to take the decisions? We will have some techniques. Okay, we will have some techniques. That is what we are going to study in investment decisions. We will be having some techniques to evaluate in which project to invest, in which business to invest. Those techniques are called techniques of capital budgeting. Okay, that is what we are going to discuss in investment decisions. Now you got 100 crore rupees. Suppose you thought, okay, I want to invest in some machinery, okay, and machinery is also an investment decisions, correct? So what you thought, okay, 100 crore machinery you purchased. Just by having a machinery, will you generate profit? Just by having a machinery, you have to use that machinery, okay, you have to operate that machinery. After operating that machinery, once you use that machinery, you have to operate that machinery. So you would need something called as working capital. So you also have to invest in working capital. So working capital is not a finance decision. I just made a small error. It is an investment decision. Okay, it is a short term investment decision. See, this notepad is a bit slow. Okay, no worries. So we will have to take working capital decisions. How much working capital we should have, how much we should invest in working capital, okay, how much days, what is our operating cycle? You learned something about operating cycle days, right? So what is my operating cycle? How can I reduce my operating cycle? How will I manage my debtors? How will I manage my creditors? How will I manage my cash? All these are working capital decisions. Okay, so working capital is another investment decisions. Now next one, after using all this, what you will get something called as profit. Now what to do with this profit? You have to keep it in pocket, or you have to give it to the owners of the capital. Who are the owners for the capital? If it is debentures, debt holders are the owners of the capital. So what you have to pay? You have to pay interest to them. For preference share capital, you have to pay preference dividend for them. For equity share capital, you have to pay dividend to them. Equity dividend to them. Now whether there are only two options, either to keep this money, or we will call it retain this amount, or you have to distribute as dividend. Okay, when to retain, when to distribute, okay, how much to distribute, all these are called dividend decisions. So these are the three types of decisions that we used to take in financial management. Now if you open your textbook, you have all the finance decisions, finance functions. You will see something called as V is equal to, okay, V is equal to, what is V? Value of the firm. It is a function of investment decision, financing decision, and dividend decision. So if you're taking decisions based on these three, your value of the firm is getting increased. Is what is the concept that we discussed. Okay, now what is the type of question? They can directly hit a question like that. Okay, tell something about investment decision or finance, or what are all the financing decisions that a company take, what are all the investing decisions that the company can take, or what are all the dividend decisions that the company can take. All these are the questions that can be asked. Okay, all these are the question. Or short term financing decision, or how we can increase the, they can ask a question, how we can increase the value of the firm by finance decision. So in by finance decision you have to write all these three. We can increase the value of the firm by having these three decisions: financing decision, investing decision, and dividend decision. And what we will do, we will write some notes here. You can write it on your own, but first you have to read it from the study material. You can write it on your own, you don't have to mug up. Okay, theory should not be mug up. Types of financing, at some places you have to mug up. Okay, all the types of bonds, right, at that places alone you have to mug up, but still you have to understand whatever you're studying. Okay, just mugging up and writing in the exam will not be helpful, because there is a high chance that you will tend to forget things. Okay, so this is first part of discussion. Okay, next one is, who will do? A manager will do, correct? Usually it is called a finance executive. Okay, finance executive, the words that are used in textbook, or chief operating officer, the CFO. The CFO is usually chief financing officer. Okay, or finance executive. What are the role of finance executive is one such question which many times has been asked in. Okay, what is the role of the finance executive, or what is the role of the CFO in an organization? So if you see the textbook, okay, you can mark this thing alone. Okay, role of finance executive or role of chief financing of, okay, CFO, role of CFO. This is one question that it can be asked. So what are the points that you can write? First thing, they will do financial analysis and planning. Okay, financial analysis and planning. Okay, financial analysis also includes ratios. Okay, all the ratios thing, planning thing, finding out variances, all these things are one of the roles of financial analysis. Second thing, you can write investment decision. So they have to take decision where to invest, where not to invest, what to do, how much to invest. Okay, then you can take financing and capital structure decision. Same thing only. Okay, same thing only, but you should know what content you should write. Because just you're writing a paragraph is not enough. I'm again saying, in theory question, point wise answers is what ICA is expecting. A paragraph answer will not look good, or you may lose marks. So how to gain marks is that you have to write point wise answer and always underline important points. Now suppose you know that financial analysis and planning is one keyword, so underline this keyword and then you write the things. So what will happen, a person who is correcting 100 papers, 50 papers, 40 papers, so he will not be having time to read line by line your paper. So what he will do, if you are highlighting something, na, it is a human nature that first thing, our first eye will go wherever what is highlighted. Now once he see this highlighting word is there in the answer key, he will just put a tick mark, or he will have an impression that okay, the other person knows things. Okay, so always highlight things which are very sure it is there. Okay, which are very sure. Always, you know what I used to do, even after writing answer, if I got the answer, suppose my answer is okay, R is equal to 15%, what I will do, I will underline this, because I know if the answer is correct, if I underline this, he will not see the steps, he will directly put tick for R is equal to 15%. So always put a dabba or always put some underline, that is very important. Okay, one tip that you have to note. Okay, then financial analysis and planning, investment decision, financing decision and capital structure. Okay, financing decisions and capital structure, these all are there in the textbook. Why I'm giving is that, first thing is it will be retained in your mind. Second thing, you should know what content you should write in the examination. Okay, financing decision and capital structure, and then risk management. Okay, if it is a 4-mark question, 3 to 4 marks, okay, 4 points are enough. Okay, if it is a 4-mark question, 4 points are enough. Fifth point is management of financial resources. Okay, which is nothing but working capital. Management of financing resources, how to manage financing resources. Bear my handwriting. Okay, done. See, important things alone we are discussing. This is very important. role of finance executive or role of CFO? This is one question. Or they can even give a case study, something like that. He is a person, he has been appointed as the CFO in some company. Now what are the roles that he have to do in that company? Okay, so you have to start the answer as that if he is appointed as the CFO of the company, a CFO has certain roles. These roles are, then point 1, point 2, point 3, point 4, like this you have to frame the question. You have to answer the question, you have to answer it according to the question. Okay, now also you can include many other points, okay, and other other roles: budgeting, forecasting, okay, planning, budgeting, forecasting, planning, treasury management, cash management, data management, whatever you know, okay, you write it, whatever you know, but don't write anything irrelevant. That is what my point is. Okay, done. Now yeah, so this is one. The last thing which can ask from first chapter is this agency problem. Okay, agency problem and agency cost. Agency problem and agency cost. This is nothing but it always gives a bifurcation. It always have a bifurcation. A company's owner, okay, owner, or which are also called shareholders, are different than management. Are different than management. This thing talks about a company's owners or shareholders are usually different than management. Okay, so there can be a conflict that can arise between the management and the owner shareholder. Okay, so it talks about the problem. So once you read this, you will be able to understand. Okay, there is nothing much to explain here, but I am just giving you an overview. The overview is that you already know, right? If I'm investing shares in Reliance, so I am the owner of this Reliance, but management is different. Okay, I may be having some thinking, okay, but the management will be having some thinking. So usually owner of the shareholder and management will be different. So how they have to address this problem, how to do this, is always dependent on agency problem, agency cost, how to mitigate this. One mitigation would be, because owners will get profit, management will get salaries. So one such solution, they can ask what are all the steps that can be taken to avoid agency problem. So one point is that management salary can be linked to profit, so that their focus can be aligned. This is one such solution. Okay, this is one such solution. Second solution is effective monitoring should be done by equity shareholders to management, so that these things are so if you can see, it is there in the textbook. Okay, managerial compensation is linked to profit of the company to some extent, also with the long term objectives of the company. So you can highlight this. This is one such important question that can be asked. Okay, this is a potential question that can be asked. Now with this first chapter completed. Okay, first chapter avloda, nothing else. Okay, just 20 pages first chapter, nothing else. Okay, these are the only questions that can have, just have a small reading is enough. Okay, now let us go into financing decision now. Okay, financing decision. Are you all enjoying the class, right? All are enjoying. Financing decisions. Okay, cost of capital. Capital is nothing but, okay, funds that are used for long term. Okay, funds used for long term. Okay, cost of capital. Now as I said, whenever we are taking any fund, every fund will have some cost. Okay, every fund will have some cost. Now here theory questions are not very much possible, practical questions are alone possible. Here we are having lot of formulas. Okay, cost of equity, cost of debt, cost of preference share. But once you understand the formula and the logic, you will no need to memorize it. I hope in my class no one has memorized even a single formula. I hope you have not memorized even a single formula. Every formula you know the logic, right? Very good. So that is what is the intention. Whenever you need to memorize, you have, at least, at least a petty logic you have, okay? Even though you don't know the full logic, at least petty logic you have in your mind. So, having a logic will keep things retained in your mind. That is the only objective. Because once you mug up na, always you can have a doubt. Now, many students mug up the interpolation formula. This, this formula, LR lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate into higher rate minus lower rate. You don't know the formula, but you know the logic, correct? So what is happen? What is happen is that this is the formula for interpolation. But what happen is that many students mug up this formula. Okay, many students mug up the formula. Now what will happen in the exam? They will have a doubt. NPV at lower rate is okay. This is higher rate or lower rate? Ayo, I am not able to understand. They will have this doubt. Or do I have to do higher rate minus lower rate or lower rate minus higher rate? Do I have to do minus or plus? They will not be able to understand. Okay, they will not be able to understand. So have little logic in your mind, so you will understand the formula also. Okay, just an example. Okay, I am my intention is not to scare you all. Just an example. Okay, fine. Now, yeah, cost of capital. Formula will only help you to save time. Okay, formula will only help you to save time. So it is not a bad thing to use formulas. Formulas can be used, but underlying logic should also be known. Okay, don't only go by logic, otherwise you will get stuck. Okay, so as you said, extreme of something is very bad. Okay, so always have a balance between what you should remember and what you should not. Okay, always have the balance between the two. Now next one, when we talk about cost of capital and long-term funds. Now what are all the long-term funds that we are discussing about? Okay, what are all the long-term funds? One is the equity share capital. One is the equity share capital. What are the things that we will discuss in this chapter? Second thing is, okay, preference share capital. Then we will have debentures. Okay, then we will have debentures. We will have retained earnings. Okay, we will have retained earnings. Then what we have? You will be having something called as bank loan. Okay, bank loan. Redeemable, irredeemable, all this. Okay, debentures and preference shares. You have redeemable and irredeemable. Fine. Now, whenever you are taking any money from someone, okay, whenever you are taking money from someone, it is not free. You have to give something, correct? Always it is a give and take. You are taking something, you have to give something. So for equity share capital, what is something that you will give? Dividend is something that you will give. Okay, preference share capital, what you will give? Preference share capital, what you will give? You will give preference dividend. Okay, you will give preference dividend. Debentures, what you will give? Interest you will give. Okay, retained earnings, you will nothing, you will give. Okay, nothing, because this is your money only. Bank loan, what you will give? Interest you will give. Okay, now out of which some amount can be fixed. Okay, now this dividend is fixed or not? This is not fixed. Okay, this is not fixed, because this is at the discretion of the company. If you want, you pay the dividend. If you don't want, you don't pay the dividend. Preference share capital, this is fixed or not fixed? This is fixed. Interest, this is fixed or not fixed? This interest is fixed. Fixed now, it is decided at the time of taking the money. Okay, it is decided. And this bank loan, you will pay interest. It is fixed or not fixed? It is fixed. Okay, now one thing is that wherever the payment wherever the payment are fixed, it is easy to calculate the cost. It is easy to calculate the cost. Wherever something is not fixed, you have to take certain assumptions to calculate the cost. Okay, wherever it is fixed, it is easy to calculate the cost because it is certain. And wherever it is not fixed, you have to take some assumption, because if it is not fixed, now you cannot tell that it is free, or you cannot tell that the cost is 0%. You have to assume something to find the cost. Okay, So we will make some effort, we will take some assumption to take the cost. Now first we will complete the fixed, whatever it is fixed. Okay, let's start with cost of debentures first. Okay, cost of debentures first. Debentures can be irredeemable, okay, or it can be redeemable. Okay, now if it is irredeemable, now one more thing, it is called as KD. Okay, cost of debentures is called as KD. If it is irredeemable, the formula is I into 1 minus T divided by net proceeds. Here the formula is I into 1 minus T the whole divided by RV plus NP divided by 2 here plus RV minus NP divided by remaining life of the debentures. Okay. Now always see whenever, okay, whenever, suppose if you are investing somewhere, you are getting a return of 10 rupees every year. 10 rupees every year you are getting the return. You are invested 100 rupees. What is the percentage of return? 10 by 100. So always return or cost, okay, always return or cost, the annual cash flow, okay, the annual cash flow that you are paying or receiving is the numerator, and the cash flow which is received, okay, cash flow which is received, okay, annual cash flow which is to be paid is in always will be in the numerator, and the cash flow which is received, okay, which is received totally, yeah, cash outflow, no, this is debentures. Okay, debentures, we are talking from the cost perspective, not from the return perspective. So cost perspective will pay, okay, whatever is the annual cash flow which will come in the numerator, whatever is the total cash flow received will be coming in the numerator. Now net proceeds is the amount that I am receiving. If I am issuing debentures, I will receive amount, correct? If I am issuing 1 crore rupees debentures, now 1 crore rupees I will receive, correct? So this 1 crore rupee will be net proceeds. What I will pay every year? Interest I will pay every year. 100 rupees is the, suppose I'm interest I'm paying every year now, this 100 rupees will come in the numerator, but on this interest I am getting some tax benefit, yes or no? Yes, this interest is tax deductible or not? If it is tax deductible, now my cost should also be after tax, correct? So because of this interest I am paying 30 rupees less taxes, yes. So this 30 rupees is attributable to this, so I can tell my net cash outflow is 70 rupees. You don't have any doubt here, right? My net cash outflow is 70 rupees. So what I am doing? I am doing I into 1 minus T. This is after tax outflow. This is after tax outflow. Okay, this is after tax outflow. And what is this? This is my total cash inflow. Okay, this is my total inflow. This is my total inflow. Now here we can have certain adjustments. What we are going to speak is here we can have certain adjustments. It is adjusted after floating cost. Okay, floating cost. Okay, flotation cost we are having. Now if you are issuing debentures, you will pay some commission to bank, or you will pay some commission to underwriters. Suppose I am telling my commission that I am paying is 2%. So I am getting 1 crore rupees, but I am paying 2%. Okay, I am paying 2 lakh rupees to underwriting. Okay, 2% I am paying 2 lakh rupees to underwriters. If I am getting 1 crore rupees and if I am paying 2 lakh rupees to underwriters, what is the net cash that I received? 2%, 98 lakh. So your net proceeds will not be 100, your net proceeds will be 98. Okay, so this net proceeds is adjusted with flotation cost. Okay, this net proceeds will be adjusted with flotation cost. Clear? This is one adjustment that you have to make from net proceeds. So whenever you are having any flotation cost, that will be adjusted with net proceeds. Fine. Okay, now this is for fresh issue of shares. Okay, this is for fresh issue of shares. Whenever you are finding the cost, you will find the cost as of today. You will find the cost as of today. So this net proceeds can also be market value of debentures. Okay, market value of debentures, which will show if I were to issue debentures today, what will be the cost that I will receive, what will be the amount that I will receive. So it can also be market value of debentures. Okay, for fresh issue, na, this is. and this will also adjust. If flotation cost is there, if I were to issue, I will get the market value, and if I were to issue, I will also pay flotation cost. So flotation cost will also come. Okay, even though it is new issue or fresh issue, new issue or subsequent issue, market value will, market flotation cost will always be adjusted with net proceeds. Is the first adjustment that you have to understand. Now debentures will be having something called as face value, and it can have something called as issue price. The face value can be 100 rupees, but the 100 rupee debenture can be issued at 120 rupees, correct? Because it will be redeemed at 100 rupees only. I'm just taking an example. It will be redeemed at 100 rupees, but it is issued at 120 rupees. If it is issued at 120 rupees, now what is the amount that I got? 100 or 120? 120. So what is net proceeds? 100 or 120? 120 rupees. Now flotation cost 2%. One doubt will always be there. Flotation cost we should apply with face value of the share or issue price of the share? Issue price of the share. Okay, flotation cost should be applied, okay, with applied to issue price. Okay, applied to issue price and not face value. Okay, this is one error which is usually done by the students. Flotation cost they will apply to face value. What they think, okay, face value of the debentures is this, so let me apply with the so you have to apply with issue price. If you are issuing at 120 rupees, then you have to apply flotation cost with the issue price only. Next thing, now you are redeeming, okay, now you are redeeming it at suppose 150 rupees. You are redeeming. Now this is an irredeemable shares. Irredeemable share, we don't have any redemption value. Okay, now here redemption value concept will come. If it is a redeemable share, you will have something called as redemption value. You will have something called as redemption. Suppose you issued shares at 100 rupees and you redeemed that share as 130 rupees. You issued share, okay, you issued at 100 rupees and your redemption value is 130 rupees. So what is happening is that first of all you are paying 10% interest. So 10 rupee interest you are paying, but for the 5 years you are also paying some 30 rupees extra. So this 30 rupees is also cost, right? This 30 rupees should also be included. So what is this? What we are doing, this I am treating it as capital gain. Okay, what I am doing, because this I am paying extra, correct? This 30 rupees I am paying extra. So what I am doing, the extra amortized cost that I am paying, okay, the extra amortized cost, 1 minute. Okay, the extra amortized cost that I am paying, so what is this? This is nothing but, okay, amortized cost, which is the difference. Okay, this can be amortized cost or amortized benefit, because if it is issued at discount, this will be at benefit, correct? If RV is less and net proceeds is more, my cost will become less. Why? Because it is a discount. So amortized cost or benefit, amortized cost of benefit for premium or discount. Okay, for premium or discount. Now no need to go too much into the logic. The only thing is, first thing, okay, first thing, whenever we are discussing redeemable shares, interest will always come. Okay, interest minus 1 by t by np is there. Okay, interest into 1 minus t by np is there, but one more cost that can include is if you're issuing a premium or discount. So RV minus NP is called premium or discount. Okay, this can be, if it is positive, it is premium. If it is negative, it is discount. This because if the life of the debentures is 10 years or if the life of the debentures is 20 years, you have to amortize it, correct? Because in numerator only annual cost can come, so you have to amortize it by n. Okay, so RV minus NP divided by n. Now denominator you can take net proceeds, but since the life is more and the redemption value is different, you can take the average cost. Okay, you can take the average cost. So NP plus RV, so RV plus NP, okay, RV plus NP divided by 2. Clear? Now this thing is very slow. I have to open a new file. 1 minute. Just 1 minute. Okay. So cost of irredeemable debentures I into 1 minus t divided by net proceeds, cost of redeemable debentures I into 1 minus t plus rv minus np the whole divided by n, the whole divided by rv plus np divided by 2. One minute. Just 1 minute. I'll just open a new so that it will be fast. Okay. I hope it works good. Okay, fine. So irredeemable I into 1 minus t divided by np. This np you have to adjust with flotation cost. Okay, flotation cost, or it can also be market value of debentures. Okay, it can also be market value of debentures. Okay, np is equal to market value of debentures or net proceeds. Okay, adjustment can be made to flotation cost. Redeemable debentures I into 1 minus t plus rv minus np the whole divided by n the whole divided by rv plus np divided by 2. Clear? No doubt in debentures. Can we move ahead? Okay, let's go to cost of preference shares. Okay, cost of preference shares is also called as KP. Preference shares can also be irredeemable or it can be redeemable. Now here what we have to see is that the only difference between interest and preference dividend is that interest we will get tax benefit, dividend we don't have any tax benefit. Okay, dividend we don't have any tax benefit. Any doubt, ask your DT teacher why. So KP is equal to preference dividend divided by net proceeds. Here KP is equal to preference dividend divided by plus RV minus NP the whole divided by N, RV plus NP the whole divided by 2. Very good. Okay, so N is not the total life. Okay, N is the remaining life. Always understand we are finding cost as on today, so you have to see only the remaining life. Okay, N is remaining life. N is remaining life. Okay, done. So this thing is done. Cost of preference shares is done. Next thing, if someone is asking you, okay, what is the cost of loan? Okay, what is the cost of my bank loan? What is the cost of my bank loan? If someone is asking you what is the cost of my bank loan, what will be the formula? Don't say the formula. He is telling, you will ask what is the interest of the bank loan. The person is telling that I am paying 20% interest. What I am paying? I am paying 20% interest. Now what is the cost of the bank loan? What is the cost of the bank loan? 20 into 1 minus t. Okay, because we will get tax benefit on interest. So nothing else, nothing new. Okay, now these are all the fixed whatever we have discussed. Okay, cost of debentures, cost of preference shares we have discussed. Now let us go into cost of equity. Okay, KE. This is something important. Cost of equity. Now under cost of equity, how many formulas we are having? Okay, we are having 5 formulas. Okay, we are having 5 formulas. Why 5 formulas, sir? Because we are having different assumptions. Okay, we are having different assumptions. We cannot have one cost of equity because different person will have different assumption. Assumption changes, cost changes. Okay, first thing is constant dividend approach. Okay, constant dividend approach, constant earnings approach. Okay, constant earnings approach, dividend growth model, Okay, dividend growth model, capital asset pricing model, okay, CAPM, capital asset pricing model, which is CAPM. Fifth one, what is it? Realized yield approach. Okay, realized yield approach. Realized yield approach. Now, one thing you would have missed is that under cost of debentures, whatever we have discussed is approximation method. Okay, this is approximation, correct? Because what we are doing, we are just taking the average. We are just taking the average. So this is not the actual cost. This is the approximate cost. So what is the actual cost? We have one more method called as YTM method. We have one more method called as YTM method. YTM method is nothing but IRR method. IRR method. This IRR we will discuss when we come to capital budgeting. Okay, when we come to capital budgeting, I will tell you how to do IRR, how to do interpolation. Logically we will discuss. Okay, but for now you should know that for cost of debentures we have two formulas. One is approximation method, second one is YTM method. Approximation method, you know the formula. YTM method is IRR method. IRR we will discuss in capital budgeting. Okay, now let us come to cost of equity. Okay, pa. Now, when we are discussing cost of equity, you all know this constant dividend approach. Now, what is the assumption? The assumption is I am paying constant dividend every year. Okay, so this is nothing but perpetual dividend every year, correct? This is nothing but perpetual dividend every year. Now, before going here, do you know the concept of what is perpetuity, what is time value of money? All this concept you know. Let me take some 5 to 7 minutes to discuss time value of money and how to discount cash flows, and then we will come to cost of equity. Okay, just 5 to 7 minutes discussion on time value of money, so that you will appreciate this constant dividend, constant earning and dividend growth model. Okay, 5 to 7 minutes discussion of time value of money. Am I going very slow? No, right? The speed is good. Very good. Time value of money. See, when I am talking about time value of money, today's amount is not equal to tomorrow's amount. So there will always be a time gap, and based on this time gap, the value of the money will changes. How it will changes? Based on the discounting rate. Okay, based on the discounting rate. This discounting rate can be inflation rate, can be any rate. Okay, it can be inflation rate, it can be any rate. Now, usually, sorry, yeah, for capital budgeting decision, you have to take the discounting rate as cost of capital, marginal cost of capital, correct? Cost of capital. Yeah, this can also be the rate of return. Okay, for different analysis, you have to use different discounting rate. Okay, but now I am showing how to discount. Okay, discounting rate is one, which discounting rate is, that is a final level discussion, but how to discount is foundation level discussion. Then why we are sitting in inter level, why we are discussing this, so you can appreciate the concept. Okay, so always in financial management, cash flow should be written like this: year end cash flow. If it is an outflow, you should write it negative. If 0th year you are investing some 1 lakh rupees, you have to write it as in negative. Okay, and if you are getting return 1 year, 2 year, 3 year, 4 years and 5 years, you have to write in positive. Suppose first year I am getting 50,000, second year I am getting 30,000, third year I am getting 30,000, fourth year I am getting 20,000, fifth year I am getting 10,000. Okay, so 0th year, okay, there is one business. 0th year I have invested 1 lakh rupees. First year I am getting 50,000, second year I am getting 30,000, third year I am getting 30,000, fourth year I am getting 20,000, fifth year I am getting 10,000. So can I say my profit is equal to 20, this is 30, 60, 90, 140. So 40,000 rupees is my profit. Can I say 1 lakh rupees I have invested, 50,000 is my return I got in first year, 30,000, 30,000, 20,000, 10,000, which is nothing but 1,40,000. So 40,000 is my profit. Can I say? Monkeys and donkeys cannot be added. Okay, first year cash flows and second year cash flows cannot be added. Second year cash flows, third year cash flows cannot be added. Why? Because the value of 50,000 is not equal to value of 30,000. The value of 30,000 is not equal to value of 30,000. Okay, so we have something called as time value of money. Because of this time gap, you have to change the value. So how you will change the value? You will bring all the values to 0. You will bring all the values to 0. Okay, and then you are going to add all this. So once you add all this, then you will get something called as net present value. What is net present value? It is nothing but discounted cash flow. So what you have to do, the changing, okay, the conversion of future value to present value is called discounting. Okay, is called discounting. The 5th year value we are converting it to 0th year, right? So we are going, so what we have to say in financial terms, we are discounting this 10,000 rupees. Okay, you all will be thinking, what's our foundation level discussion? Bear with me. Okay, discounting. So when I say how to discount, okay, when I say how to discount, you will have different types of cash flows. Okay, we will have single cash flows, multiple uneven cash flows. Suppose I am telling you that I am having a 5th year, I am getting 100 rupees. Okay, 5th year I am getting 100 rupees. So how to discount this 100 rupees? How to discount this 100 rupees? The formula for discounting is cash flow divided by 1 plus I to the power n. Or you want me to explain this also? No. Okay, cash flow divided by 1 plus I to the power n. Okay, so present value is equal to future value divided by 1 plus I to the power n. Okay, so this 100 is the future value, this 100 is the future value. So how you will discount hundreds? Just for an example, we will take discounting rate is 10%. So how you will do 100 divided by 1 plus I is 1.1, correct? 1.1 to the power 5. What is the amount? What is the amount? $62.09. Okay, 62.09 rupees. Now how we are getting this? What we are doing is 100 into 1 by 1.1 to the power 5. That is what we are doing. This thing what we will do, this is called present value factor. Okay, you will have table also, you can calculate from calculator also. How to calculate from calculator? 1 divided by 1.1 and equal to 5 times. Okay, so this is present value factor. Sir, idu theriyamala na 1 month exam ku varamata. I know. So if who knows who is seeing this video, something can be helpful to someone. That is the reason I'm telling in entirety. Okay, so this is what is called as this. Now you know that discounted cash flow is equal to future cash flow into present value factor. Done till here? Okay, how to calculate present value factor also I told you. So this is how, even if it is multiple uneven cash flow, okay, multiple 1 2 3 100 200 300, how you have to calculate? This is the table. Okay, year cash flow, then you have to do present value factor at the rate of 10%. Write all the present value factor. Okay, write all the present value factor, don't calculate sumada. Okay, write all the present value factor, and then you will get something called as discounting cash flow. This will be the discounting cash flow. This will be the discounted cash flow. Okay, this will be the discounted cash flow. That is how you have to calculate. Completed. Next one we have something called as annuity cash flow. Okay, annuity cash flow, how you have to calculate? Annuity cash flow, now first of all, the same amount you will receive. So this will be written as 1 to 10 years I am receiving 200 rupees. 1 to 10 years I am receiving 200 rupees. Some people, what they will do, 1 2 3 4 5 6 7 8 9 10 200 200 200 200 200 present value factor, all the present value factors they will do, they will multiply, they will do the discounting factor. This will take time. So this what we are going to do, there is one shortcut which is nothing but cash flow into present value annuity factor. Present value annuity factor is nothing. See, if I am doing 100, if I'm doing present 200 200 200 200, and if I'm multiplying with their present value factor, so I can take 200 common and then present value factor for first year plus present value factor for second year, I will do till n. So all this total is what is called as present value annuity factor. So how to calculate present value annuity factor? One, it will be in table. Okay, one, it will be in table. Second thing, you can calculate from the calculator. Okay, so in exam, who knows whether you will receive the table or not? Okay, who knows in which sune you are sitting? Okay, so you will receive the table or not. So it is better to calculate in calculator. So how to calculate? Again, 1 divided by 1.1, okay, equal to, so you have to press equal to 10 times. 1 2 3 4 5 6 7 8 9 10. Once you press equal to 10 times, press the button GT, okay, grand total. If you press grand total, you will get the present value annuity factor. What is present value annuity factor? 6.14, okay, 6.14. 4. Okay. 5, anything. Okay, so 6.1445 is the present value annuity factor. This is one method of calculating. Second method, in some calculators GT will not be there or GT is not be working. So what you have to do, 1 divided by 1.1, so you press equal to, correct. Now you got the first year value you keep it in n plus. First year value you keep it in m plus. M plus means you're keeping the memory and you're adding it. Okay, m means memory, you're keeping it in memory and you're adding it. Then second year memory, third year memory, like this 10 times you do. Okay, equal to memory 4, 5, 6, 7, 8, 9, 10. Okay, now everything is added. Now if you put memory recall, you will get the value 6.1445. Same thing. Okay, MRC means memory recall, whatever is there in the memory just recall. So whatever is so this is the amount 6.1445. So two so which is easy for you. Okay, if you have the grand total button, press grand total, but grand total always first reset. Okay, first reset. First, if you press MRC 2 times, your memory will be resetted. Okay, first always reset the calculator. How to check whether number is there in the memory or not? In the calculator upward you will see M. If you will see M, na something is there in the memory. If you press MRC 2 times, na the M will go. Okay, very basic I'm talking, as if it is an LKG. Okay, not LKG, it is a first class, but slowly I'll pick up the speed. Okay, I'm not used to taking marathon sessions. Fine. Present value annuity factors. Now how to take annuity factors? Third type of cash flow is perpetuity cash flows. Okay, perpetuity cash flows. Perpetuity cash flows now till infinity you are receiving some amount, so it will be 1 till infinity I am receiving 200 rupees. Okay, 1 till infinity I am receiving 200 rupees. Now how to find out discounted cash flow for perpetuity? Annual cash flow divided by rate. Okay, annual cash flow divided by rate. Okay, if you do 200 divided by 10%, this 2000 rupees is the discounted cash flow for this perpetuity cash flow. Done, completed. So now if you see we have 5 types of formulas. Okay, again we will come to here. We have 5 types of formula. Now you will be able to understand the logic of what we are discussing. Okay, cost of equity. First one, why I am also writing again and again, so this will sit in your brain. Okay, I know everything, but why I am writing again and again, it will sit in your brain. First one, what is the first formula? Constant dividend approach. Okay, constant dividend approach. Okay, constant earnings approach. Constant earnings approach. Third one, dividend growth model. Okay, dividend growth model. Fourth one, capital asset pricing model. Capital asset pricing model. And then it is realized yield approach. Okay, realized yield approach. Okay, done. Realized yield approach. Now constant dividend approach, now receiving dividend till infinity. It is nothing but cash flow. Okay, 1 to infinity you are receiving same dividend. So what is the formula here? You are finding rate. Okay, you are finding the rate R. So as I said, discounted cash flow is equal to annual cash flow divided by rate. So if you want to find the rate, annual cash flow divided by discounted cash flow. You know discounted cash flow, present, the price is nothing but the present value of all the future cash flows. Present value of all the future cash flows is called discounted cash flow. So discounted cash flow is only the price. Okay, discounted cash flow is only the price. You all know that discounted cash flow is only the price. So if I want to calculate KE here, KE is equal to, what is my annual cash flow? Dividend. Okay, DPS divided by price. Okay, price. It is also called as market price per share, or it is also called as P0. Okay, P0 is also the cash, NPS is also the cash. Okay, done. This is the first formula. Are you all understanding this? Understanding? Even if you are not understanding logic, don't worry, the formula is DPS by MPS. Okay, second, K is equal to EPS by MPS or EPS by P0. Okay, EPS by P0. Now whenever there is any growth rate means what is happening, this 1 to infinity 100 rupees is there now, this 100 rupees is increasing by 10% every year. That is what is perpetuity growth model. Okay, perpetuity growth model. The formula for perpetuity growth model is D1 P0 plus G. Very good, Pa. Very good. See, this is the formula. See, first thing, this dividend will come, but always remember this is the dividend for next year. Okay, this is the dividend for next year. Next year, expected dividend. D1 is nothing but D0 into 1 plus G. Okay, D1 is nothing but D0 into 1 plus G. D0 is current dividend. Current dividend, if you add the growth, you will get D1. D1 divided by price. This is the D1 divided by price, plus you have to add growth. Okay, plus you have to add growth rate. Okay, so K is equal to D1 divided by PO plus G. Three formulas completed. Next one, capital asset pricing model. Capital asset pricing model, the formula is risk free rate plus beta into RM minus RF. Very good, RM minus RF. Now, if you want to understand what this formula is, an investor first thing he will invest something. What is the risk free rate? Risk free rate is nothing but the return from government bonds. Okay, return from government bonds, etc. Because government bond is treated as risk free. This is something that I will get. If I am investing in your share, at least government bond return I should get, correct? And after this will be the premium that I will be asking. This will be the premium that I will be asking. Okay, now how to calculate this premium? First thing is beta. Okay, what is beta? Beta is nothing but the beta coefficient. It is beta coefficient, or it is also called as price sensitivity to market. Price sensitivity to market. Okay, different words will be given, don't get confused. If in the exam it is given the price sensitivity to market is 3, don't get confused, they are talking about beta only. Okay, so beta. Now if I am talking about RM is nothing but the return on market. Okay, return on market, return from market. Okay, return from market. If I am investing in market, what is the return that I am getting? Minus RF, I will get the premium, correct? Market I am getting 20%, already risk free rate is 10%. Now 10% is the premium that I am getting. Okay, 10% is the market premium. Okay, so RM minus RF is equal to market premium. Okay, market premium. Are you all understanding? RF is equal to return from the market portfolio. RM minus RF is equal to market premium, is equal to market premium. Now if I multiply beta is the risk which is attributable to the stock. Beta is the risk that is attributable to the stock. So if I multiply the risk attributable to the stock to the market premium, I will get the premium that I want for the stock. Okay, actually what is beta? Beta is the how the stock market is moving with the market. Okay, how the stock market is moving with the market. If I am telling beta is equal to 2 times, if I am telling beta is equal to 2 times, which means if the market is increasing, if the whole market is increasing by 1%, my this stock will increase by 2 into 1%, which is 2%. Okay, 2 times. This is always beta. How to calculate beta? Don't worry, it will always be given in the question. Okay, it will always be given in the question. How to calculate beta is a final level discussion. Come to me in final, I will teach you how to calculate beta. For now, beta will be given in the question. Beta is nothing but, so you no need any other discussion. The only formula is RF plus beta into RM minus RF. Done? Okay, pa. Capital asset pricing model completed. One minute. Okay, pa. Next is realized yield approach. Many students will be having doubt. What is realized yield approach? Okay. You also having doubt, huh? Ayyo. Okay. Realized, very confusing. Huh? See, I'll tell you what is realized yield approach. In all the four methods that you studied, okay, you were seeing the future cash flows. You were seeing the future cash flows. All were assuming future cash flows. First, constantly I will receive dividend, constantly I will receive earning, I will receive dividend in growth, capital asset pricing, I will receive something premium from the market. Everything you are deciding based on future. Realized yield approach is nothing but you are taking value from past. Okay, what is realized? Realized na past. What is yield? It is profit. Okay, you're taking the you are taking my expected profit from the past profit. So what you are doing is you are taking last 5 years return. Okay, last 5 years return, just an example, last 5 years return that you are taking the average, you are taking the average return of past 5 years. Then you saw my average return of past 5 years is 14%. Okay, then what is my expectation for next year? 14%. So realized yield approach is nothing but taking the past profit average 14%. So taking the average of 14% for past 5 years is what is called as realized yield approach. Clear? So one problem, if I show you only, then you will be able to understand that. Now how to calculate this return? How to calculate this return? You all know, if we have dividend and if we have the price, okay, if we have the dividend, if we have the price, then the dividend that I'm receiving and the price at the end of the year and the price at the end of the year divided by the price at the beginning of the year is what is my return percentage. Is my return percentage, return for first year. If I want to find out the percentage return in first year, because you want to find the return for 5 years, correct? 5 years prices are given. Okay, 5 years prices are given. First year price was 100, then it became to 110, then it came to 120, then it came to 140, then it came to 130. Okay, all these years you receive dividend. Okay, all these years you receive dividend. Suppose I receive dividend here at 20 rupees, I receive dividend here 10 rupee, I receive dividend here 5 rupee, I receive dividend here of say 25 rupees. Okay, now what I have to find to do? First I will find out the profit that I'm getting. Okay, first I will find out the profit that I'm getting. Now what is the profit that I'm getting? This 100 rupee share has become 110 rupee. So 10 rupees the capital gain profit that I got. 20 rupees is the dividend. So this 30 rupees is my total profit. Correct? Here what is my profit? 110 rupees share has become to 120 rupees. So 10 rupees my capital gain profit and 10 rupees my dividend profit. 20 rupees is my total profit. This 20, 25. This 10. So capital loss minus 10 and dividend I got 25. Okay, so 15 rupees is my profit. Correct? So this, now I want to find out the profit percentage. Okay, profit percentage. How I will find out the profit percentage? 1 minute. So how I will find out the profit percentage? This 30 rupees profit I got by purchasing the share of 100 rupees, correct? So 30 divided by 100 into 100, what is the percentage? 30%. 1 minute, actually I'm not able to write. It is 30%. Second one, what is the percentage? Okay, likewise you have to find all the percentages. Okay, likewise you have to find all the percentages. Now you got percentages of 4 years. Okay, now you got percentages of 4 years. Now if you got percentages of 4 years, there are only two methods, there are only two things. One, you have to do the simple average, or you have to do the weighted average. In exam it is done weighted average. Weighted average is nothing but the compounding effect. You are finding the CAGR, which is compounded annual growth rate. Okay, let me show you the question. Because once you see the question only, then you will be having clarity. Downloads, cost of capital. Are you all able to see this? See, are you all able to see the textbook? Online students, are you all able to see the textbook? No, 1 minute. Uh, just 1 minute. One minute. Can you just see if Marvin is there? Just 1 minute. Huh? I've downloaded the book, but students are not able to see this. Now are you able to see, students?
Yes, sir.
Okay.
Yes, sir.
It's not that I can't see this is great.
Okay.
Not this is great.
Okay. So here I have to open. Yeah, okay. Yes,
Page number 4.22, sir.
page number 4.22. Thank you very much. 4.22. Okay. Okay, pa. Sure. Thank you. Now we'll go to illustration 11. Okay, illustration 11 is a typical realized yield approach problem. Okay, illustration 11. Just see the illustration 11 here. Now if you see this illustration 11, you do it in table approach. Okay, once you see the formula na, you will be able to you will mess up things. Okay, you will mess up things. So always try to do things in table approach. So what you have to do, first thing is price. Okay, first thing is price. You are having price of 9, 9.75, 11.5, 11, 10.6. Okay, then you have dividend. What is dividend? 1 rupee, 1 rupee, 1.2, 1.25, 1.15. Correct. Now calculate what is the profit. Okay, calculate what is the profit, or you write return in rupees. Okay, return in rupees. First year you don't calculate return. Okay, first year you don't calculate return. Now what is the return? What is the return here? 1.75. What is the return here? 2.95. What is the return here? Are you sure it is 2.95? 1 minute. 11.5 minus 9.75 plus 1. Yeah, okay. Now what is the return here? Nil return. No, pa. See, 1 minute. My 9.75 minus 9 I have to do, correct? It's 11.5. Okay, 11.5 minus 9.75 plus 1 rupee, 2.75. So 11 minus 11.5 plus 1.25, I will get 0.75. Is it correct, or am I wrong? 10.6 plus 11 plus 1.15. It is 0.75. But yeah, there is one thing alone. Here in the textbook, okay, here in the textbook, what they have done is they took dividend as 1.25 and 1.15. Okay, 1, see if you can see 1.2 and 1.25. 1.2 and 1.25 is what they have took. So you take it what is what this institute is doing. Actually this is the correct way, but you do it what institute is doing. Yeah, correct. But for first you will get the answer, but for the next year we will not get proper answers. Okay, then you have to calculate return percentage. So what you do, you take dividend like this. Okay, don't take dividend like this, you take dividend like this, not an issue. Okay. No, see, don't do as per my method, do it as per this only, study mat only. Do it as per study mat. This makes more sense, but can't help it. So then you have to do return percentage. Okay, return percentage. So once you do return percentage, see why? Because now this is D1. Okay, no, actually what I can tell you is this is D. Okay, this is P0, P1. So they took P1 as 9.75 and they also took D1 as 1. Okay, this is only they are doing D1. They are taking P2, D2, P3, D3, P4, D4. This P0 and D0 is what they are ignoring.
Sir, they were taking for last 4 years.
Yes. Last 4 years they are taking. So D4 is the 4th year. Okay, fine, pa. Anything? Yes. Okay. Which one makes sense? Institute. Yeah. Correct. Correct. So you have to do it in this way. Okay, you have to do it in this way. So once you get that, you will get some return percentage. What you will get? You will get 19.44 percentage. Correct? Are you all getting? You will get 28.21 percentage. You will get 6.09 percentage. You will get 7.72 percentage. Are you all getting this? I hope you are getting this, right? Done. Okay. Now see what is happening here is you are having now 4 rates. You are having 4 rates. One is 19.44 percentage. One is 28.21 percentage. Now is 6.09 percentage. Now we have 7.72 percentage. Okay, you have 4 rates. There are 2 methods. Okay, one is arithmetic mean, second one is geometric mean. Now what is arithmetic mean? Just do all the 4 divided by 4. Okay, so 19.44 plus 28.21 plus 6.09 plus 7.72 divided by 4, you will get 15.365 percentage. So under arithmetic mean you will get 15.365 percentage. Okay, but geometric mean you have to do. Geometric mean is what makes sense because it is compounding. Okay, because it is compounding. Now what is geometric mean and how we are doing it is what is the question. Correct, is what is the question. Now take it, now take this, 1 minute, small explanation alone I'm making. Okay, one small explanation. You all know this present value, present value is equal to future value divided by 1 plus I to the power n. Okay, just say this I is 4. Okay, just say this I is 4. Now 1 plus I to the 4, okay, present value into 1 plus I to the 4 is equal to future value. Okay, present value into, this is nothing but compounding. Okay, this is nothing but compounding is what we are doing. Now see what I'm doing here is, if I have the price here, it is 1 plus I to the power 4. Why I am doing 1 plus I to the power 4? Okay, it is nothing but 1 plus I, 1 plus I, 1 plus I, 1 plus I. What we are assuming, this I is the discounting rate. What we are assuming, this I is the discounting rate 10%. Every year 10% is discounted, correct? Every year 10% is discounted. But when we are doing realized yield approach, every year this rate is different, correct? This I is different, this I is different, because this is future na, we cannot take different rates, same rate we will take, okay, and then we will discount. Now here we have different rates, so that is the reason what we have to do. We have to do 1 plus I for the first year into 1 plus I for the second year. Same thing is what we are doing, okay, same thing is what we are doing. What we are doing, 1.1944 into 1.2821 into 1.069 into 1.0772. Are you all understanding why I am doing this? First of all, the logic you are understanding, okay. See, there is no formula like this, but the logic you have to understand. That is the reason we are doing, because future na same rate you will do and compound, but since it is realized yield approach, every year the rate will be different. It is nothing but 1 plus I to the power 4, but I is different for all the 4 years. So 1 plus I1 into 1 plus I2 into 1 plus I3 into 1 plus I3. Clear? Yeah, that's what I did. Yeah, that's what I did. Divided by 4, this is what is arithmetic mean. 15.365%. You missed it, arithmetic. You can do like that, but you do both na, arithmetic mean and geometric mean, because geometric mean is what they are expecting, correct? So leaving the answer in arithmetic mean is not proper. This is, we can also do that. Arithmetic mean is the approximate rate, geometric mean is the actual rate. It is nothing but similar to IRR, okay, arithmetic mean and geometric mean. Now geometric mean, what we are doing, everything we are doing this, okay, and then 4 square root, okay, 4 square root, the square root of 4th one. Why? I will tell you why square root of 4th one. Because if you are doing 1 plus I to the power 4, you will get some rate. If you want to find out the annualized rate, you have to do square root of 4, correct? You have to do the square root of 4, because these are 4 rates combined. These are the 4 rates combined. Now if you want to find a single rate, you have to do square root of 4, okay. How to find out square root of 4? Sorry, not square root, 4th root. How to find out 4th root? Ayyo, how to find out 4th root? See, in calculator we have a method. First you have to put this number, okay, you will get that number. What is that number? This number is, what is this number first? See, 1.1944. I don't want to spend too much time in problems, okay. 1.2821 into 1.0609 into 1.0772, okay. You are getting 1.75. You are getting 1.75. 1.75 4th root. How you will find out? First you have to put this number, okay. In calculator, if any root you can calculate by calculator, okay, any root you can calculate by calculator. 4th root, 5th root, 100 root, 200 root, any root you can calculate. There is one shortcut method. First is put the number in calculator, okay, this number, put this number in calculator. Second one, press square root 15 times, okay, press square root 15 times. Third one, add 1. First, sorry. First you have to subtract 1, okay. First you have to subtract 1. Fourth one, what you have to do? Then you have to divide it with the nth root, okay. We have to divide it with the nth root. Fifth step, what you have to do? You have to do plus 1, okay. Sixth step, what you have to do? Okay, press into equal to 15 times, okay, into equal to 15 times. Then what you have to do? So if you try this, you will get 1.75. First what you have to do, you have to put this number, then you have to do square root 15 times. 1 2 3 4 5 6 7 8 9 10 11 12 13 14 15, then minus 1, okay, then divided by nth root, which is 4th root, then plus 1, then into equal to 1 2 3 4 5 6 7 8 9 10 11 12 13 14 15, okay. what you will get? You will get the answer 1.15. Okay, you will get the answer 1.15. What is 1.15? Then you have to do -1. You have to do -1 because this is the you took +1 here, right? You took +1 here, so you have to take -1. You do -1. The answer is 15%. Okay, the answer is 15%. Anyone is having any doubt? Online students, any doubt you're having in realized yield approach? If this problem comes now, 90% of the student leave this problem. But at least now I think you won't leave this problem. Any doubt? How I got 1.75? It is nothing but 1 plus I1 into 1 plus I2 into 1 plus I3 into 1 plus I4. Okay, why I am doing like this? Why I am doing like this? Usually I have to do 1 divided by 1 plus I to the power 4, but since here 4 rates are different, I am just multiplying it 4 times. Online students, are you all understanding the logic? If you're not understanding the logic, follow these steps. Okay, because only one problem is there and only this type of problem is possible. Okay, online students, you can reply, so it can be interactive.
Understood.
Understood. Very good, Pa. Okay, done. Can we move ahead? Okay, but you know, we have one shortcut also. That shortcut is this 1.75. You do root 2 times, you will get 4th root. Root 2 times 4th root, right? So square root into square root, you will get the 4th root. Okay, you do this. But why I am teaching this? I know this also, but why I taught this? What if it is 5 years? So that you should not get stuck. I can very easily say do root 4 times and go ahead. But why I taught this? So this will help us. If it is 5th root also, you will be able to do that. Okay, if it is 4th root, if it is 2nd root, if it is square root, if it is 4th root, if it is 8th root, you will be able to do like this. Okay, done. Realized yield approach done. Now once you found out the cost of all the individual items, if you want to find out the cost of overall company, how you have to do? You have to do the weighted average cost of capital. This is something called as WACC. Okay, see, it is very important concept. WACC is very important concept. In exam they won't ask you single cost of capital. Single cost of capital, they will only ask you for equity. Okay, but if they want to prepare a question, they will ask some 2 or 3 single and then they will ask you to find the WACC. Okay, now how to find the WACC? There is a table. Okay, there is a table. First is sources of funds. Okay, first is source of fund. Suppose it is equity, preference share capital, okay, debentures, retained earnings. Okay, retained earnings, you will have these things. Okay, now after source, what you have to do? The amount. Okay, the amount. Suppose you're having equity of 100 crores. Okay, preference share capital is 50 crores, debentures of 200 crores, retained earnings of 100 crores. Then what you have to do? You have to find out the weight. Okay, you have to find out the weight. First, you have to find out the total capital. What is the total capital? 300, 450. You have to find the weight. The weight can be in ratio also, the weight can be in percentages also. Okay, so it is 100 by 450. Okay, 100 by 450. You have to find out the rate. Rate is nothing but if this is A, B, C, D and E, this will be A by E, this will be B by E, this can be C by E, this can be D by E. Are you all understanding? Okay, after finding weight, what you have to find the cost. Okay, cost, you all know separate formulas we calculated. Then this will be the weighted cost. Okay, weighted cost. See, any question comes, do only in this table. Okay, weighted cost is nothing but, okay, if this is A into B, this is A into B. Okay, weight into cost. Okay, weight into cost. Once you do all this is something called as weighted average cost of capital. Done. Weighted average cost of capital. Okay, done. Now one thing what we missed is I didn't teach you how to find out the cost of retained earnings. Okay, I didn't teach you what is the cost of retained earnings. Now concentrate. cost of retained earnings is generally cost of equity. Concentrate, cost of retained earnings is generally cost of equity unless we are having some adjustments. Okay, now what are those adjustments? If we are having any flotation cost, now you have to reduce this flotation cost. So 1 minus flotation cost percentage. Okay, 1 minus flotation cost percentage. If we are having any brokerage, now that also you have to reduce. 1 minus any brokerage percentage is there. Okay, or if there is any personal income tax, not corporate income tax, if there is any personal income tax, that also you multiply 1 minus personal income tax percentage. Okay, personal income tax percentage. Why? Because all these are opportunity cost. Because cost of retained earnings, okay, cost of retained earnings will not have any flotation cost, will not have any brokerage, will not have any personal income tax, but KE will have all these things. So that is the reason you take KE. Okay, you take KE and then you remove flotation, brokerage and personal income tax, you will find out KR. So all these opportunity costs are getting reduced. Okay, all these opportunity costs are getting reduced. Yes. See, if you want to issue new equity, na flotation cost will be there, correct? So that is the reason you're removing flotation cost, because KRL there is no flotation cost, so you remove flotation cost. If you are paying dividend, because you will pay dividend, na personal income tax will be there, so you remove personal income tax. If the person is sharing in trade, na he will pay brokerage, so you remove brokerage. So all the shareholder cost you reduce it, you will get KR. Okay, so there is one small problem. In one time, one 3-mark problem came just by using this concept. Okay, find the cost of retained earnings, the cost of equity is this, the flotation cost percentage is this, the brokerage percentage is this, the personal income tax percentage is this, and corporate income tax percentage is this. Okay, all the 4 values given. Now if the person knows this formula, and it is just a 1-minute problem. Okay, not even 2 minutes, 1-minute problem. But if the person don't know this formula, this is nothing, this is no formula, this is just logic. But if the person don't know the formula, he will get stuck. What I will do? Corporate tax where I should put, personal income tax where I should put, flotation cost where I should put. Okay, so this is the formula, cost of retained earnings. Done. Now weighted average cost of capital, we have 2 weights. We have 2 weights, book value weight. Okay, book value weight and market value weight, and market value weight. Okay, market value weight, it is nothing but the amount that you are taking, the amount that you are taking. Concentrate. In book value, the amount that you will taking will from the balance sheet. Okay, the equity share capital, reserves and surplus, okay, debentures, preference share capital, you will take amount from balance sheet. Okay, you will take amount from balance sheet. Book value, amount from the books. What is the books? Balance sheet. Market value, you have to take the market value. Debentures, you have to take market value of debentures. Preference shares, you have to take market value of preference shares. This equity and reserves and surplus together is called equity. Okay, together is called equity. This is nothing but market value of equity share. Okay, market value of equity share. Now you will get confused. This is for equity, then what is reserves and surplus? See, there is no bifurcation of equity and reserves and surplus for shares, correct? If you are purchasing a share of 120 rupees in Reliance, you cannot bifurcate. Am I paying for equity share capital, or am I paying for reserves and share surplus? Reserves and surplus. So what you will do, you will directly put equity, or in many textbook what they will do, they will bifurcate this equity, the market value, into equity and reserves and surplus with book value weights. I mean with book value of equity and reserves. Understand what I am telling? If I am having 100 rupees of equity and 50 rupees of reserves and surplus, and if my market value is 350 rupees, see, if my market value is 350 rupees and my book value is 150 rupees, and book value I have in the ratio of 1:5, sorry, 1:0.5, okay, or it is nothing but 2:1. What is the ratio of book value? 2:1. So what I will do, this 350 also I will do in the ratio of 2:1. Okay, so 350 divided by 3 into 2, so this will become 233 and this will become 167. Okay, so this will be the equity and reserves and surplus bifurcation. You can do, you cannot do. In textbook, few problems they did the bifurcation, few problems they didn't do the bifurcation. For standardization, you do the bifurcation. There will be no impact. Okay, there will be no impact. And then you calculate the weighted average cost of capital. Now you know how to calculate book value weight. You know how to calculate market value weight. With this, you will find out what is the WACC. Okay, what is the WACC? WACC as per book value, WACC as per market value. One typical question that can come from cost of capital is that they will give you the details of all the costs, they will ask you to find out all the individual costs, and then they will also give you the price of all the shares, price of share, price of debenture, price of preference share, and they will ask you to find out the WACC as per book value and WACC as per market value, an 8-mark problem, a typical 8-mark problem. Okay. Now any sum that we are doing, okay, any sum, any chapter we are studying, because this is exam oriented class, I'm not going very slow, right? This is exam oriented class. So why? Because it is exam oriented class, I will show you what type of questions are possible. In cost of capital, only 2 types of question is possible. Okay. First is finding individual cost of capital. Individual cost of capital. This is one type of question which is possible. In this question, usually they ask either redemption value of debentures, YTM, okay, redemption value of debentures and YTM. This is one type of question they ask, or they will ask cost of equity, okay, or they will ask cost of equity. In second type of question is this comprehensive problem of WACC, okay, comprehensive problem of WACC. This is second type of question. Only 2 types of questions are possible, okay, book value of capital, market value of capital. Next is marginal cost of capital. Marginal cost of capital is nothing but cost of raising additional capital. So they will give details of additional capital. Additional capital can be at a different rate, and that is marginal cost of capital. If you see the problem, you will understand. Okay, cost of capital chapter is completed. Done. Okay, let us go into leverages. Next 20 minutes I will complete leverages. Okay, leverages. What is leverage? Okay, what is leverage? First of all, what is leverage? Leverage is nothing but whatever advantage or disadvantage that we are getting, okay, that we are getting by inclusion of fixed cost. Okay, so because of fixed cost, if we get any, okay, if we get any advantage or disadvantage, is called leverage. Okay, it's called leverage. Usually they talk about advantage, but as you all know, leverage is a double-edged sword. You can either get advantage or you can either get disadvantage. If profit is increasing, you get advantage. If profit is decreasing, you will get double disadvantage. Okay, so this is one thing. Just 1 minute. Okay, now how to calculate leverages? See, leverages occurs because of fixed costs. Okay, now draw an income statement. How to draw an income statement? Sales minus variable cost, what you will get? Contribution minus fixed cost, what you will get? Okay, EBIT minus interest, what you will get? Earnings before tax minus taxes, what you will get? Okay, profit after tax. Preference dividend for now, keep it aside. Okay, PAT divided by number of shares, this is PAT or earnings available to equity shareholders. So what you will get? EPS. Done. So this is a typical income statement. Now here, what are the fixed costs? Here, what are the fixed costs? 1 minute. Here, any cost which is not related to sales is called fixed cost, which means whatever level of sales the cost is incurred, it is called fixed cost. So one is this fixed cost. 1 minute. One is this fixed cost. This is one fixed cost. What is second fixed cost? Interest. Okay, this is operating fixed cost, this is financial fixed cost. Okay, so we have this two types of fixed cost here. Okay, fixed cost and interest. Now see, we have three formulas here. Okay, we have three formulas here. What is first formula? Contribution by EBIT is first formula. Okay, this is formula for operating leverage. What is operating leverage? Contribution by EBIT. What is second formula? EBIT by EBT. Okay, financial leverage is equal to EBIT by EBT. Done. Operating leverage, financial leverage. Okay, two formulas. Combined leverage is nothing but this combined by 2. So this is nothing but contribution by EBT. Okay, contribution by EBT. It can also be called as operating leverage into financial leverage. Done. Now what is happening here is that if I am telling my operating leverage is equal to contribution by EBIT, so are you all able to understanding this formula? You don't need to mug up, right? The formula you don't need to mug up. You all know operating leverage is because it is occurring because of this. So contribution divided by EBIT, then contribution divided by EBT. Okay, just 1 minute. This is one set of formulas. Okay, three formulas we discussed. Second set of formula, I can do it here but it will become messy, that is the reason I am writing again. Okay, sales minus variable cost will get contribution minus fixed cost, what we will get? EBIT minus interest, what we will get? EBT minus taxes, what we will get? PAT. Okay, PAT. Then divided by number of shares, what we will get? EPS will get. Now see here, we have two fixed cost. Now what we are doing is every number is linked to one number. Okay, leverage is nothing about linking of one variable to another variable. Now here if you see, EBIT is linked to sales. Okay, EBIT is linked to sales. The formula is percentage change in EBIT divided by percentage change in sales. Okay, now here this will be linked to this. So this will be percentage change in EPS divided by percentage change in EBIT. Okay, now combined leverage will be, you are connecting these two. Okay, so this is operating leverage, this is financial leverage. Combined leverage is equal to percentage change in EPS divided by percentage change in sales, or operating leverage into financial leverage. Okay, or operating leverage into financial leverage. 6 formulas. Is there any need to mug up this formula? No. Only one method I will tell you. What is the one number that will make you remember all the formulas? 3. Okay, only 3 you have to remember. See what we are doing, we are nothing but we are drawing 3. Okay, we are drawing 3. First set of formulas. Okay, first set of formulas, it is bottom to top. Okay, contribution by EBIT, EBIT by EBT. Okay, this is bottom to top and this is, that is top to bottom and this is bottom to top. Okay, this is bottom to top because percentage change in EBIT divided by percentage change in sales. Operating leverage, financial leverage and combined leverage. Done. Now this is mug up of, so this is formula, this is an approach by which you can this is the approach by which you can understand this formula. Now what is the interpretation of the formula? You have to know what is the interpretation, correct? Operating leverage, financial leverage and combined leverage. if I'm telling operating leverage, it means okay, 1% change in 1% change in sales will have, okay, this times percentage, okay, this times percentage, which means n percentage change in EBIT, because they are linking sales with EBIT. Okay, second one, 1% change in EBIT will have, okay, n percentage change in EPS. Okay, combined leverage is 1% change in sales will have n percentage change in EPS. Okay, this is what is the interpretation, which means if I am telling my operating leverage is 2 times, my financial leverage is 3 times, and what will be my combined leverage? This will be 3 times, which means if my sales is changing by 1%, my EBIT will change by 2%. Okay, EBIT will change by 2%. Financial leverage means if my EBIT is changing by 1%, my EPS will change by 3%. Combined leverage means if my sales is changing by 1%, my EPS will change by 6%. Okay, this is what is combined leverage. Done. This is what is the interpretation. Now, what are the types of question that you can expect in leverages? Okay, what are the types of question that you can expect in leverages? Under leverages, 2 types of questions alone you can expect. First type of question is details will be given, find leverages. Okay, find leverages and one interpretation question. Okay, one interpretation question. This is one type of question possible. Are you all visualizing what is? We'll give some details and they will ask you to find the leverages. After finding leverages, they will tell, okay, now the sale was 1 lakh rupees. The sale has increased to 1,20,000 rupees. What will be the new EBIT? What will be the new EBIT? Just for example, sale was 1 lakh rupees. Okay, your sale has been increased to 1,20,000 rupees. Okay, 1,20,000 rupees. Say your old EBIT was 10,000. Okay, this was the old sales, this was the old EBIT. Okay, and your operating leverage is 2 times. Now what is happening? Your sale is 1 lakh rupees, your EBIT was 10,000 rupees, already calculated. Okay, now the question is, your sale has increased from 1 lakh to 1,20,000 rupees. What will be your new EBIT? So how you should understand? First you have to find out the percentage change in sales. What is the percentage change in sales? Is equal to 20%. How you find out 20%? 1,20,000 minus 1 lakh divided by 1 lakh. Okay, percentage change in sale is 20%. Now what you have to find out? Percentage change in EBIT is what we have to find out. So what you have to do, percentage change in EBIT is 2 times into 20% is equal to 40%. Okay, so what is new EBIT? New EBIT is equal to, first is old EBIT into old EBIT plus 40%. What is old EBIT? 10,000 plus 10,000 into 40%. Okay, plus 10,000 into 40%. So what will happen? 10,000 into 40% is 4,000. So 10,000 plus 4,000 is 14,000. So what is my new EBIT? 14,000. Like this problems are possible. Okay, like this problems are possible. Are you all understanding? Yes, no, yes, no, yes, no. Done. Now you are understanding. First question is details will be given. You will ask to find the leverages with any one interpretation question will be asked. Okay. Second will be they will give partial details. Okay, they will give partial details and some leverages. Okay, and some leverage will be given. And they will ask you to construct the income statement. They will ask you to construct the income statement. This is the second type of question possible. Some leverages will be given, some details will be given, and they will ask you to construct the income statement. So what you have to do, this is nothing but one variable will be given, one variable will not be given. With that one variable, you have to find out the other variables and then you have to construct the income statement. Okay, this is the second type of questions possible. Done. Now you are comfortable with leverages chapter or you want to discuss more? Comfortable, correct? So leverages is completed. Okay, leverages is yeah, preference dividend I have to discuss. Okay, just 1 minute. There is one small point in preference dividend that I want to discuss. 1 minute. Okay, 1 minute. See, 90% of the times preference dividend will not come in leverages chapter. Okay, 10% of the time preference dividend will come in leverages chapter. Okay, in that place what you have to do is what we are going to discuss now. Now when it comes to preference dividend, then two fixed cost will come in financial leverage. What are two fixed cost? One is interest and another one is fixed dividend, preference dividend. Just give me 1 moment. Actually this is not responding. Okay, now see, the formula for operating leverage is what? Contribution divided by, okay, it is contribution minus fixed cost. You can write like this also. Okay, contribution minus fixed cost. It is always numerator divided by numerator minus fixed cost. Financial leverage is equal to EBIT divided by, okay, EBIT minus interest. Okay, EBIT minus interest. Combined leverage is equal to contribution divided by contribution minus fixed cost minus interest. Okay, now if there is no preference dividend, this is the formula. If preference dividend is coming, okay, if preference dividend is coming now, two fixed cost will come in financial leverage. What is the second fixed cost? Preference dividend, and here also preference dividend will come. Okay, but this all are before tax numbers. Preference tax is alone after tax number. Okay, after tax number. So you have to convert this into before tax number. Okay, so what you have to do, you have to just do 1 minus t here. You just have to divide 1 minus t. Okay, because always before tax number is equal to, after tax number is equal to before tax number into 1 minus t. So if you want to convert an after tax number to before tax number, what you have to do? Okay, after tax number divided by 1 minus t. Okay, so this is the one small adjustment that you have to make whenever preference dividend is coming. Don't miss this. Okay, don't miss this. This is one small adjustment that you have to make. Okay, EBIT divided by EBT minus preference dividend divided by 1 minus t. This will be the formula if we have preference dividend. Okay, now leverages is covered. Leverages is covered. Done. Now we'll go into capital structure. Okay, now we'll go into capital structure. In capital structure, three types of problems are possible. Okay, only three types of problems are possible. First type of problem is finding optimum capital structure. Okay, finding optimum capital structure using this EBIT, this EPS MPS analysis. Okay, EPS MPS analysis. This is the first type of problem in capital structure. Second type of problem is finding indifference point, and also one financial break even point. Okay, financial break even point. Okay, indifference point is very important here. This is very important. Okay, two types of problem. Third type of problem, what they can ask is they will ask you to find out, okay, finding value of the firm. Okay, finding value of the firm using capital structure theories. Okay, using capital structure theories. Important theories are net income approach and net operating income approach. Okay, this is the third question. Okay, usually we expect some 1 or 2 questions from capital structure. Okay, if you're lucky you will get 2 questions. If you're not lucky you will get both the time. You are lucky only. Okay, you will at least get 1 question from capital structure. Capital structure, one of the easiest chapter to complete. Okay, one of the easiest chapter to complete. Now 1 minute. Okay pa. When we talk about capital structure, what is capital structure? The structure of capital. You have equity, you have debt, you have preference share capital. So how much equity you have to give, how much debt you have to give, how much preference share you have to give, how you will take a decision. Wherever the value of the shareholder is maximum, wherever the wealth of the shareholder is maximum, only that is the best capital structure. Correct? If you ask a question, what is the best capital structure? The capital structure where wealth of the shareholder is maximum. Correct? Now, where the what is wealth of the shareholder? The market price of the share is wealth of the shareholder, or the EPS is the wealth of the shareholder. Okay. So if you have details, you will find MPS. If you don't have details, you will not find MPS. Okay, you will stop at EPS. That is what is EBIT, EPS, MPS analysis. Okay, EBIT, EPS, MPS analysis. Both EBIT, EPS, MPS analysis and indifference point, we have set of a set of table, a set of procedures. If you follow that approach, you will be able to crack the problem. Okay. 1 minute. Okay, can we take I think he's asking to take a break. Can we take a small 10-minute break? Okay, 10:30 is the time. 10:40 we will meet exactly. Okay, a small 10-minute break, just a water break. Okay, fine. Okay, sure, please have your breakfast here. No, I won't have. You have it. least if you are there. Okay, can we start? Fine. So we were in capital structure, okay? How many chapters completed? 3 chapters completed. Okay, 3 chapters completed. This is the 4th chapter, capital structure. Okay. Now, see, under capital structure, as I said, 3 types of problems can be possible. Okay. First is to design, to have an optimum, to find out the optimum capital structure. Okay, optimum capital structure using EBIT, EPS, MPS analysis. First type of problem, very important. Second one, indifference point. Okay, indifference point. It also includes one more topic, which is financial break even. Okay, financial break even point. This is also important. Actually, all the 3 are equally important, because one after the other, any question can come. Okay, there is no that this is having high probability, this is having low probability. Okay. Third one, we want to find out the value of the firm using capital structure theories. It is usually NI or NOI. Okay, it is usually NI or NOI. These are the 3 types of problems that can be asked in capital structure. Idhukku mela now questions Modigliani Miller also it is there, but very rarely asked, so we will not be covering in this marathon. Okay, optimum capital structure, EBIT, EPS, MPS, indifference point, and then value of the firm. Okay, we have value of the firm. Let us go first. First is EBIT, EPS, and MPS analysis. Whenever any question comes, determine what is the optimum capital structure. You have to know that it is a question of EBIT, EPS, MPS analysis. I will tell you the structure. Okay. Oh, sorry. Online students, are you all able to hear me?
Yes, sir.
Okay, thank you. So now it is EBIT, EPS, MPS analysis. In these type of problems, the structure is, we will be having few options. Okay, options of financing. It can be option 1, option 2, okay, option 3. Okay, we have For an example, we are having three options. Okay, this can be full equity. Okay, just an example. This can be 50% equity, 50% debt. Okay, this can be full preference shares. Anything is possible. Okay, anything is possible, any mix is possible. Suppose, and this will be given in the question. Now what we have to do, we will have EBIT. Okay, we will have EBIT. EBIT will be given in the question. Okay, will be given in the question and will be same for all. Okay, will be same for all options. Correct, same for all options. If I am receiving 1 crore rupees, I cannot say 1 crore rupees received from equity, na my EBIT will change. Okay, your EBIT will be same. Your EBIT will be same from all financing options. Now from this EBIT, what you have to do, you have to reduce interest. You have to reduce interest. What you will get? You will get earnings before taxes. Then what you have to do, you have to reduce taxes. What you will get? Okay, profit after tax. Okay, profit after tax. From this, what you have to reduce? Preference dividend. What you will reduce? Then what you will get? Earnings available to equity shareholders. You have to divide number of equity shares. Okay, what you will get? You will get something called as earnings per share. Okay, now this is what is important. From earnings per share, if you multiply P ratio, you will get market price per share. If P ratio is not given, stop the question in EPS. If P ratio is given, then find out the MPS and then you do the analysis. Okay, done. Now what is P ratio? What is P ratio? MPS divided by EPS. Very good. P ratio is equal to MPS divided by EPS. Okay, you all know constant earning. What is the formula for KE? Constant earnings, EPS by. So I can say KE is equal to 1 by PE ratio. Correct, I can say KE is equal to 1 by PE ratio. So if P ratio is given, then you multiply by P ratio. If P ratio is not given, KE is given, then find out the PV ratio and then you multiply the MPS. Okay, then find out the P ratio and then you multiply the EPS. Because if K is given, suppose K is given as 20%, what you do? You do 1 divided by 20%, find the PV ratio and then you multiply it by MPS. Okay, done. If it is 20%, now what is P ratio? P ratio is 5 times. Just do 5 times and get MPS. Done. So this is what is the usually the question for EBIT, EPS, MPS analysis. It will be very easy questions. Okay, now we will discuss some crispy points which are there. Okay, which are there in this problem, but we will usually make mistakes because that is what is exam oriented. Correct. Now what are all the points? Many times what will happen, under the old capital structure, they will be already having some loan, they will be already having some preference share capital or equity share capital. Okay, they will be already having some old loan, say at 10%, preference dividend, say they were having at 10%, equity share capital, say they were having some 1 lakh shares. Okay, now they are asking in option 1, they want to issue full equity shares and new equity shares will be 10,000. Okay, so what you have to do, under number of equity shares, you have to bifurcate into two. One will be old shares, then will be new shares. Then you have to do total number of shares and you have to divide earnings available to equity shareholders by total number of shares. Okay, this is one point. Second point, suppose if debt is there, suppose they want to have new loan of say 50 lakh rupees at 12%, they were already having some loan. So what you have to do, under interest they will be having something called as old interest and this will be new interest, because both the interest they have to pay. Correct. So old interest na, this old into old rate. Okay, and the new interest na, what is the new amount that they are taking into new rate, and from this they will get the total interest. Okay, so EBIT minus total interest. Okay, not the new interest, total interest you have to take. Done. Okay, this is what is the point. Done. I will show you one problem so you will get some clarity. Capital structure, right? 1 minute. Are you all understanding or you are having any doubt? Okay, Now if you see the capital structure, mhm, hmm, just see this question. Now this is a simple question where nothing is there. Okay, this is one simple question. What will be the advanced question? The advanced question will be already they will be having something and that will also be included. Okay, I will show that question also. See this question. Number of equity shares, existing equity shares and newly issued. So this will be the total equity shares. Okay, same thing, profit before interest and taxes. So these were the existing profit and this is the new profit. So this is the total EBIT. Okay, this will be the total EBIT. Same way interest also, two interest are there. Okay, so if they are having any old interest and new interest, and after doing all that you have to find out the EPS, and wherever the EPS is more, if you see here EPS is more, so option 2 we have to take. Correct? This is how a problem will look like. See, plan 1, plan 2, plan B, expected EBIT is given, then less interest. If you see interest here three interest are now, here two loans are there, here 3 loans are there. Why? Because here in loan they are giving a ceiling limit. Okay, till 5 lakh if you're taking na, this will be the percentage. Till 10 lakh you're taking na, this will be the percentage. Till 15 lakh you're taking na, this will be the percentage. So here since they are taking more amount, your percentage will keep on increasing. Once you read the question you will understand. Okay, see the question here. The funds can be borrowed at the rate of 10% up to 2,50,000. So up to 2,50,000 10 percentage, over and above 2,50,000 and up to 10 lakh is 15 percentage, and then over and above 10 lakh is 20 percentage. So this is nothing, something like tax slabs. Okay, something like tax slabs is what we are doing. So this can be the interest. So this is how they can complicate. Okay, more than that they cannot complicate. Okay, done. So this thing is done. Now we'll go into the next one. EBIT, EPS and MPS analysis is completed. Next, what is there? What is the next type of question possible? Indifference point. I hope you all are not bored, huh? Not bored, la? Okay. Now indifference point, if you see the questions of indifference point is the level of EBIT where EPS is same for different financing options. Okay, EPS is same for different financing options. Okay, so there EBIT will given, you will find out the EPS, whatever is the maximum EPS you will take it. Here what is happening, you have to find that level of EBIT where in all the 3 financing options that one point is same. Okay, that one point where EPS is same. Okay, so usually indifference point can be done only if you are having 2 options. If you are having 3 options, you have to find out 3 indifference point, plan 1 2, plan 2 3 and plan 1 3. Okay, so usually indifference point will be there only if there are 2 financing options. If there are 2 financing options, suppose I am having option 1 and suppose I am having option 2, if I am having 2 options, so I have to find out the EBIT level. Okay, the EBIT level I want to find out. Okay, where the EPS will be equal, So how to find out? We have 2 methods. One is logical method, another one is formula method. Which one you have to know? Both the things you know. If logical method is keep the EBIT as X. Okay, keep the EBIT as X. Then you reduce interest. Okay, then you reduce interest. Then it will be then earnings before tax will be this EBIT minus interest. Okay, this will be EBIT minus interest 2. Okay, minus interest 1 minus interest 2, and then you have to reduce taxes. Correct, you have to reduce taxes. So once you reduce taxes, you will get EBIT minus interest 1 into 1 minus T. Here it will be EBIT minus interest 2 into 1 minus T. Okay, this alone will be X. Okay, so it will be something like X minus this, then this into this, then this will be profit after taxes, then divided by number of shares. So EBIT minus interest 1 into 1 minus T, the whole divided by number of equity shares in plan 1. Here it will be EBIT minus I2 into 1 minus T divided by N2. Now if you get this, this is the number of equity shares, this is the EPS. The value where these both are equal and the value of EBIT is what is called as indifference point. Confusing or not confusing? Very. So the formula approach is nothing. This is the formula approach. EBIT minus interest 1 into 1 minus T divided by N1 is equal to EBIT minus interest 2 into 1 minus T divided by N2. If preference dividend is there, you have to do minus preference dividend. Okay, minus preference dividend. Done. Equal to this. So this will be the question. EBIT alone you have to solve. You have to solve EBIT, all the values you will have. I1 value you have, I2 value you will have, T value you will have, preference dividend value you will have, number of shares in first plan you will have, number of plan in second plan you will have. EBIT is what you have to find out. So then you will get some amount of EBIT. That amount of EBIT, suppose the amount of EBIT is 10 lakh rupees. This amount of EBIT is called as indifference point. Okay. Two types you can solve. First, you put a table in the exam, put X, then solve for X. Or second one, you directly put the formula. Okay. So you don't need to remember the formula. Okay. You don't need to remember, mug up the formula. You know the logic and then you put the formula. Okay. Try to solve it in formula approach only in examination, but you don't need to mug up the formula. Okay. Done. Okay. Let us see one problem. I just want to show you problems because these are very easy. Okay. Indifference point. Now see this question. Here you just have to find out the indifference point. This is the formula. EBIT minus I1 into 1 minus T divided by number of shares N1, N2. Here they have written E1, E2, number of equity shares. You will be having some problems in exercise questions. In exercise you will be having some problems. See this problem. Alternative 1, 6 lakh equity shares of 10 rupee each. Alternative 2, 20 lakh, so 2 lakh equity shares of 10 rupee each, and then debt of 40 lakh. Okay, so 40 lakh and 20 lakh. So here 60 lakh is completely equity. Here 60 lakh is in a mix of equity and debt. So this is the interest. Okay, so now you have to find out the indifference point between two alternatives. This is the formula. Whenever in the examination, I am telling you one presentation tip. Whenever you write the formula, you also write the full form of all the variables and the values for them. If you know the values, you write the values for them. What is the EBIT? EBIT you don't know, write EBIT. Interest charges, you just write the amount. Interest charges in alternative 1 is 0. In alternative 2 is 7,20,000. What is the tax rate? The tax rate is 40%. What are the equity shares? Here we have some 6 lakh equity shares. Here we have some 2 lakh equity shares. Write all the values and then you put the formulas and get the answer. Okay, then if you put the formula, you will get EBIT as 10,80,000. So therefore EBIT of 10,80,000, earnings per share is same for both the alternatives. Therefore this is the indifference point and put a square dabba. Done. Indifference point is done. Okay. Now let us come to financial break-even point. Financial break-even point. See, financial break-even point is nothing but the total fixed cost is what is called as financial break-even point. Okay, total fixed cost. See, if you wanted to find out break-even for costing, how you will find out? Fixed cost divided by contribution per unit, correct? Here we don't have this concept of contribution. The total fixed cost is break-even point. It means that if you are earning equal to interest, means your EPS will become 0. So financial break-even point means EBIT where EPS will become 0. Okay, where EPS will become 0. Okay, so here what is the total fixed cost? Interest plus preference dividend divided by 1 minus t. Ayyo, from where contribution will come here? Interest plus preference dividend divided by 1 minus t. Preference dividend alone, you have to do this adjustment, okay? So this is what is called the total. Here only people will make mistake, okay? If they are asking financial break-even point, na interest they will put, but preference dividend they won't put any adjustments, okay? First of all, many people don't know what is financial break-even point. Done. Financial break-even point completed. Third one. Capital structure theories. Okay, capital structure theories. Here our objective is to find out the value of the firm. Okay, here our objective is to find out value of the firm. Now I will tell you an easy method. Okay, you don't have to go very deep into capital structure theories. Okay, I will tell you only three formulas alone you have to remember. Capital structure theories will be completed. Three formulas alone you have to remember. What we are going to do is net income approach and net operating income approach. Okay, net income approach and net operating income approach. Once you remember this three formula, your entire capital structure theories is completed. Value of the firm is equal to value of equity plus value of debt. You all know this. Value of the firm is equal to value of equity plus value of debt. Whenever we are talking about capital structure theories, we always have two assumptions. First assumption is only equity and debt are sources of finance. Okay, we don't have preference dividend. This is first assumption. Second assumption is no taxes. Okay, second assumption is no taxes. If taxes comes, now things will change. Okay, so we usually have two assumptions in capital structure theories. One is equity and debt are the only two sources of finance. Second is no taxes. We have other assumptions, but for problem solving these two assumptions are important. Okay, now value of firm is equal to value of equity plus value of debt. Clear? Now value of debt is equal to interest divided by KD. Done. What is interest? Interest is the amount that we have to give to the debenture holders. KD is the cost of the debenture holders. KD is the cost of the debenture holders. So if you divide this, you will get the value of the debt. Clear? Okay. Value of equity. What is the amount which is available to equity shareholders? See, EBIT minus interest, correct? Minus interest, minus, I am telling the amount, okay, not earnings per share. What is the amount? Earnings available to equity shareholders. So it is EBIT minus interest minus taxes is equal to earnings available to minus preference dividend. We don't have any preference dividend. We don't have any taxes. So EBIT minus interest is equal to earnings available to equity shareholders, correct? So EBIT minus interest divided by what? KE is equal to value of equity. Very good. Now value of the firm. What is the amount which is available to both equity holders and shareholders? EBIT. EBIT is available to both equity and also debt holders divided by what is the cost? KO is the cost. Okay. This is one formula. Value of the firm is equal to value of equity plus value of debt. Value of debt is equal to interest by KD. Value of equity is equal to EBIT minus interest divided by KE. Value of firm is equal to EBIT divided by KO. Done. If you have any doubt, please ask. No doubts? Very good. Okay. Second thing what you have to remember is that we have two approaches. Okay, we have two approaches. Net income approach. Not required to remember the complete theory. Okay, we have net income approach and then we have net operating income approach. Okay, we have net income approach and then we have net operating income approach. One thing alone you remember, only one line alone you remember. Under net income approach, K is constant. Under net operating income approach, KO is constant. Okay, this thing alone you have to remember. Under net income approach, KE is constant. Under net operating income approach, KO is constant. Okay. Now, two types of questions are possible. First question is find out the value of the firm. Find out the value of the firm using net income approach, or find out the value of the firm using net operating income approach. How to find out the value of the firm using net income approach? You will have EBIT. Okay. You will reduce interest. Once you reduce interest, you will get earnings available to equity shareholders. Correct. You divide this earnings equity to shareholders by KE. Correct. So what you will get? Value of equity you will get. Okay. Then what you have to do? You have to add value of debt. Value of debt, you know how to calculate. Once you add value of the debt, you will find out value of the firm. This is nothing but net income approach. Under net income approach, you use the KE. Under net income approach, you use KE because KE is constant. Okay. Under net income approach, you use KE. Okay. Now, if the question is find out the find out the value of the firm using net operating income approach, what is the one thing you have to do? Value of the firm is equal to EBIT you already have divided by KO. Directly you will find out value of the firm. Yeah, but directly you will find out the value of the firm. So now you have the value of the firm. Okay, now you have value of the firm. You reduce because now you want to find out KE. So yeah, from here you also find out KO. What is KO? KO is equal to value of the EBIT divided by value of the firm. Okay, so you will find out KO. Here you use KE to find out KO. Here you will use KO to find out KE. Okay, done. That is what is the one difference in net income approach and net operating income approach. Now see, value of equity you got. Okay, value of equity, value of the firm you got. From value of the firm you reduce value of debt. What you will get? Value of equity you will get. Done. Value of equity you got. Now find out the earnings available to equity shareholders. How you will find out? EBIT you have. Okay, then minus interest. Minus interest, what you will get? Earnings available to equity shareholders you will get. Correct. So value of equity you have, earnings available to equity shareholders you have. What you can do? You can find out KE. KE is equal to what? Earnings available to equity shareholders, which is nothing but EBIT minus interest divided by value of equity. Correct. You don't have to do this also. Directly do EBIT minus interest divided by value of equity. You will get KE. Done. Any doubt in net income approach and net operating income approach? Is it simple or is it tough? First of all, it is simple. Correct. Okay, no more complications can be made here, because many students feel difficult in capital structure theories. Okay, capital structure theories only net income and net operating income is, and many people get confused what is net income approach and what is net operating income approach. So this is just one way of understanding. I have not given you any logic. This is just one way of understanding. Here KE is constant, here KO is constant. Okay, here KE is constant, here KO is constant. So here you will have KE and then you will find KO. Here you will have KO, you will find KE. Value of the firm you know how to find out. Done. Okay, pa. Capital structure theory is also completed. But here we have one more formula. Okay, what I said, 3 formulas alone you have to remember. 3 formulas alone you have to remember. 2 formulas you remembered, correct? What is the first formula? Value of the firm is equal to value of debt plus value of equity. Value of debt is equal to interest divided by KD. Okay, value of equity is equal to EBIT minus interest divided by KE. Value of the firm is equal to EBIT divided by KO. Done. And then here, this is one thing. This here KE is under net income approach, KE is constant. Under net operating income approach, KO is constant. If you want to remember a net operating O, so KO, like this you remember. Okay, net operating income approach, so KO is constant. Now, we didn't have any taxes. Suppose if tax impact is coming now, what you should do? Okay, tax impact is coming now. If tax impact is coming now, we have to bifurcate. Firm are known as levered firm and unlevered firm. Okay, unlevered firm. Levered firm, na, the firm which is having leverage. When they will have a leverage? They will have a leverage when they are having a fixed cost. When they will have a fixed cost, na, they are having interest. When they will have an interest? They will have an interest when they are having loan, correct? So levered firm, na, a firm with borrowings. I'm going very speed. Okay, firm with borrowings. Unlevered firm, na, firm without borrowings. Firm without borrowings. Done. So a firm which is having loan is called a levered firm. A firm which is not having any loan or borrowings is called an unlevered firm. Okay. Now what will happen is that if tax is not there, everything you did was correct. But if tax is coming now, for levered firm they will get an advantage, because on tax they will get a tax benefit, correct? They will get a tax benefit. So what the formula is? Value of levered firm is equal to value of unlevered firm plus debts, okay, plus total debts into tax rate. Okay, this is nothing but the tax shield on debt. You will be asking a question, sir, interest ledana sir tax shield kadeko. I am calculating the value in a present value of everything. So on the total debt amount I will get pa. Are you all understanding? On the total debt amount I will get tax benefit over the period of time, and then the present value I am doing. Correct? This is the third formula that you have to remember. Value of levered firm is equal to value of unlevered firm plus debts into T. If one company detail is given, you can find out. If two company details are given, where one is having tax impact, one is having borrowings, another one is not having any borrowings. So first you find out the value of unlevered firm. Then from that you add the debts and taxes. From that you add debt into taxes to get the value of levered firm. Done? Understanding? Yeah. Yes. Okay. Done. For your comfort, you want to see any problem? See, net income and net operating is a very, I call it very easy. It is very difficult to understand. Okay, you all know that in the regular class how we struggle to understand. Now it's very easy. Why it is? Yeah, why is it is very easy? Because we are consolidating the discussion. If you don't know that, today you get confused. Now see here, the question is, see, this is approach, arbitrage. See this question, but this is also arbitrage. 1 minute. Yeah. No sums is there for? No, we will get questions. Summa or a 3 mark 4 mark question will be given. Something they will give for value. Approach uses taxes, okay, but they will give, if tax is there, now what? See here, it is no tax world. Okay, here it is no tax world, so you just have to find out using whatever. Now see this question. Alpha and Beta Limited are identical except for capital structure. Alpha Limited has 50% debt and 50% equity. Beta Limited has 20% debt and 80% equity. So different capital structure. Borrowing rate for both the companies is 8%, no taxes. Okay, no taxes. So what they are asking, first you have to see what they are asking. If you own 2% of shares on Alpha, determine your return if the company's net operating income is 3,60,000 and overall. If KO is given, what is that you have to use? Oh, okay, net operating income approach. So directly you can find out the value of the firm. Value of the firm is equal to operating income divided by KO. 3,60,000, 18%, 20 lakhs. Done. Very simple. Okay, very simple. Then because you are holding 2% of the shares, then what is the value of the company? So value of Alpha Limited is 20 lakh rupees. then what is the market value of debt and market value of equity? So market value of debt is 50% equity, 50% debt, correct? So this will be the market value of debt and market value of equity. So from market value of equity, net operating income less interest on debt, this is the earnings available to equity shareholders. So what is the return attributable to me? It is 5,600 rupees. Okay, it is 5,600 rupees. So this is return on equity. Return on equity na earnings available to equity shareholders divided by market value of equity. This is return on equity. Something they will ask for. Everything is logical. Okay, everything is logical. See this question. Firm's overall cost of capital is 50%. So which income you will, which thing you will use? Net operating income approach. Net operating income approach, what is the formula for value of the firm? EBIT divided by KO. What is EBIT? 5 lakh. What is KO? 15%. Directly do 5 lakh divided by 15%, you will find out the value of the firm. 5 lakh divided by 15%, you will find out the value of the firm. 33,33,333. So value of the firm is completed. Now they are asking cost of equity. So what you have to do? Value of the firm divided, minus value of debt. If you do minus value of debt, what you will get? Value of equity. So EBIT minus interest divided by value of equity is equal to cost of equity. So you will get cost of equity here. See, market value of debt is 15 lakh. So 33 minus 15 is 18 lakh 33,000. So first you will find EBIT minus interest. EBIT minus interest is 3 lakh 50,000. So 3 lakh 50,000 divided by market value of equity, you will get KE. Yes, done. This thing you ignore, okay? Always try to do logically. Don't use formulas. Done. This is also logical also, but for now don't confuse yourself. Okay, now we have a third approach which is not usually asked in exam. Even if it is asked in exam, not worth asking. It is nothing but traditional approach. Okay, traditional approach. Traditional approach is nothing but, okay, traditional approach is nothing but where WACC is what optimum structure we should use, where WACC is minimum. Okay, where WACC is low or WACC is minimum. So what they will give is that different cost of debt, different cost of equity things will be given. If you see this question, just see this question. Cost of debt is given, cost of equity is given, percentage of debt on total value is given. See, percentage of debt on total value. So this is the weight of debts. Okay, this is the weight of debt. So with this you have to find the weight of equity. What is weight of equity? It is 1 minus weight of debt, correct? So this will be 1, this will be 0.9, this will be 0.8, 0.7, 0.6, 0.5, 0.4, correct? Now cost of debt into weight of debt plus cost of equity into weight of equity, you will get weighted average cost of capital. Yes or no? Yes. So once you find out the weighted average cost of capital in this way, wherever the weighted average cost of capital is minimum, if you see option number 2 is minimum, so option number 2 is the optimum capital structure. This is traditional method. Done. Okay. So now capital structure is completed. Okay, with this capital structure is completed. Now if you see except ratio, your module 1 is completed. Except ratios, your module 1 is completed. Ratio, I have nothing to explain. Ratio is completely computational chapter. So ratios we will see, problems alone you will see, we will see tomorrow. Okay, because ratios we have different types of problems that we will see tomorrow. Otherwise, if you want to see the concepts and formulas, everything is completed in module 1. Okay, everything is completed in module 1 except ratio. Done. Now we have to start with next chapter, which is investing decisions. Okay, investment decisions. See, just by spending some 3 hours, see 8:30 or 9:30, 10:30, 11:30, just by spending some 3 hours, you have completed module 1. So another some 3 or 6 hours we will complete module 2 also. Okay, another some 6 hours, sorry, not 6 hours, some 4 hours maybe. Okay, can we take a small 10-minute break? Sure. Okay, pa. So it is 11:20. We will meet at 11:30. Okay, we'll meet at 11:30. A small 10-minute break we will take. Okay, we'll take adequate breaks in between because I know you also cannot sit you also cannot sit at a stretch. I also cannot sit at a stretch. So it is beneficial for both. We'll take a small 10-minute break and then we will jump into capital budgeting. Capital budgeting is again a big and a heavy chapter. Okay.
Sir, leverage முடிச்சிட்டீங்க.
Yeah, leverage is completed.
Okay. Between I was disturbed for some. Okay.
Yeah, no issues. You missed it.
No, if you say YouTube, I will see.
Yeah, sure.
Thank you.
Okay, thank you. Definitely you will get lunch break. You want lunch also, then that also you will get. You got the lunch?
ஆன்லைன்ல இருக்கவங்க கொடுத்தா நல்லா இருக்கும் சார்.
அட்ரஸ் கொடுத்துருங்க, ஸ்விக்கி பண்றேன்.
இல்ல போய் சமைக்கிட்டு போயிட்டு தான். தேங்க்யூ.
ஓகே. Morning once again. So you all will be thinking how this time so many breaks sir is giving, huh? Lunch cake break கொடுக்க மாட்டாரு. How they're giving breaks? So many surprises you're getting. Like first, how a slow faculty has transformed itself into a super fast faculty. First. Second thing, you asked a question, sir, will we get lunch break, sir? Definitely we'll get lunch break. I can't keep you hungry, huh? Third surprise will be break and all you are giving. We cannot expect break. If you tell class is till 5, na, in our mind we know that class is till 6. Yeah, we'll leave. I'll leave you early also. And one more thing you will keep in mind, okay, break la 3 maniki da kadeko lunch break. I'll give you on time, okay, on time. Today you'll eat on time. Yes, yes.
தமிழ்ல ஒன்று சொல்லுவாங்க, செவிப்புணவு இல்லாத பொழுது சிறிது வயிற்றுக்கும் ஈயப்படும்.
Translation பண்ணுங்க.
அதாவது whenever you don't hear anything, don't have nothing to hear, then you will have something for your stomach. So now we are hearing your classes, so that itself food for us.
Oh, thank you for your kind words. Actually இதுக்கு நான் reply கொடுக்க முடியல because I'm short of words, but anyhow thank you very much. But one thing is that one reason is slowly I'm becoming old, right? So I also need some breaks. Okay, fine. Let us start with investment decisions. Okay, module 2. See, you have to learn. People are appreciating the classes. You guys don't come to classes itself. Okay. Fine. Investment decisions. Okay. So, module 1 completed. Okay. Happy, right? Okay. Now we are starting with module 2. Module 1 ratios alone is pending. That in the end I will give you some idea. Okay. So investment decisions we are starting. Investment decision will take some time because it is a good big chapter and lot of things are there to discuss. Okay. Usually student feels difficulty in solving problems in 3 chapters. Solving problem in 3 chapters. One is this investment decisions. Then they will feel difficulty in ratios. Then they will feel difficulty in working capital management. Okay, in these 3 chapters alone, usually students feel difficulty in solving problem. Understanding is very easy. They all understand everything, okay, ratios, investment decision, working capital management. The only difficulty will be to solve the problems. You all feel difficulty or no? Okay, not. I'm very happy, pa. Okay, you all are not feeling difficult, but overall statistics, these 3 chapters, student level, they feel some difficulty. Investment decisions because lot of things are there, lot of things to discuss in investment decisions. Ratios because many formulas are there, which formula where to use, what number to use where. Working capital management, again a little bit lengthy chapter, but you know, little out of a little out of the box problems are possible, but not that out of the box, but you have many small chapters you have. Okay, cash management, debtor management, creditor management, this treasury management, all these things you have, this operating cycle analysis, and then you have this MPBF, maximum permissible bank finance. Okay, all these things you have. Now with this, let us start with investment decisions. We'll start from basics. Okay, investment decision alone, because we'll pick up the speed then. So investment decision is also called as capital budgeting decisions. What is capital long term? Capital budgeting na, how we are investing, we will budget, okay, we will budget properly, okay. So it is also called as capital budgeting decisions, investment decisions. Why this is important? Theory questions are there, okay. Now why this is important, okay, why investment decisions are important, or why capital budgeting are important, why we should take capital budgeting decisions, why not blindly invest somewhere, okay, why not blindly invest somewhere. First thing is because it is a long term commitment, okay. First thing is because it is a long term commitment, or it is a long term decision that we have to take, okay. It is a long term commitment, or it is a long term decision we have to take. Second thing, it involves huge cost, okay. It involves huge initial cash outlay, okay. It involves huge initial cost, okay. That is why it is important. Huge initial cost. Second thing, third point, once you take a decision, you cannot come back. It is an irreversible decision. It is an irreversible decision, okay. It is an irreversible decision. It is a long term commitment or decision. It involves huge cost. It is an irreversible decision. Why it is irreversible decision? Because huge cost once you took, now again if you want to coming back, then there is no looking back, okay. There is no looking back. So this is one theory question that can be asked, okay. This is one theory question that can be asked. Fourth point, why it is important? Because it is risky decision, because it is risky and complex. Why it is risky? Because we are predicting the cash flows which we get in future, okay, which we get in future years, and future is always risky, correct. So it is a risky decision, it is a complex decision. How you will take the cash flow, how you will estimate the cash flow. See, in problems it is very easy to estimate a cash flow. Just imagine in a real world how you will take a decision. So risky and complex decision. Fifth point, closure involves huge cost. If at all you want to close the project now, it involves huge cost, correct. So due to these reasons, capital budgeting decisions are very important. So it should be given utmost important, okay. So the question can be, what is the purpose of capital budgeting? This can be the question, or the question can be, why capital budgeting is important, or what are the points that we should be consider while taking capital budgeting decision. All these can be questions that can be framed from this, and these, if these headlines you write and something you write in inside, you will get marks. Not something, okay, you read the textbook and see, okay, you read the textbook and see. You just have to write, it is a long term commitment decision, because for example, if you are purchasing any machinery, something, it is related to fulfillment of long term objectives, okay. Long term objectives, the decision we have to take now. The cash flows that we are going to get in future are risky, so that is, it is also a risky and complex decision. In class, what example I gave for this? Anyone remember any example I gave in class for this, to remember these points? See, I will give you two examples. See, one is professional example I will give, okay. Professional example I will give. One example is that purchasing a car. See, if you are purchasing a car, it is for a long term, okay. It is a long term decision, because once you purchase the car, you cannot say after 1 month, ayyo, this I am not getting comfortable in this car, the seat is not comfortable. You cannot go and sell. If you sell now, they will get a second hand price, correct. So first thing is, it is a long term commitment, it is a long term decision. Second thing, it involves huge cost, okay, because car is not very cheap, okay. So once you become a CA, you will be able to afford, don't worry. So it involves huge initial cost. Second, it is irreversible. Once you buy a car now, it is not irreversible, but once you change the car, it involves huge cost, okay. Closure involves huge cost. If at all you want to change your decision, it involves huge cost, or if at all you want to scrap it, it involves some cost. Fourth one is, it is risky. It is not risky or complex in case of cars, but still, okay, you can just take an example. Unprofessional example I gave is marriage decisions, okay. Marriage decisions. Marriage is a long term commitment. So marriage is a long term commitment. If you want to do marriage now, you have to have huge cost, okay. You want to call 1,000 people, or mandapam, everything you have to do, huge initial cost you have to do. Marriage is an irreversible decision. Once you marry a girl, after 1 month, sir, we are not having good bandwidth, then it is it won't work. Once a decision made is made, there is no looking back, okay. Whoever the girl is, okay, there is no looking back. Afterwards, if you find something, you sir, already she had 2 boyfriends. No worries. It irreversible decision. Fourth, risky and complex. Why risky? No one can understand a girl. Okay, for a girl side, okay, fine. Risky and it is a complex decision. Okay. Fifth one, closure involves huge cost. Okay. Once you go for closure, divorce, huge cost you have to pay. Okay. People call it alimony. Okay, I don't want to, but things at least it is registered in your mind now. Okay, fine. So why capital budgeting is important? It is a long-term commitment decision. It involves huge cost. It is irreversible. It is risky and complex, and closure involves huge cost. Okay, if they can ask in 2 marks, 3 marks, 4 marks question, you can write it. Okay, you can write it. This is one theory question which is possible. Okay, which is purpose of capital budgeting. Okay. The second question, what can be asked here is capital budgeting. Online, someone is telling it is the best example. Thank you. Okay. Now, capital budgeting process. Okay. Capital budgeting process. This is. Now, if you want to do capital budgeting, what is the process that you have to follow? Okay. That what is the process? Again, a theory question. Again, a theory question. First thing is you have to plan. First thing is you have to plan. Okay, you have to plan the money. You have to plan the money, and then where you have to invest. All this you have to plan. Second thing is you have to evaluate. Okay, if you have 4 projects in your tatta, that means you have to evaluate. Okay, what are the risk return profile of all the 4 projects? Okay. Third one, after evaluating everything, you will select. Okay. Third point is selection. First thing is you will plan. Fourth thing is all the things you will keep in one plate and then you will evaluate. Okay, you will evaluate everything. Third thing is you will select. After selecting what you do, you will invest your money. Okay, and then it is implementation or investment. Okay, it is implementation. It is implementation. After implementation, you will forget. No, you have to control. Okay, because once you take a decision, you have invested in something. You have to run the business. Correct? You have to control. Okay, and then you have to review. Just you chose the project because it was having 16% IRR. So after 1 year you have to review, right? It actually got 16% IRR or not, okay? Or whether there is any variance or not. Whatever you invested or budgeted in the first year, whether you got or not, you have to review. So this is the capital budgeting process, okay? This is the capital budgeting process. Capital budgeting process, see, if you want theory question, what you can do some kind of, this abbreviations PESICR, something word you can make and you can remember. But I think here this will not be required because it is very simple to remember. Is it simple to remember? Yeah. Only one thing is first word alone. Okay, first word alone should come into your mind. Okay, in exam what will happen if you read capital budgeting process now? Sir, one word solunga sir. That one word alone I know the answer, but one word alone I am not able to remember. If you get that one word, then you get the answer. Okay. So do something so that you get that first word. Okay, do something that you get that first word. The one way is you should have some kind of abbreviations. Okay, so you will get the first word. Okay, P, planning. Okay, then planning you will get to know planning, evaluation, selection, implementation, control, review. Done. Capital budgeting process. It is one more theory question which is possible. It is one more theory question which is possible. Okay. One minute. Okay. Now, how to take a decision? This is what is main, right? Why to take a decision we already understood. Now, how to take a decision? Okay, how to take a decision? How to take a decision? So we have some techniques of capital budgeting. Using that technique, we will take a decision. Okay, we have some techniques of capital budgeting. Yeah. These techniques are actually divided into 2. One is this traditional techniques. Another one is Western, modern techniques. Okay, traditional techniques and modern techniques. Whatever is important, that alone we will cover. Okay, under traditional techniques we have ARR, accounting rate of return. Second one, payback period. Okay, here we have, first is discounted payback. Okay, discounted payback. Then you have this NPV, this IRR, okay, or this profitability index. Profitability index. Okay, these are the different techniques of capital budgeting. Okay, these are the techniques of capital budgeting. Using these different techniques, you will be able to take some decisions. Okay. Okay. Next. Now, one by one, satak will complete all the techniques of capital budgeting. Okay. First one, accounting rate of return. One thing you always have to understand, under capital budgeting, we usually see cash flows. Okay, we will not see profits, we usually see cash flows. Okay, profit will not be used, only at one place profit will be used, which is ARR. Okay, all other cases in capital budgeting, cash flows alone will be used. Okay, only here profit will be used. Why? Profit is an accounting concept, name itself is their accounting rate of return. Okay, maybe accounting booklet place illa, they just put it in financial management. Okay, so accounting rate of return, the formula is, okay, ARR, actually the formula of ARR is average PAT divided by, okay, average investment. Okay, average investment, this is the regular formula, average PAT divided by average investment. See what will happen, how a typical question will come, they will give you values of year 1, year 2, year 3. Okay, they will give you, say, sales, then you have to do minus variable cost, you will get contribution, minus fixed cost. Okay, you will get EBIT, minus interest, you will get earnings before tax. Okay, minus taxes, you will get earnings after tax. Okay, you will get earnings after tax. So this is profit after tax. So this profit after tax, year 1, year 2, year 3 you got. Now profit after tax, year 1, profit after tax, year 2, profit after tax, year 3, you do divided by 3, you've got the average PAT. Okay, you got the average PAT. Now how to do? No, this is not earnings available to equity shareholders, this is profit after tax. Okay, so profit after taxes. Now average investment, what you have to do, investment at the beginning. Okay, investment at the beginning plus investment at the end divided by 2, that is what is average investment. Okay, so usually if you are purchasing a machinery, if machinery is your investment na, 1 lakh rupees is the machinery, after 5 years if the salvage value is 20,000 na, 1 lakh plus 20,000 divided by 2, 60,000 will become your average investment. Okay, 60,000 will become your average investment. Either it is investment at the beginning plus investment at the end plus 2, or the cost plus the salvage value divided by 2. Okay, because their salvage value is the end investment. Okay, done. So this is how a question will look like, and that is how you have to solve. So in your textbook, if you see, you will have one question where in 3 different methods ARR is calculated. Okay, in 3 different methods ARR is calculated. It is nothing, at one place they will take total profit, another place they will take total investment, and the third place they will take average investment. Whatever you do, okay, you will get the answers. So this is the typical formula for ARR. Understood? Can we move ahead? Payback period, we'll go for payback period. Payback period, see, from here we need cash flows. Okay, so first you have to know how to estimate the cash flows. Okay, how to estimate the cash flows, estimation of cash flows. Okay, you should know how to estimate the cash flows. Suppose you are having EBITDA. Okay, suppose you are having EBITDA. Okay, EBITDA. What is EBITDA? Earnings before interest, depreciation and taxes. Okay, amortization. Okay, earnings before. So suppose if you are having an EBITDA, first you will do minus depreciation. Okay, if you do minus depreciation, what you will get? EBIT. Correct? Minus interest, what you will get? EBT. Minus taxes, what you will get? Profit after tax. Okay, profit after tax you have to do. Now what you have to do to find the cash flows, you have to remove all the non-cash expenditures. Okay, non-cash expenditures. Depreciation, is it a cash expenditure, non-cash expenditure? Non-cash expenditure. So you have to add back depreciation. Okay, you have to add back depreciation. You will get the cash flows. Understood? Yes or no? You can ask a question. What nonsense you're doing? Here you're reducing depreciation. Here you're adding depreciation. What is the difference? Here you're reducing 100 rupees. Here you're adding 100 rupees. What is the difference? You can ask a question, right? But because of depreciation, we get something called as tax impact, correct? Because of depreciation, we got something called as tax impact. Because of the tax impact, we are doing that. So why we are doing like that? So we can also have another approach. You don't do anything. You don't do anything. From EBIT, directly you put minus minus interest or minus tax. Okay, minus interest. You will get some earnings before tax. Then directly you do minus tax. Okay, and then plus, okay, on EBITDA only, on EBITDA, EBITDA, first you do minus taxes, first you do minus interest, then you do minus taxes. Okay, then you will get some balance, you will get. Okay, then you add tax shield on depreciation. Okay, tax shield on depreciation, which is nothing but depreciation into tax rate. Are you all get? Depreciation into tax rate, not depreciation into 1 minus t. Depreciation, which is the tax shield on depreciation. On the depreciation, you are saving some taxes. Okay, so that saving is an inflow for you, correct? Then you will get the cash flows. Both ways answer is same. Okay, both ways answer is same. Okay, see here what is happening is that normal tax you are reducing, depreciation into tax also you are reducing. Okay, normal tax you are reducing, depreciation on taxes also you are reducing, correct? You reduce depreciation, which is 1 minus t, that on taxes also you are reducing. So this is becoming PAT. So that is the reason what you are doing, you are add back depreciation on taxes. Okay, but we have two approaches. This approach, if you want, you can follow. This is the logical approach. This is the logical approach. Okay, in textbook at few places they have used this approach, few places they have used this approach. You follow whatever approach you want. My work is to tell you that there are two approaches. Okay, first thing is, first reduce the depreciation, then add back the depreciation. Second thing is, don't do anything, you directly add the tax shield on depreciation. Okay, so this minus plus impact is gone and directly this tax amount is added here. Okay, you want me to show through numbers, the answer will come same? No, right? Done. So with this, you would have estimated the cash flow. We have other adjustments also in cash flow that we will discuss in the later stage. Are you all comfortable with the revision, right? Okay. Because if you are spending your precious time 1 month before the exam, not even 1 month, 15 days before the examination, if you are spending with me now, it should be worth for you. If it is not worth now, it is my mistake. Okay, so if you feel it is worth, then I'm doing a great job. If you feel no sir, then okay pa, you have to then study at home only. Because my only intention was to accelerate your preparations, because every student is different. Few student will be studying nicely, okay, will student they will they are disciplined. Few students are like me, if someone push only then they will study, okay. So this is just a push for those students. Okay, worth it, thank you. So online students Vasundhara, Amarjeet, Vijay Raghavan, Priya, are you all with me? Are you all understanding? You can unmute yourself. We can just interact.
Sir.
Yes,
Yes,
yes.
sir.
Okay, okay,
Yes, sir.
okay, okay. Very good.
Sir, instead of buying fruit and making juice, you are giving juice. So it is definitely better than we studying.
Yes, yes, yes. I'm just consolidating the discussion and giving it to you. So uh, that is actually very good.
If
In
you
the
what we will do, we will just go through the problems only.
yeah,
If you know the concept, we can confidently we can attack the problems.
correct, correct. See, both is required. Okay, both is required. Understanding of concept is also required. Solving the problem is also required.
Tomorrow also we will be with you only.
Yeah, 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 yeah. Sure. Okay. You 1 minute. More than me, this OneNote is hanging. Pa. He is not able to handle this bulky subject, I guess. Yeah. Okay, pa. Now, ARR completed. Now we'll go into payback period. Cash flows are used, okay. From now only cash flows will be used. No one should talk about profit to me, okay. Profit you remember only when it comes to November 2. Accounts paper on November 2, okay. So payback period. Tick tock counting only 15 days, huh. I become very happy, you know, to scare students. Fine, payback period. Actually, I should keep a countdown here. It should just gets reduced number of hours. If there are some 500 hours now, okay, now 499 hours, 498 hours. Some countdown should be there. Okay, fine. Payback period. What is payback period? What is payback period? Okay. It is a period. Okay, what is payback period? Payback period is similar to break even. See, when you were doing break even in costing, what is break even? The sale unit at which the profit was 0. So at which you are recovering the fixed cost. That is what is break even, correct? So here also whatever you are investing, when are you getting back? You have invested 1 lakh rupees now, in what time? So this is break even in period, okay. In how much time? So that is break even in units. This is similar to break even in period, okay. Just to give you a visualization, if you are investing 1 lakh rupees, within what time you are able to recover that 1 lakh rupees is what is payback period, correct. So it is a period within which, okay, within which the investment is recovered, okay. It is a period within which the investment is recovered. It is a payback period. How to calculate payback period? Okay, we have two types of cash flows. If we have annuity cash flows and different uneven cash flows, okay, uneven cash flows. Okay, I don't want to go very conceptually. First I will give you an example, okay. Suppose we have year end cash flow. I have invested 1 lakh rupees, okay, 5 years, 30,000. Okay, not 1 lakh, 90,000, okay. 30,000, 30,000, 30,000, 30,000, 30,000. This is the cash flow. Okay, this is the cash flow. If someone is asking you, in how many years I am able to recover my 90,000, what will be your answer? So what you will tell? I recovered 30,000 in first year, sir. Second year I got another 30,000, so now I have 60,000. Third year I got another 30,000, so I got my 90,000 back. Now whatever I'm getting in fourth and fifth year is my profit over and above my investment. Okay, over and above my investment. So this 3 years is what is called as payback period. Okay, this 3 years is what is called as payback period. How to calculate this? If all the cash flows are same, we have a shortcut formula. We have a shortcut formula. It is nothing but investment amount. Okay, investment amount divided by annual cash flows. Okay, divided by annuity cash flows or annual cash flows. Okay, if the cash flows are same, alone you can use this formula. Okay, if the cash flows are not same, how to use? That is the logical way. Okay, that is the logical way. Year 1, 2, 3, 4, 5, cash flows 30,000, 30,000, 30,000, 30,000, and then 30,000. Remember this table. Whenever any payback period come, you have to use this table. Year, cash flows, cumulative cash flows. Okay, cumulative cash flows. First it will be 30, second it will be 60, this it will be 90, this it will be 1,20,000, this will be 1,50,000. Okay, if you don't know how to calculate cumulative cash flow, please sit in foundation class. Cumulative cash flows. Okay, cumulative cash flows. Next one, after finding cumulative cash flows, you should see when are you recovering this 90,000. So if you see this 90,000 I have recovered here, this 90,000 I have recovered here, so third year is my answer. Third year is my answer. But just for an example, what if my investment is 1 lakh rupees? Okay, what if my investment is 1 lakh rupees? Now, which means 3 years I didn't recover. 3 years I recovered only 90,000. Fourth year I am recovering 1,20,000. So I know that it is somewhere in between 3 and 4 years, correct? Somewhere in between third and fourth year I recovered my money. It can be 3 years, 1 month, 3 years, 2 months, 3 years, 3 months. How we have to calculate now? How to calculate that is what I'm going to tell you now. You are understanding the concept. So 1 lakh rupees is my investment amount. 3 years I've recovered only 90,000. Fourth year I recovered 1,20,000, but my investment is 1 lakh rupees. So it is somewhere between 3 and 4. Now how to calculate that? First is 3 is confirmed part. 3 is confirmed. Okay, 3 is the full period. Now what is the fractional period is what I want to calculate. Now what is the fractional period? What is the fractional period? What is the additional investment that I want? What is the additional investment that I want? 10,000. 90,000 I already recovered. What is the additional recovery that I want? 10,000 rupees is my additional recovery. This is nothing but 1 lakh minus 90,000. Okay, if I want to formulate it, not IRR formula, sim. Yeah, this is also interpolation. That is interpolation of two variables. This is interpolation of one variable. If you want to talk it conceptually, but let's not go very deep. This is 3 plus 10,000. Okay, see what we are doing. We are just interpolating between 3 and 4. We are just interpolating between 3 and 4. So 10,000 is the additional amount that I require. Okay. Now if 10,000 is the additional amount I require, what that I earned? So out of 30,000, 10,000 is what I required. Okay. So it is 1 by 3. Okay. So 3 plus 0.33. So it is 3.33 years. Okay. 3.33 years. But conceptually we cannot write year in this. So you have to write it in months. Okay. We cannot write in fractions. So but in institute many times 3.33 years are is given. So you cannot question the institute, but you can write 3.33 years or 0.33 you just do into 12. Okay. You will get 4 months. Okay. So write 3 years, 4 months. Clear?
So screen not visible, sir. That 4 months and all.
Not.
Border like.
No, my handwriting is bad. Can you see my circle?
3 years, 4 அப்புறம் months எழுதிருக்கீங்கல்ல அது தெரியல.
Okay.
லெஃப்ட் வரணும் screen.
Okay, sorry. Yeah. Okay. So 3 plus 0.33, 3.33 years. How to calculate in months? This fractional amount you do into 12. Once you do fractional amount into 12, you will get in months. Now will you ask a question why we have to do into 12? Converting into, if you don't know, sit in 6th standard class. Okay, fine. 3.33, this is hanged again, 1 minute. Will this hang in other classes too, or only in my class it is happening? Okay. But mostly it happen only in my class. I don't understand, why destiny is for me only. This is also one such mystery no one can answer. Whenever I take a full day class, always it rains. Pa. Maybe it is a blessing also. God is giving a blessing. Tofik is taking a full-time class. Take some blessings. Or it can be, that also. Okay, no one should come to his class. I will put rain. Anything we can interpret. Okay, anything we can interpret. So online students would be thinking that I'm eating some gutka or pan masala. Nothing. I'm just eating mouth freshener. Okay, just a clarity I'm giving you. $10,000 into 12 divided by 30,000. That is also correct. If you are getting the answer 4 months, it is correct. Okay. Payback period completed. Payback period completed. Now, let us go into traditional techniques we completed. Now we'll go into Western techniques, modern techniques. Okay. Many people, whenever I say traditional, opposite is always Western. So modern techniques. Discounted payback period. Okay, discounted payback period. Here and there I will discuss some important, crispy points that you take note of it, because that will be helpful in examinations. Okay, here and there I will discuss that. Now discounted payback period, because here we have many, this cookie points here. Now discounted payback period is nothing. Same thing. Here cash flow. Okay, 1, 2, 3, 4 and 5. 30,000, 30,000, 30,000, 30,000 and 30,000. Next, what we have to do? We have to do cumulative cash flow. When I was doing cumulative cash flow, one person slapped me. How you can add monkeys and donkeys? He asked me, how you can add monkeys and donkeys? This 30,000 cannot be added with 30,000. Sir, you only taught me in first class, correct? Monkeys and donkeys cannot be added, correct? Monkey should be married with a monkey, donkey should be married with a donkey, human should be, so they cannot, interchange and do, okay? So first year cash flow and second year cash flow cannot be added together. So what we have to do? We have to discount this. You have to bring all this in zeroth value, and then you do cumulative cash flow, and then you do payback. So this is what is called as discounted payback period. Okay, discounted payback period. So what we have to do? We have to do present value factor. You all know how to calculate discounted cash flow rate. Present value factor, say at the rate of 10%. Once you do all this, you will get something called as discounted cash flow, and this is cumulative discounted cash flow. based on this cumulative discounted cash flow, you should see which 2 years. You should see which 2 years is there, and only based on this data you have to calculate. One more mistake that many people do is that they will divide it by this number. The difference of this number, they will divide it by this number. It's not, because there we divided by 30,000, correct? Here we have to divide it by this discounted cash flow number. Okay, so this is the table that we have to consider: discounted cash flow, cumulative discounted cash flow, and then we have to see where this 1 lakh is touching, and if it is coming in between, you have to interpolate it between those two numbers, and then you have to find out the discounted payback period. Yes, done? Comfortable with discounted payback? No doubts, correct? Okay, yeah, no doubts. Okay, now discounted payback is completed. One more thing, what is this 1 lakh? Cash outflow or inflow? Cash outflow. These are cash inflows. Okay, these are cash inflows. So if I'm taking discount, the total of this is discounted cash very good, discounted cash inflow. Okay, discounted cash inflow. Now next concept, net present value, NPV. Very important. In the regular class I took a lot of time explaining in net present value. Don't worry, here I will just write one sentence. Okay, discounted cash inflow minus discounted cash outflow is what is called as NPV. Simple formula. Yes or no? Done? Minus investment also. See, what is investment? It is nothing but year 0. Year 0 is the investment. Year 0, it will be 1 only. 1 lakh, what is the present value factor? 1. So what is the discounted cash outflow? It is 1. At some places there can be 2 outflows. 1 outflow in year 0, 1 outflow in year 1. So that is the reason I am writing discounted cash inflow minus discounted cash outflow, because outflow can happen anytime. Okay, so discounted cash inflow minus discounted cash outflow, or you can also write cost of investment. Okay, if only year 0 na, cost of investment. Okay, year 0 cost of investment. Done? Or you want some explanation? No explanation needed, right? Okay. Sir, you will start again, sir, if you start now. NPV, discounted cash inflow minus discounted cash outflow. It is nothing but after having, after taking out all the cost, what is the amount which is remaining with me is what is called as net present value. Okay, net present value is nothing but if I'm having total amount of cash inflows, discounted cash inflows, if I'm taking out discounted cash outflow, I will get net present value. It is nothing but discounting means removing the cost, correct? From the total inflow, if I got this inflow, the 30,000 into 5, this 1,50,000 inflow I got, right? If I discount that, maybe the value is 1,20,000. Okay, so that 30,000 we removed, that 30,000 is compensating to the cost. Discounting rate is, what is discounting rate? Cost of capital is actually the discounting rate. Okay, so what I'm doing, I'm removing that cost. So 30,000 is the cost, then 1,20,000 I will get. So 1,20,000 is the discounting cash inflow, 1 lakh is the discounted cash outflow. What is the amount which is remaining is 20,000, which is nothing called as net present value. Explanation given, okay, for someone who wants to get the explanation also. So net present value is nothing but discounted cash inflow minus discounted cash outflow. Always remember, whenever net present value problem come, you can draw this table. Here, cash flow, present value factor, say it is at the rate 10%, then discounted cash flow. Here, see, usually there are 2 types of doing problem. One, what institute does is they does 1, 2, 3, 4, 5. They add everything, write discounted cash inflow, then minus cost of investment, and they do the net present value. what I used to do it, I write year 0, 1, 2, 3, 4, 5 because I find this more conceptually logical. Okay, then my cash flow will be I invested 1,50,000 rupees, sorry 1 lakh rupees I invested, then I got 30,000, 30,000, 30,000, 30,000 and 30,000. Here I will put 1, see here I will put 1, so I will get this as 1 lakhs. Okay, then this will be say 0.909 and somewhat everything, and then we will get the amount as 30,000, 20,000. Okay, 20,000 as net present value if my total discounted cash outflow is 1 lakh 1,20,000. Okay, are you all understanding? See, 1,50,000 was my total cash flow. I discounted and I removed 30,000. Just giving an explanation. Okay, if I'm removing 30,000, that 30,000 was belonging to cost, because discounting rate is nothing but the cost of capital. In capital budgeting decision, discounting rate is the cost of capital. If I remove 30,000 cost, I am having net present cash flow of 1,20,000. So out of 1,20,000, 1 lakh was my investment, so 20,000 is my net present value. Okay, 20,000 is my net present value. Done. Okay. See, again it hanged. Okay, so net present value is we completed. Next one, profitability index. Okay, next one is profitability index. Profitability index, what is profitability index? Discounted cash inflow divided by discounted cash outflow. Okay, NPV is what we are giving in absolute values. Profitability index is what we are giving in ratios. No difference between NPV and profitability analysis, both go in same direction. NPV is an absolute number and profitability index is a ratio. Okay, just 1 minute. See, I am fast, but this one note is slow. Other faculties don't write too much. That is the reason it don't hang. But they also write a lot. Then why it is happening with me only? Any reasons?
Secure bandwidth, sir.
Secured bandwidth.
Check your bandwidth, internet bandwidth.
No, it always happens. Whenever my class there, it always happens in this.
I think it is giving chota arrested to you.
Yeah, some mythological reason. Or you guys are giving some sabama? No, right? Okay, pa. So the next one is profitability index. Profitability index is nothing but discounted cash inflow divided by discounted cash outflow. Okay, so in this example, what is my discounted cash inflow? 1,20,000. What is my discounted cash outflow? 1 lakh rupees. So what will be my profitability index? 1.2 per 1.2. Okay, so profitability index. Okay, profitability index formula is discounted cash inflow divided by discounted cash outflow, which is nothing but 1,20,000 divided by 1 lakh is equal to 1.2. Okay, this is profitability index. Done. Net present value and profitability index completed. Just knowing formula is enough. Who will take the decision? See, actually one thing you have to remember, the one person who does the work, for him salary will be less. The person who takes the decision, the person who reviews his work, for him salary will be more. So which is more valuable? Taking decision is more valuable. You know, review, decision, monitor, control, all these are important. Doing the work anyone can do. Okay, you are now in the student stage, so you will do all the work. So once you become a chartered accountant and once you become some senior person, you will not do work. You will review, you will monitor, you will control. You should have good people skills. So I don't want to give any gyan here. Net present value, profitability index completed. Now what we have to take? We have to take some decision. So let me give a decision rule. Okay, let me give a decision rule. If it is a single project, NPV, if it is positive is better. Okay, profitability index more than 1 is better. Okay, now, okay sir, it is good. I am having two projects. Both are positive. What I should do? Both I should accept. Okay. So if you have two projects and if you want to choose one, if it is a mutually exclusive decision, you have to choose one and you have to reject one. Okay, then more is better. Okay, more is better. And here, I mean higher is better. More is not a good word. Higher is better. PI, higher is better. Same way, if it is a payback period, is it higher or better? The low the better. Okay, the sooner the better. Good word. Sooner the better. But since we are financial management student, we want numbers, so lower the better. Okay, lower the better. Higher alone we have signs. Lower we have sign. For sooner we don't have any sign. Okay, lower the better. Okay, payback period, if one is having 4 years 5 months, another one is having 4 years 11 months, don't tell 4 years 11 months is more, let's go there. 4 years 5 months is good. Okay, so if it is a payback period, how to take a decision? The lower the better. If it is NPV, higher the better. If it is profitability index, higher the better. Okay, so this is the decision rule. Okay pa. Now coming into internal rate of return. Internal rate of return, IRR. Okay, IRR. People feel this is difficult. IRR, is it difficult? No, not difficult. You said no like this. Is it difficult? It's moderate. Okay. See, IRR, I'll give you 3 steps. Okay, this 3 steps alone is IRR. First thing is okay, find 2 rates. Okay, with 2 rates, find 2 NPVs. Find 2 NPV. One is positive NPV and other one should be, another is negative NPV. Okay, negative NPV. One is positive NPV and second one should be negative NPV. Then second step is interpolate and find IRR. Avladha, completed. See how simple is this. First 2 rates, find 2 NPV. One should be positive NPV, one should be negative NPV. Second one, from both this NPV, just interpolate and find the IRR. Sir, it is easier said than done, sir. How to find the 2 rates? Then we have to calculate 2 NPV and then we have to interpolate. Okay, let me go more. Okay, now you all will ask a question, sir, what rate we should apply, sir? See, I've already told you 90% of the time rates will be given in the question. 90% of the time rates will be given in the question. But sometimes directly they will give. Sometimes what they will give, present value factors alone you will give. Okay, present value factor. Ayo, 1 minute. Okay, pa. See, present value factor for 12%, present value factor for 14% will be given. So you know that 12% and 14% alone you have to use. Okay, and how many digit which is given in the paper, that digit alone you have to use. Okay, don't use your calculator and put 4 digits. If 2 digit is given in the question paper, take 2 digits. If 3 digit is given in the question paper, take 3 digits. If 4 digit is given in the question paper, take 4 digits. Usually question paper gives 3 digit. Okay, so use the values which are given in question paper. Don't use your mind, even though you know to, use your mind, don't use a calculator. Even though you know to calculate the present value factor, don't calculate with calculator if institute has given the value. Okay, if institute has given the value, take that value. Okay, fine. Now how to guess the rates? Okay, first you have to guess 2 rates, correct? First you have to guess 2 rates. So how to guess the rate? 90% of the time institute will give in question. Okay, 90% of the time institute will give in question. What to do in 10%? That is why we are here. What to do in 10% cases? See, in few cases, what will do, institute will give 6 rates for 12% also, he will give 14% also, he will give 15% also, he will give 16% also, he will give. So what you have to do? Usually use the center rate. Okay, why to use the center rate? First see 14%. If 14% is positive, use 15%, this will be negative. This will be negative. Okay, or for a better thing, first use 15%. If 15% is negative, use 14%. If 15% is positive, then definitely 16 will be negative. Okay, so better thing is first use 15% rate. See, this is the tactic. Otherwise what people will do, some people who don't know anything, na, first 12% they will do, positive it will come. 14% they will again calculate NPV, positive it will come. 15% again they will calculate, positive it will come. Then definitely 16% is negative till the time exam paper will be completed. Okay, so always use tricks and tactics. Okay, what is the trick? Whenever 4 rate is given, 2 rate is given, na, those 2 rates are the guess rates. 4 rate is given, na, take the second last rate. See, if it is negative, then definitely this will be positive. Okay, if it is negative, then definitely this will be positive. If this is positive, then definitely this is negative. Are you all understanding what I am trying to tell? Huh? Online students, are you all understanding what I am trying to tell?
Yes, sir.
Very good.
Why 12% and 16%?
Why institute is giving 12 and 16?
No, why not? Why shouldn't we take these two?
Okay, why you shouldn't take 12% and 16%? See, how much ever far the rates are, that much inaccurate the answer will be. The accuracy depends on how closer we get, because we are doing interpolation, correct? Interpolation is average. So the closer the number, the accurate will be the answer mathematically. Okay, because this is nothing but average. Average of 1 and 10 is 1 plus 11, 5.5. But average of the 2 more closer number will be, more accurate. Okay, so this is nothing but interpolating. Interpolating means averaging out. So the closer, the better. Okay, pa. So how to find out the rate, I told you. Now, what if question is not giving any rate itself? What if question is not giving any rate? Very rare chances. Okay, somewhere some rate will be given. Then you just first use some amount, some rate you use it. Okay, some rate you use it, and then the difference between your 2 rates should not be 4 to 5%. Okay, that alone you take care. The difference between 2 rates should not be 4 to 5%. Don't put 1% rate I will take, second 99% rate I will take. Definitely one is positive, one is negative. Okay, don't do like this. Okay, your IRR will be somewhere else. Okay, always take closer number. Your difference between 2 should not be more than 4 or 5%. Okay, but don't worry, these are very rare circumstances. Usually in the exam paper it will be given. For that you have to open and see the previous year papers. If you see the previous year papers, you will get to know how questions are framed. Okay, so now you have 2 rates. Okay, one will be a lower rate and one will be a higher rate. Okay, you have 2 rates. You will have 2 NPVs, correct? You will have 2 NPVs. One will be positive, one will be negative. So lower rate will have a positive NPV, higher rate will have a negative NPV. You all know this, right? Or you want me to explain why? You all know this, okay? So you have two NPVs, one will be a positive NPV, one will be a negative NPV, okay? Now let me just take one example. I'll just take the numbers, okay? I won't calculate the problem, I'll just take the numbers. So here the NPV at lower rate is 2280 and NPV at higher rate is 4190 in one of the problem, where NPV at lower rate is 10 percentage and this is 12 percentage, okay? Answer also I am writing, answer is 10.704 percentage. This is what we have to calculate, okay? Now these are the values. You will have the cash flows. Using all those cash flows, you will have these values, okay? You will have these values. You have two rates na, two NPV you will calculate. I'll also give you the table how you should calculate, You will have year, you will have cash flows, year 1, 2, okay, 0, 1, 2, 3. Then you will have cash flows, say 1 lakh is the cash flow, okay? 40,000, 40,000, 40,000. Do present value factor at the rate 10 percentage. This is the present value factor, discounted cash flow at the rate 10 percentage, okay? This total will be NPV at the rate 10 percentage, okay? Then do present value factor at the rate 12 percentage. This will be the present value factors. Discounting cash flow at the rate 12 percentage. This will be the discounted cash flows. Then this will be NPV at the rate 12 percentage. Done. So NPV at the rate 10 percentage is 2280. You will get NPV at the rate 12 percentage is 4190. Please bear my handwriting, okay? You can hear me, right? Yeah. So NPV at the rate 10 percentage will be 2280. NPV at the rate 12 percentage will be negative 4190. Okay. This is one typical problem, a problem from illustration 7. Okay. Now what you have to do, you have to find the IRR. How will you find the IRR? We have two approaches, pa. One is formula approach, second one is logical approach. Use whatever is comfortable to you, okay? Use whatever is comfortable to you. First, I will tell the formula approach. What is the formula? Lower rate plus I think my class is very weak for formulas. You got the answer without using the formula, okay? See, one good thing is you can calculate everything in calculator only, but in exam you have to write, okay? In exam you have to write. You all have become matured, but now you all should use some strategy to gain marks, okay? Okay, I'll tell you the formula, okay? I'll tell you the formula. The formula is lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate into higher rate minus lower rate. So this is the formula, okay? I was also scared when first time I was reading this formula, but if you know, you know, okay? So what is lower rate here? 10 percentage. What is NPV at lower rate here? 2280. What is NPV at lower rate? 2280 minus what is NPV at higher rate? 4190. Okay, minus 4190. What is higher rate? 12 percentage. What is lower rate? 10 percentage. So what you have to do? 2280 plus, okay, minus will become plus 4190. You have any doubt? Minus will become plus or not? You have doubt? You don't have doubt. If you have doubt, you have to sit in 4th standard. So 6470, then 2280 divided by 6470, you will get 0.3523, then into 12 percentage minus 10 percentage, you will get 2 plus 10. Yeah, so you will get the answer 10.70479 something, okay? So this is using formula. This is using formula 10.70479. Okay, so that is what is given, 10.704. Now logical approach. Again it hanged pa. Logical approach. Okay. Okay. Now under logical approach, what you have to do? You have to visualize. Okay, just draw a line. You have to just 1 minute. So what you have to do? You have to visualize. You have to visualize a line. Okay. So this is negative NPV. This is positive NPV. Just 1 minute. You can use any method. If you are able to do the formula, it is good. If you are able to understand logically, do logically, then write the formula and then do. Okay, not an issue. You can do this in working note also. If you do in formula, na, examiner will become happy. If you do logical, na, I will become happy. But me becoming happy is of no use. Examiner, you should make examiner happy. Okay. Depends on the examiner. If the examiner is a good person like me, he will give marks.
From 2,280 it has come to negative 4,190. So for the difference of 6,470, 2%. So for the difference of 2,280, how much percent? So cross multiplication பண்ணி போட்டு அந்த மாதிரி explain பண்ணாக்க whether they will give mark without writing formula.
Yeah, they will give marks. They will give marks, but you know it will be time consuming for you to explain everything, right?
Okay.
It is better to do. See, it is better what they are expecting. Okay, it is better to do what they are expecting. You do this. You draw this line also. No worries. You draw this line. You do this, and then you write. Okay. Even if you don't write the formula, if you write the numbers and give the answer, that is correct. Okay, that is correct. They will give marks. They should give marks directly if you write the numbers and do. So what is negative NPV minus 1 minute? Okay.
4,190.
Yeah, 4190, and this is 2280. Okay, this is for 12% rate, this is for 10% rate, correct? Now what is the logical way of understanding is that what I want is I want my NPV to be 0. I want my NPV to be 0. So what will be the rate? I know that the rate is somewhere between 10 and 12. Okay, that is where it can become 0. Okay, that is where it can become 0. You know, one time one student asked me one doubt. If we are finding 2 NPV, why one should be negative and one should be positive? 2 NPV both are positive, I can do interpolate, right? How you can interpolate? If you are actually finding, you know, 9% and this is something 3000, how you can interpolate between these two? You will not find NPV 0 here, correct? The percentage, if in between 9 and 10, then it should be 0. If it is 0, then definitely it should be more than 10. Understanding? I didn't expect this doubt from you, but okay, it happens. Okay, fine. So 12% and 10%. Now see, don't confuse much. Okay, don't confuse much. What I did is that I just wrote the numbers here. For 12%, my NPV, my negative NPV 4190, positive it is becoming 2180. I want my NPV to be 0 because IRR is equal to the rate at which NPV is equal to 0. That is what is IRR. Or you can also say the rate at which discounted cash inflows is equal to discounted cash outflows. Okay, Now what you have to do is that you have to see there is a 2% increase in rate. So 2% increase in rate, how much my NPV has decreased? 2% increase in rate, how much my NPV has decreased? 6470 my NPV has decreased, correct? I am increasing my rate by 2%. My NPV has reduced by 6490. So how much rate I should increase? How much rate I should increase to reduce my NPV? So I want my NPV to be 0. So how much I should reduce? So 2280 if I reduce, then my NPV will become 0, correct? So now the question is, if by increasing rate 2%, my NPV is reducing by 6470, I want my NPV to be reduced to 2280, only then my NPV will become 0. So with this, how much increase in rate I should do? So you just have to cross multiplication. What is the amount that you are getting? 0.704. Okay, 0.704. So what is telling? You increase it by 0.704, which means 10% was the rate. So 10% length you increase to 0.704. The answer is 10.704. Is it matching? Yeah, it is matching. Okay, 10.704 is the percentage. This is the logical way of presenting the answer. Okay, even if you present the answer in this way, there is no problem. Just write here 2280 into 2% divided by 6470, 10% plus. Okay, just write this equal to 10.704%. Even if you write this, you will get the answer. Okay, done. Which is easy, logical formula. Everything is easy only. See, this is also what rate? Lower rate plus what is 2280? NPV at lower rate. What is 6470? It is nothing but NPV at lower rate minus NPV at higher rate, correct? 6470 is NPV at lower rate minus NPV at higher rate, correct? So NPV at lower rate minus NPV at higher rate. What is 2%? Higher rate minus lower rate. Okay, that is how formula itself came. Okay, so anything, are you comfortable with IRR now? IRR comfortable? Online students, IRR comfortable?
Yes, sir.
Very good, very good. What about others? Vasundhara, Amarjit, Priya, others, are you all with me? Okay, okay, okay.
Yes, sir.
Okay, are you all enjoying, right? Are you all enjoying, right?
Definitely.
Yes, sir.
Yeah, okay, okay, very good. Next one. IRR is completed. IRR is completed. Now, what is the next one? See, there is one more concept called as modified IRR. Okay, modified IRR. Modified IRR is nothing but it just changes the IRR a bit. See, what is happening is that in IRR we have an assumption. The assumption of IRR is that, okay, the assumption of IRR is that the intermediary cash flows are reinvestment at IRR rate. Okay, the assumption of IRR. So if I'm having the cash flow here 1, 2, 3, 30,000, 30,000, 30,000, what is happening is that I'm discounting this from here, correct? So this 30,000 is discounted in the IRR rate. This is also reinvested at IRR rate. This is also reinvested in IRR rate. So it is always assuming that whatever is my cash flows is getting reinvestment, is getting the assumptions of IRR is that my intermediary cash flows, my intermediary explanation is not required. Summa I'm giving. Actually, I don't take MIRR in fast track. Okay, assumptions of IRR is that intermediary cash flows are reinvested at IRR rate, but actually it is wrong because reinvestment rate can be different, correct? If you're taking a loan at 15%, is not that you can even deposit the amount at 15%, correct? If that is the amount, then banks cannot earn, correct? Reinvestment rate is always different from the it's the borrowing rate. Okay, so if I'm finding the IRR, if my IRR is 50%, if my IRR is 50%, na, it is assuming that my intermediary cash flows are earning 50%. Okay, but this is not possible. Okay, my intermediary cash flows should be reinvested at reinvestment rate. So here you will have two rates. Okay, here you will have two rates. One will be the reinvestment rate. Okay, one will be the reinvestment rate, another will be the IRR rate. So what you have to do to find out the MIRR is nothing but, okay, to find out MIRR, what you are doing is, suppose 0th year you have invested 1 lakh rupees, okay, 0th year you have invested 1 lakh rupees, first year, second year, third year, 30,000, 30,000, 30,000. Clear? Now what you are doing is, this 30,000 you compound it and bring it to third value, okay, future value you do, which means 30,000 into 1 plus I to the power 2. First year you bring it into third year na, 30,000, I will write here, year 0 I have invested 1 lakh rupees, okay, year 1, 2, 3, let me put 40,000, only then profit will come, okay, 40,000, 40,000. Now what will happen, what I am doing, MIRR na, I will find the reinvestment amount, okay, I will find the future amount. So the future value I will do, this 40,000 I will bring to third value. So what I should do, 40,000 into 1 point, suppose my reinvestment rate is 10%, 1.1 to the power 2. This 40,000 I have to bring to third year. So first year, second year, I will compound it to third year. From first year, I am compounding this value to third year. Then I will add all the third year, future year values. It is such that I gave an example in class, right? Arvind just came, he invested 1 lakh rupees, he gone to foreign, and after 3 years he came, he just wants what is the amount in my bank account, okay, that is what he wants. So what is happening is that the intermediary cash flows that you are getting, right, 40,000, 40,000 and 40,000, if this actually is not reinvestment at IRR rate, this is reinvestment at reinvested rate. So this is the reinvestment rate, 40,000 into 1.1, 40,000 you received, right, in the first year. You keeping in bank it at 10% and you will mature it at third year. So how many years compounding you will do? 2 years. Clarity irukala. Okay. Now 40,000 into 1.1, 1 year compounding. 40,000 second year, next year you want to mature, na, it will be 44,000, correct? Now this will be 40,000 into 1 only, okay? Now if you add this value, this will be the third year cash flow. This will be the third year cash flow. Now what you are having, 0th year you have invested 1 lakh rupees. Third year you are having how much amount? Third year you are having how much amount? It will be 40,000 into 1.1 into 1.1 plus 44,000 plus 40,000. You will have 1,32,400, correct? So actually it has hanged, okay? So 0th year you have invested 1 lakh rupees. Third year you are having 1,32,400 rupees. What is the rate? Just use the present value future value formula. Present value is equal to future value divided by 1 plus I to the power n. Yes. So 1 plus I to the power n into present value is equal to future value. Okay. What you want to find out? You want to find out the I value. Just 1 minute. Yeah, 1 plus I to the power 3 is equal to future value divided by present value. Okay. So you will get 1,32,400 divided by 1 lakhs. Okay. So what you are getting? 1.324. Now you have to do 3. So third root you have to do. Okay. 1.324. Third root you have to do. Third root of 1.324. Once you do third root of 1.324, if you do -1, you will get the rate. Actually, it is stuck. Otherwise, I would have write it and show you. So, online students, you are all understanding this concept of MIRR, right? MIRR also, if question comes, 90% of the student leave MIRR, okay? Because they don't understand itself, MIRR. Online students, are you all understood MIRR? You want me to repeat again? MIRR alone.
Can proceed, sir. No need to explain it.
Okay. Minute. Okay. Now what is happening is that 0th year I have invested 1 lakh rupees. Third year I am having a future value of some 1,32,600, right? So what I have to do now, I have to find out the I percentage, at what rate it has grown, at what rate it has grown. So it is nothing but present value into 1 plus I is equal to future value, correct? So 1 plus I is equal to future value divided by present value. Future value is equal to 1,32,600. Present value is equal to 1 lakh. So you will 400, sorry. So what you will get, 1 plus I is 1 plus I to the power 3, okay? To the power 3, not 1 plus I. 1 plus I in a first year. This is third year value. So 1 plus I to the power 3 is equal to 1.324. So 1 plus I is equal to 1.324. Third root you have to do. What is third root of 1.324? What is third root of 1.324? Here you have to use that shortcut formula. So what is the shortcut formula? 1.324. First, how many times you have to press square root? 15 times. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. Then you have to do minus 1. Then you have to do divided by 3. Then you have to do plus 1. Okay. Then into equal to 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. What is the amount that you are getting? 1.20575 you are getting. Okay. So once you do minus 1, you will get 0.20575. It is nothing but 20.575 percentage. Okay, that is what is MIRR. Okay, that is what is MIRR. I will give you one, just because people become very, capital budgeting. 1 minute. Actually, MIRR should come in the exam. Then next time students will be very serious. Because many a time we leave MIRR. Yeah, but understanding is what is the problem, right? Yeah. See this question. Investment of 1,36,000, which means year 0. Determine considering 8% cost of capital. Okay. Determine MIRR considering 8% cost of capital. So 8% is the reinvestment rate. Okay. The following cash inflows: profit before depreciation, but after taxes. Okay. So now you had all the cash inflows. Cash outflows 1,36,000. So what you have to do with this 30,000, 40,000, 60,000, 30,000, 20,000, you have to convert this into future values. So this is reinvestment rate factor. I mean nothing but the future values. Okay, reinvestment rate factor. So instead of present value factor, this is the future value factor. Okay, this is the future value factor, which is nothing but 1.08 to the power, come on, to the power 1.08 to the power 4. First year you have to see first year cash flow. If you want to bring it into the future value of 5th year, so first year to second year is 1, 2, 3 and 4. Okay, yeah, because these are the cash flows at the end of 1 year. I always used to say, if year 1 cash flow is 30,000, na end of year 1 only we have to see. Okay, end of year 1. Don't get confused. This is beginning and end thing. Okay. Yeah, correct. So 1.08 to the power 3, 1.08 to the power 2, 1.08 to the power 1, 1.08 to the power 0. So 1.8 to the power 0, na, it is always 1. Okay. So once you do all this value, you will get the future value. Now once you got the future value, year 0, your outflow was 1,36,000. Year 5, your inflow is 2,13,567. So what you have to do? You have to do the 1 plus I to the power 5 is equal to 2,13,567 divided by 1,13,567. 36,000. Okay, this is what is happening here. If you see 2,13,567 divided by 1,36,000, and then fifth root of this minus 1 is equal to 9%. Okay, this is MIRR. Done, done, done. Okay. Online students, I'm actually scared for other students. Are you all understanding, right? MIRR? Vasundhara, Priya, Amarjit.
Sir,
Okay, okay. Great. So this is done. It is still hanged pa. Okay. So MIRR is completed. Now all the techniques of capital budgeting is completed. Okay. So capital budgeting completed. We have few special cases. Okay, we have few more points that we have to discuss. Now under investment decisions, okay, under capital budgeting, only two types of problems are possible. Beyond that, no problem can be asked. Okay, in examination, only two types of problem can be asked. Okay, so listen, first type of problem is the techniques of capital budgeting. What is the first type of problem? They will give you the details and they will ask you find NPV, find IRR, find payback period, find profitability index. Like this they will ask you. Okay, like this they will ask you. Second type of problems, that is where more usage of brain is required. It is case study based problem. They will give you all the cash flow, case study, business scenario they will give you, and then they will ask you to take a decision. They will not give you what technique, nothing they will give you. They will just ask you to take the decision. Okay, usually we use NPV. Okay, usually NPV. I already told you, from IRR and NPV, which is superior? NPV is superior. Why? Because IRR is having that flaw, right? Okay. So whenever you are having any contradiction between NPV and IRR, always select the value where NPV is giving the answer. Okay. So I think this is taking a long time. Is it because of lunch time? Huh? Actually, I don't want to leave you in middle, Lata. Okay. So we have 2 points here. Okay, only two types of questions are possible in capital budgeting. First is that techniques of capital budgeting, everything we discussed. Second point is what we are going to discuss now. Second point will be a case study based problem where estimation of cash flows, many types of adjustments will be there, and after that we have to find NPV. Okay, after that we have to find NPV, and then we have to decide whether to accept the project or not. Okay, that is what is the second type of problem. Usually in exam both are asked. Okay, 50-50 probability, 50% probability here also, 50% probability there also. Okay, so you cannot leave anything, both can be asked. So online students, you want lunch break now, or we can just continue for some time and you'll be able to handle? So what do you say?
Take after some time.
Okay, what about others?
Break you can take after some time.
Yeah, sure. And what about others?
after sometimes we can have. After sometimes,
Okay.
chapter and read things.
Sorry.
Let us finish this chapter.
Yeah, okay. Finishing this chapter will be little bit, but I will complete one area. Okay, I will complete one area and then I leave. Actually, I'm happy. People are enjoying. Actually, students' mentality will be, sir, break menu, sir. They will tap. But actually, I'm happy that actually people are enjoying and they want, the class to continue. This makes me very happy.
ரொம்ப break விட்டா exam break ஆயிடுச்சுன்னா என்ன பண்றது?
Nothing will happen. Why fear when I am here? So just 1 minute, pa. And let me close this and open, pa. This thing is okay. Your DT open aichi. Insert a new page. Just give me 1 minute, huh? Can you please call Marvin? Is he there? Yeah. Fine. So under second type of problem are case study based problems. So in case study based, actually the notepad is hanging a lot. So that's the reason I just off, but I'm not able to switch on now.
One more.
OneNote, yes, yes.
So you open Chrome, you shouldn't open Chrome. It's not saying you don't open it, it's take too much RAM.
Okay, okay. You just open a new sheet itself, new sheet, new file. So nothing should be there. All this new
This
sheet.
one we shouldn't remove. So
Okay.
not belong to you, sir.
But this will take memory.
No.
It not take memory, right? Okay.
Nothing that took memory. Sorry, this is 70%. When you open a Chrome, it took full memory, so it become fully.
Okay, okay. But now it will be
Now it's
proper,
fine.
right? Okay,
Chrome
fine.
doesn't open itself. If
Okay.
you want to open any sheet there, open it from Edge. This one. This one is enough. From
Okay.
here.
Sure, sure.
So, but make sure don't close Google Meet on it.
Sure, sure, sure.
Sure, sir.
Okay. Thank you.
Yes, sir.
Okay, pa. Yeah. Done. Now, so what we were discussing, yeah, two types of problems are there. Okay. But yeah, before that, as I said, some crispy points alone I will discuss with you. Okay. So, profitability index I discussed. Okay. Profitability index I discussed. What is profitability index? Discounted cash inflows divided by, okay, discounted cash outflow. One time in one examination, they just asked find out the desirability factor. Okay. So they got confused, but actually desirability factor is same as it is another name for profitability index also. Okay. In book also one sum is there. What is if desirability factor is that is also another name for profitability index. Don't get confused. Okay. One more time, what has happened is that they asked a question, find out net present value index. Net present value index. So what you guys will do? 90% of the student calculated net present value and gave. What 90% of the student did? Calculated net present value and did. You all will be thinking, correct, Dana? But actually net present value index means this is an index, correct? So it should be ratio. Net present value is nothing but net present value divided by discounted cash outflow. Okay, net present value divided by discounted cash outflow. See, ICI anything can do, okay, but we have to take care. Okay, so these are the small crispy points that I wanted to discuss. Okay, so if something is called and asked net present value index, just it is nothing but NPV divided by, it is also called as net profitability index. Okay, net profitability index. That was profitability index, this is net profitability index. So here if it is more than 0 now you have to accept. Okay, more than 0 now you have to accept, because as you know, if NPV is negative now you don't have to, so it will become less than 0. So if it is more than 0 you have to accept. Okay, so this is one point that I wanted to discuss. So other points, capital budgeting, back methodology. Okay, next one. As I said, we have two types of problem. One is techniques and second one will be case study based problems. Okay, case study based problems. Now what I did is that let me make it very easy for you, because I try to structure the topic in such a way that you should be able to understand and retain in the examination. Okay, so whatever the question comes, I will give you an approach. Okay, if you follow this approach, any question will come, you will be able to handle. Now what is the approach? Any question, any case study question comes, you should find out the first step is estimation of cash flows. First thing is estimation of cash flows. What is estimation of cash flows? We already know, if profit is given, add back depreciation. Find out the cash flows. Okay, find out the cash flows from the numbers. Okay, now cash flows, it can be in three types. Okay, you have to estimate three cash flows. First is initial cash flow. First is initial cash flow. Second is annual cash flows. Okay, annual cash flows. Third is terminal cash flows. Okay, you have to estimate three cash flows. Always put step 1. Any question you do, always put the step 1 as initial cash flows. Okay, initial cash flows. Initial cash flows. See, I'm trying to cover as much as possible, so you should not be struggling in examination. So when we talk about initial cash flows, okay, now if it is a new asset, see, if it is an initial cash flow is nothing, the cash flow at year 0. Okay, the cash flow at year 0. So what you have to do, it will be usually what it will be, initial cash flow will be what, if you are purchasing the cost of asset. Okay, cost of asset, this will be a cash outflow. Okay, this will be a cash outflow. Then what are all the other things possible? I will just make sure to write all the adjustments. What are the other things possible? If we have any setup cost, okay, if we have any setup cost, that will also come as cash outflow. If you are purchasing the asset, na, something you have to put as setup. Okay, setup, all these are cash outflow. Another thing is working capital. Whenever working capital come, working capital also is an investment, correct? So that is also an investment in year 0. So working capital also is an initial cash flow. This adjustment of working capital I will come later stage, but now for initial cash flow, working capital is also an initial cash flow. Then find out the initial cash outflow. Okay, second one. Second one, annual cash flows. Now usually if annual cash flows are given for different years, now 1, 2, 3, 4, 5, now these are the annual cash flows. Suppose sales is given, just put sales. Different sales budget is given, put different sales. Okay, then suppose variable cost is given, reduce variable cost. Yeah, that is for replacement decision. I will come to that also. That is replacement. Okay, this is fresh capital budgeting problem. What you are telling, replacement of old machinery scrap, that is a replacement. I will come to that also. Okay, Now variable cost, if you want to reduce, you just reduce all the variable cost, okay? All other cost to reduce. End of the day, you will reduce depreciation. You will reduce depreciation also, okay? You will reduce depreciation. Then you will get profit before taxes, okay? You will get profit before taxes. Once you get profit before taxes, you will reduce taxes, okay? You will reduce taxes. After you're reducing taxes, you will get something called as PAT. Now what you have to do? Now what you have to do? You have to add back depreciation. Non-cash expenditure you have to add back, correct? So add back depreciation, okay? After adding back depreciation, you will get the, okay, you will get the cash flows. So this will be the annual cash flows, okay? This will be the annual cash flows. What will be the third step? The third step will be finding the terminal cash flow, okay? Finding the terminal cash flow. Terminal cash flow at the year 5. So suppose say this was year 1 to 5. So this is year 5. Now at the year 5, what you will do? Either you will sell the machinery, correct? So if you are selling the machinery, the scrap value of machine, okay? Scrap value of machine, it is an inflow or outflow? Scrap value of machine, it is an inflow, okay? Positive number, okay? Scrap value of machinery is an inflow, okay? Point 1. Second, I already said that whatever we invest in working capital, we will recover in the final year. We will recover in the final year. So we will also get this working capital recovery, okay? Working capital recovery. Working capital point I will touch again, okay? If you are not able to understand, don't worry. Working capital point I will touch again. So scrap value of machinery, what you will also add the working capital recovery. Now one adjustment, concentrate here. If you are having scrap value of machinery, okay? If you are having scrap value of machinery, there can be a tax impact, okay? Tax impact has to be taken care of, correct? Suppose suppose my WDV of the asset is 80,000 rupees, okay? Suppose my WDV of the asset is 80,000 rupees and my scrap value is 1 lakh rupees, okay? My tax rate is 50%, okay? Now under terminal cash flow, you will put scrap amount as 1 lakh. You will put tax amount as 1 lakh. You will put the cash amount as 1 lakh rupees. But you have to do one adjustment. What is that adjustment? It is the tax adjustment. Now how you have to calculate the tax adjustment? See, the WDV was 80,000. You sold for 1 lakh rupees. Is it a capital gain or capital loss? It is a capital gain. What is the capital gain amount? 20,000 is the capital gain amount. So you have to pay some taxes, correct? What is the taxes that you will pay into 50%? So 10,000 rupees is the tax that you are going to pay. Yes or no? Okay. Now here some tricky points are there here and there, you have to understand, okay? Never forget, wherever scrap value is there and any tax amount is there, you have to multiply the tax amount, okay? Now scrap amount is 1 lakh and capital gain is 10,000. So capital gain is the taxes. Capital gain is 20,000 and tax amount is 10,000. If this tax is an expense or income, this is an expense, correct? Because profit now you have to pay tax. So minus tax expense, minus tax expense on scrap, okay? Minus tax expense on scrap. What is your tax expense? 10,000. Because once you got 1 lakh rupees, from the vendor, you will not keep that 1 lakh rupees in the pocket. 10,000 rupees you have to pay to the government. So this also you have to take it into consideration. Then your net cash outflow will be 90,000, okay? So this is one adjustment that you have to take care. The tax impact on scrap value, this is one adjustment that you have to take care, okay? So 1 lakh minus 10,000 will become 90,000, okay? So this is one terminal cash outflow. Now once you got all the cash flows, say this is 10k, 20k, 30k, 40k, 50k, yeah, anything important? Lunch, okay, done. So scrap amount 1 lakh, tax expense on scrap is 10,000 rupees, so net cash flow is 90,000 rupees. I just gave you an example. Now how to end the problem? Now write, okay, NPV, right? Either calculation of NPV you write or anything, you write the heading, capital budgeting, something, you write the heading, or let me see what is the correct heading that you can write. 1 minute. Calculation of NPV itself you write, pa, okay? Calculation of NPV. Here what you have to do, you have to put particulars first, okay? Particulars, year, cash flow, okay, year and cash flow. No, 1 minute. Particulars, and then you put year 1, 2, 3, 4 and 5, okay? Year 1, 2, 3, 4 and 5 and 0, okay? 0, 1, 2, 3, 4, 5. First, initial cash flow, okay? Initial cash flow. What was the initial cash flow? Say you are calculated in step 1, correct? So you just put initial cash flow is my 10 lakh rupees. Summa one example, okay? 10 lakh rupees. Second, annual cash flows, okay? Annual cash flows. You already calculated annual cash flows, right? Suppose this is 10,000, 20,000, 30,000, 40,000 and 50,000 annual cash flows. Third one, what that will be, terminal cash flows, okay? Terminal cash flows is on year 9. So this all are cash outflow, this is cash inflow. Terminal is also an inflow, correct? 90,000 is my net inflow. What is my net inflow? 90,000, that will come under year 5, correct? So now I will put my total cash flows, okay? Total cash flows. This will be 10 lakh rupees. This will be 10,000, okay? This will be 20,000 positive, okay? This is 30,000, bear my handwriting. This is 40,000 and this is 90 plus 50, which is 1,30,000, okay? 1,30,000. Now all the cash flows you have, what you have to do, cash flows into present value factor. Suppose the present value is 15%, this is 1, okay? This is 1. Don't, one silly mistake people do is 0th year they will put the first year present value factor and then they will continue for 6 years. Don't do that. Present value factor for 0 is 1 and then you continue 0 point something you will get. Afterwards you will get discounted cash flow, okay? Afterwards you will get discounted cash flow. You will get the values of discounted cash flows. Once you add everything, you will get the NPV. If NPV is positive, you accept. If NPV is negative, you reject. Got it? One typical problem, how to approach is what I'm telling, okay? How to approach is what I'm telling. Approach is, first, always break the cash flows into 3 cash flows. First is what and all cash flows will come under increment, under initial cash flows. Second, what and all cash flow will come in the calculation of annual cash flows. Third one, what and all the calculations will come under terminal cash flows. Then formulate everything into one table, a beautiful table you prepare, okay? Not like me, a beautiful table you prepare in the examination, and then you calculate the NPV, okay? Tomorrow we are going to solve some 1 or 2 good problems in capital budgeting, in which I will use this approach and I will show you how this approach is useful, okay? But this is just an approach that you should keep in mind. Whenever you're reading the question, your approach should be very clear, okay? You should not read it like a story. Your approach should be very clear, okay? Once you're reading the question, underline the numbers or just write it, this is initial, this is annual, okay? And this is terminal cash flow, so that your calculations are proper. Because many a time, if you're not having an approach now, working capital adjustment you can forget, correct? Working capital adjustment you will tend to forget, okay? Now the next one, some adjustments I'm going to tell you. Already 2 adjustments you already know. First is this non-cash expenditure. Non-cash expenditure adjustment you have to add back, one of which is depreciation, okay? One of which is depreciation. Second adjustment, what we learned? We learned working capital adjustment, okay? Yeah, working capital recovery in terminal cash flows.
Tax adjustment on scrap sales.
Working capital adjustment, and third one is tax adjustment on scrap sales. See, what you are asking is working capital after tax. Working capital is a balance sheet item. No tax adjustment will be made on working capital. Yeah, scrap value of machine. Correct. Yes. Correct. So 3 adjustment we learned, okay? Working capital, let me elaborate a little. Working capital, usually whenever we are doing any business, We need long term investment also, we need working capital also. If the question is telling working capital investment is needed for 50 lakh, so you will be thinking 50 lakh where I should put, when working capital is needed, 0th year, first year, second year, third year. If question is silent, always add working capital in 0th year. Okay, always add working capital outflow in 0th year if the question is silent. If the question is given 0th year, they are putting 20 lakh rupees, first year they again need working capital of 20 lakh rupees, then you put in under 0th year you put 10,000 rupees, then under first year, okay, here under first year you also reduce working capital, okay, less working capital you also reduce here, okay, or under annual cash flow also you can reduce anywhere, but you have to reduce working capital, okay. It is better not to reduce in annual cash flow, because if you reduce in annual cash flow, you will give tax impact. So tax impact will not come in working capital. Otherwise, what you will do here, you will reduce working capital. So on that working capital also tax will, so it will become wrong. Okay. So it is better, whatever extra point is there, you always put it in the main NPV table. Whatever is the point that you already know, you put it into the structure. Okay. Okay. Non-cash expenditure, working capital. Now working capital adjustment, you will be thinking, sir, 0th year I've invested, why I am adding back in 5th year? You all will be having a question, right? Okay, 0th year I'm investing 10 lakh, it is okay. Why I am adding back in 5th year? You will be asking a question, pa. Correct. So there won't be any other reinvestment. See, what is happening is that working capital is the amount which is used. Okay, working capital is not the investment, it is the usage money. Now 1 2 3 4 5, just imagine working capital as sales. Okay, now what is happening, this is working capital investment, this is recovery. Okay, this is investment, this is recovery. I have invested 10 lakh rupees. Okay, I have invested 10 lakh rupees. Now what will happen, this 10 lakh rupees I will sell, correct? If I sell that, I will receive the 10 lakh rupees in cash again, correct? So working capital I have recovered. Then again I will put stock, because I cannot stop my business. Then again I will recover. Okay. Then again I will invest. Again I will recover. Okay. Again I will invest. Again I will recover. Again I will invest. Okay. The same way if you do, everything will be cancelled out. End of the day, you will get your 10 lakh rupees back. When you're closing the business, you will sell the stocks, correct? So you will get back your 10 lakh rupees back. So that is the reason 0th year you're investing 10 lakh rupees. Okay, 0th year you're investing 10 lakh rupees. 5th year you're again getting back your 10 lakh rupees. Okay. So this is what is the concept of working capital. Why are we reducing in 0th year? Why are we adding back in 5th year? Okay. In few questions, what will happen? Working capital investment and recovery. Here they will put, we will need working capital amount of, we will need, okay, this is the amount required for working capital. Okay. Amount required for working capital, we will need first year, we will need some 20 lakh working capital, we will need some 30 lakh working capital, and then if we don't need it is okay. Now what you have to do, this will become a balancing figure here. Okay, this will become a balancing figure here. 10 lakh you invested, 10 lakhs you got. Now if you need 20,000, how much you have to invest? 30 lakhs you have to invest, correct? So not 30 lakhs, 1 minute. Okay, it will not be 10 lakh, it will be say 40 lakhs. Okay, just an example. 1 minute. 2 lakh rupees I need, okay, 2 lakh rupees I need. So now what I have to do, I have to invest 8 lakh again. Okay, I have to invest 8 lakh more to keep 2 lakh in the end of the year. There is one problem in study material like that, where 0th year also I am investing, first year also I am investing, and how I am calculating is this amount I am calculating by keeping this as balancing figure. Okay, because 10 lakhs I receive it in first year, then the question is telling that this amount I already need, and then first year I will again invest. Okay, so by this I will find some 2-3 years working capital investment. So it is always better, whenever working capital information is given, then it is better to prepare a schedule of working capital investment and recovery, so as to have a proper number where and all working capital amount is given. Okay, where and all working capital amount is given. Okay, now working capital adjustment is done. Tax adjustment on scrap value is done. Non-cash expenditure is done. Now we have some other adjustments. 1 minute. Yeah, scrap value also we have little more. See, scrap value, 3 cases are possible. Okay, one is your book value is more than salvage value, one is book value is equal to salvage value, third one is book value is less than salvage value. Okay, book value is less than salvage value. This we discuss. If the salvage value is more, book value is, then there is capital gain, correct? There is capital gain. This is, there is no capital gain. Okay, there is no capital gain. Here we have capital loss. Okay, here we have capital loss. If there is a capital gain, is it a tax expense or tax income? Tax expense. Tax expense is an outflow or inflow? Outflow. Okay, tax expense is an outflow. Okay, tax expense. If there is a capital loss, is it a tax expense or tax income? Yeah, because of that we are having an opportunity benefit, or I can say this loss can be adjusted with some other profit, and some other place I will be gaining some amount. So this is an opportunity benefit. So this is a tax inflow. So this is a tax benefit which is an inflow. Okay, this is a tax benefit. This is a tax benefit which is an inflow. Okay, which is an inflow. Usually how to find out the cash flow under scrap is scrap value, which is scrap value that you are receiving minus tax expense. Okay, minus tax expense plus tax benefit. Tax expense will be there when book value is less than salvage value. When book value is less than salvage value. Tax benefit will be there when book value is more than salvage value. Okay, when book value is more than salvage value. Then why? Because here we have a capital loss and there we have a capital profit. Okay, capital gain. Okay, here we have a capital loss, so here we have a capital gain. Clear? People will be confusing. Sir, loss, capital loss is there. Okay, sorry. Here capital expense, tax expense. Here it is capital gain. Oh, 1 minute here. Whenever we are having any tax benefit, which means we are having capital loss, and here we are having capital gain. Okay. If book value is less than salvage value, then it is capital gain. Yeah, correct. Okay. So if there is a gain, then we have an expense. If there is a loss, then we have a benefit. Clear? If it is equal, not just scrap value, because no tax expense, no tax benefit. Clear? This is one more thing. Okay, usually tax expense will be there, but if in question capital loss is there, na, don't get confused. Now second thing, how will you find out book value? First thing, book value will be given in the question. If it is not given, na, you find out WDV. How to find out WDV? Prepare a depreciation schedule, find the WDV. WDV is less than salvage value. Book value is nothing but the WDV. Okay, WDV. Either WDV will be given, or you have to calculate using depreciation schedule. Or you have to calculate using depreciation schedule. Clear? Yeah. Now next one. Next one. Second type of problem is replacement problem will be there. The second type of capital gain problem, case study problem will be replacement problem. Under replacement problem, na, it is same. Okay, initial cash flow, the approach will be same, but the only thing is the numbers and adjustment will be little bit different. Okay, I mean this adjustment will be same, some extra adjustment we have to discuss. Now under replacement decision, what we have is that under replacement decision we have some old machinery. Okay, we have some old machinery that was having a life of 10 years. Okay, we have some, just a question I'm telling, we had an old machinery that was having a life of 10 years. Now fifth year, what I'm doing, okay, fifth year what I'm doing, fifth year I want to sell. Okay, at the end of fifth year, what I'm doing, now there is some advanced machinery which has come. Okay, new machinery that has come, which is again, just imagine it is having a life of 5 years. Okay, it is having a life of 5 years. Now what is happening, the question is like that, old machinery was having a life of 10 years, but fifth year the company has decided some new machinery has come into the market, and that is an advanced machine, and it will provide me more benefit. So what I will do, I will sell that old machinery, I will bring that new machinery, and then I will, whether it is good to buy the new machinery or not is the question. Whether it is good to buy the new machinery or not is the question. Now how to solve this problem? Same, initial cash flow. Okay, initial cash flow. What is the initial cash flow? First will be the scrap value from old machinery, correct? This will be an inflow. Okay, this will be an inflow. Then plus or minus tax benefit on above. Okay, tax benefit or expense on above, correct? Expense on above. Okay, done. Now what is happened? You are purchasing new machinery also on 0th year, correct? This is year 0. So next will be purchase of new machinery. Purchase of new machinery. So this will be an outflow. If any setup cost is there, that will also come. Okay, if any setup cost or additional cost is there. Okay, additional cost. Second, working capital investment. Okay, working capital investment. Done. Everything is done. Initial cash flow. Now annual cash flows. Here we have two methods to solve. See, nothing pa. Inflow na positive, outflow na negative. Why confusing? Scrap value is an inflow or outflow? Initial is negative. Initial cash flow is negative. Year 0 NPV, what you will put? Negative you will put. Okay, so that is the reason I always say keep it very simple. Inflow positive, outflow negative. Whatever is there, just put positive, negative numbers. Okay, in textbook initial cash flow will be given in positive. Okay, don't get confused. Inflow positive, outflow negative. That, and you follow it entirely. Okay, follow in the entire problem, so your answer will be correct. Now second one will be annual cash flows. Now what will happen? Here we have two approaches. One is total approach and one is incremental approach. Now what will happen is here sale 1, 2, 3, 4, 5 years is given. The question will be given, previously we were able to sell 10,000 units. Now we are able to sell 12,000 units because of the new machinery. Incremental approach means we will only take incremental values. So what we will do, first I'll tell you incremental approach. Incremental is the logical way of answering. So incremental approach, what you will do? You will do 20,000 units extra whatever you are selling into the sales value. Okay, then variable cost of this 20,000 units, then will be contribution, then fixed cost. If there is any incremental fixed cost, now they will tell previously my operating cost was 20,000 rupees, but new machinery is having an operating cost of 50,000 rupees. So there is a 30,000 incremental annual cost that I am having. So that also I will reduce, incremental annual cost of 30,000 rupees. Okay, all the incremental cost I will reduce it, all the incremental benefit I will add it. End of the day I will get something called as incremental cash flows. Clear? Clear? Incremental cash flows. Now what is normal cash flow? This is only normal cash flow. Nothing is this is also incremental only. This is also incremental only, right? This is not total, this is also incremental only. If you are purchasing only, then you will see I have not used the word incremental here, but actually this is also incremental only. Incremental means the cash flows which are relevant for the decision. Only if you sell you will get this you will get the salvage value. Only if you purchase you will have an outflow, correct? Same way, only if you purchase the new machinery you will have this additional sales, otherwise you won't have. So while purchasing the additional machinery, what is the additional benefit that I'm getting, or what is the additional cost that I'm getting? That is what I'm going to do it. Okay, that is what I'm going to do it. Now here one more tricky point is there. Many people used to miss this. Incremental depreciation also we have to take, right? Incremental depreciation. So what you have to do? First you have to see what is the old depreciation. then you have to do what is the new depreciation. If new depreciation is more, na incremental depreciation will also come. Okay, if depreciation is more, then depreciation is a non-cash expenditure, you have to subtract here and then you have to add back again. Okay, incremental depreciation. Now what one more twist the question can put is, the old machinery was having WDB method, new machinery is having SLM method. Okay, one new twist they will put. So what you have to do, you have to clear a WDB schedule for old machinery, and then you have to find out what was the what would have been the depreciation if they would have used for the next 5 years, and then what will be my depreciation, what will be my additional depreciation which I will be using it for this year, which will be straight line, and then you will get different depreciations for different years. Okay, there is one question like that. So this is one more twist that it can happen. Okay, now total approach. People feel total approach is easy. Total approach means put total sales, total variable cost, total contribution, total fixed cost, whatever cost you're having, just put in total. Total depreciation you put, no need to calculate the old, nothing related to old. Total this you put, and then you add back the total depreciation. You will get the cash flows. Okay, you will get the cash flows, and that. Yes, total you are doing. Okay, total we are doing. Both the cases answer will be same only. Okay, both the cases answer will be same only. Why I am telling answer will be same? Because everything you are doing in totality, even you are reducing the totality thing. So you will get the cash flows same way when it comes to terminal cash flows. Okay, same way when you get in terminal cash flows. But textbook follows incremental approach. Okay, only in one place it follows total approach. Now when we see the terminal cash flows is nothing, again salvage value. If you are selling this new machinery, then salvage value is adding, then plus or minus tax benefit. Okay, tax benefit or expense. Okay, then again working capital recovery, add back. This will be your terminal cash flow. Now you have annual cash flows, you have initial cash flows, you have terminal cash flows. You put it in the put it into the NPV schedule, and then find out the NPV positive accept, NPV negative reject. Clear? Online students, are you clear? See, why I am spending so much time in capital budgeting is that you should have comfort in solving problems. Are you all feeling that comfort?
Yes, sir.
Yes, sir.
Great, pa. Great. See, wherever all the cookie points I said, right, that also I have discussed. This working capital adjustment, this tax adjustment on scrap values, all, I said this WDV and SLM, this change in depreciation, that also I did. Then working capital, whenever this the closing values will be given, then working capital investment will be there, that also I have discussed. Now only if you do the problem you will get to know. So tomorrow you will get to know these things practically. Okay, now you know the approach of how to solve. When you're actually solving the problem, that's where your real brain will start working. Clear? So this is the second type of problem that will come in capital budgeting. First type of problem, cash flows will be given. From that cash flows, you have to use capital budgeting techniques. Okay, capital budgeting techniques are simple and straightforward. Second is case study based question, where you have to estimate the cash flows. Estimation of cash flows is what is important. Okay, now there is one more concept which is called as opportunity cost. Okay, relevant cost, anything, incremental cost, whatever you can talk. Okay, now one more point, sunk cost. What is sunk cost? Sunk cost, now the cost which have already been incurred. Okay, cost which is already incurred. Okay, cost which is already incurred. I'll give you one example. One example is that to evaluate the proposal, I paid some amount to consultant. Okay, to evaluate the proposal, I paid some amount to consultant. Now whether will I put that consultant amount as an outflow? Now what you have to ask this question, whether I accept the proposal, then this will be an outflow, or if I don't accept the proposal, then also it will be an outflow. Then this sunk cost is not relevant. So this will not even come in our NPV schedule. Are you all understanding what I am telling? Correct? Sunk cost whether you accept the project or you reject the project, it has already been incurred. Then why should I bring it into the NPV schedule? Because this is a cost which have already been incurred. Okay, so this is the sunk cost. Second one is the incremental cost or opportunity cost, whatever is happening. Now what can I give an example is that suppose you are having a land, you are having the land, you are the owner of the land. Had you given that land on rent, you would have got 2 lakh rupees of rent. Okay, you would have got 2 lakh rupees of rent every year. But now you are using that land, you are using that land for this project. Okay, so there will be no outflow of 2 lakh rupees, correct? But this is an opportunity cost, correct? Any benefit that you are foregoing is a cost, yes or no? Any benefit that you are foregoing is an opportunity cost. Are you all understanding? See, had I taken this land on rent, I would have paid 2 lakh rupees per annum rent. But because this land is mine and because I am not able to earn that rent, so this project should have an outflow of 2 lakh rupees. There is no actual outflow, but this will be an opportunity outflow. This will be an opportunity cost. Are you all understanding? These are the small points where people can make mistake. One mistake and your problem goes for a toss. Okay, clear? So now I think lot of points I've covered. Investment decision, this capital budgeting alone, I actually spend more time because I want to cover this in entirety, because students are not having comfort. Student is not having comfort in capital budgeting, but now at least they will have some comfort. One more point is allocated overheads. You all would have studied in costing. Some overheads you will allocate into different projects, different branches, different departments, correct? So if it is allocated, which means head office expense you have allocated to me, this expense have already been incurred. If you are accepting the project or not accepting the project, this overhead is going to incur, correct? So this allocate overheads is irrelevant for taking the decision, correct? Clear? Are you all? So whenever the question tells that the overhead allocated from year 1 is 1 lakh, year 2 is 2 lakh rupees, please in the NPV schedule don't reduce 1 lakh and 2 lakh rupees, because it is an allocated overhead. This is not an actual overhead that you are spending because of the project. Any expense or any income that you are earning or you are expensing because of the project, that only will come under NPV. It is what is called as incremental cost or incremental benefit. Clear? Clear? Online students, are you all clear with this? Very good, Pa. Very good. Okay. Now I think I've covered almost all the points, and successfully we have completed capital budgeting. Okay. Capital budgeting when we started 11, 12, 1, I think 1:45. Huh? Yeah. Okay. So I think 2 hours 45 minutes it took. Don't worry, okay, don't worry, we will complete now we will go speed. Okay, now we will go speed. Okay, don't worry. This overheads, I mean this investment decision took some time, but now it will go little speed, so don't worry about the timing. It is my responsibility to cover maximum portion, and it is your responsibility to enjoy the subject. Okay, so now can we take a break, or you want me to start risk analysis in capital budgeting? Online students, what do you think?
Take break, sir.
Break, sir.
Okay, Pa, okay, clear. Thank you very much. See, even if you say I will take a break, okay, because I also want to eat. Fine. So now in the next class we will complete risk analysis in capital budgeting, very simple chapter, and then we will start with dividend decisions. Okay, and then we will start with dividend decisions, and then we will see few more points in ratios and working capital management. See, module 1 already completed. Module 2 if you see, investment decision alone is around 30% of the book. If you see the book, more than I mean 50% is investment decision only, Pa. Okay, investment decision and risk analysis in capital budgeting. Okay, these two are investment decision. 50% is investment decision only. The other 50% is the rest of the topics. Okay, so if you see module 1 we completed 90%, okay, 70%. Okay, theory I want you to read, so 90%, and module 2 we completed 50%. So overall we have less than I think less than 30% remaining totality. Okay, so let's take a break. I think the time is 1:45. Okay, you 1 hour will be enough, or can we keep 1 hour 15 minutes?
No,
So 2:45 you all want to meet, or let's keep it 3 o'clock. So you know it will be a round time. So 3 o'clock we will resume. Okay, 3 o'clock.
Okay.
3 o'clock we'll resume. Sure.
Yeah,
Okay. But after 3 o'clock, you know, I have only 2 hours left. 5 o'clock. I also promised to leave early.
6 o'clock, sir.
Okay, we'll do one thing. 45 minutes break, pa. Okay, 2:30 we will meet. Okay,
Okay, okay,
clear. 45 minutes break. 2:30 we will meet. Okay,
okay, sir.
sure, sure. Okay, pa. We can take a break. I'll keep everything intact. So you got your lunch, huh? You ordered from home. Where's your house? Comfortable, right? Okay, well, good afternoon everyone. Online students, good afternoon. Okay, fine. Hope everyone had your lunch. Cool, cool. Okay. So in the previous session, what we completed, complete module 1 we completed except ratio analysis. Ratio analysis, you know, it is a computational chapter. We'll handle it tomorrow. And today's we and now we also completed capital budgeting. We are going to start risk analysis in capital budgeting. Just a small note, this risk analysis in capital budgeting, new syllabus, I mean in the coming attempt, next to next attempt, it is removed. Okay, it is removed. So if it is removed, now there are two probability. One probability is that because this is the last time that you are studying, it is removed from inter. Okay, so inter students are studying for the last time, so there is a chance that definitely this problem will come because afterwards they cannot ask. Second probability is they think that maybe for inter students it is not important, they have removed, so they will not ask any question. But let us go with the first probability only, and then we will study risk analysis in capital budgeting. Okay, I think it will come. I think it will come. Risk analysis in capital budgeting is a very easy chapter. You know, you don't have to use your brain also. This is completely computational chapter. Once you know the structure and once you know how to solve it, you will be able to handle the subject beautifully. Okay. Now, risk analysis in capital budgeting. First of all, why this chapter is important? Okay, we started with why. Okay, capital budgeting we started with why. Risk analysis in capital budgeting why. First thing is, whenever we are saying, okay, year and cash flow, I'm receiving 1, 2, 3, 4, I'm receiving a cash flow of 100 rupees, I'm receiving a cash flow of 300 rupees, I'm receiving a cash flow of 200 rupees. If I'm receiving a cash flow of 100 rupees in year 4, I cannot be certain, okay, I cannot be certain that year 1 I will receive 100. If I tell, okay, year 1 I'm receiving 100, I will tell what proof year 1 you will receive 100, what proof year 2 you will receive 300. Future is always uncertain, correct? Future is always uncertain. So all these cash flows are uncertain. We cannot directly put the cash flow, correct? So directly we cannot say second year I will get 300. So how to calculate this cash flow is what we are going to see in risk analysis in capital budgeting, by seeing the element of risk and by seeing the element of uncertainty. Okay, by seeing the element of risk and by seeing the element of uncertainty. Okay, now very quickly we will complete this chapter because this chapter is very easy. Just a minute, let me download the study mat. 1 minute. Yeah, intermediate financial management chapter number 8, risk analysis in capital budgeting. Chapter number 8, risk analysis in capital budgeting. Let me okay. 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 So we are going to see the risk element. Now under risk analysis in capital budgeting, also we have to identify, we know that cash flows have an element of risk. Okay, now how to handle that risk is what we are going to see in risk analysis in capital budgeting. Okay, now under risk analysis in capital budgeting also we have some techniques. Okay, we have some techniques, and these techniques are actually statistical techniques. Okay, statistical techniques and other techniques, okay, and other techniques. Very simple, okay, very simple. Statistical techniques, nothing is there. One is that expected value, okay, expected value. Second is standard deviation and variance and coefficient of variation, okay, standard deviation, variance and coefficient of variation. Now under other techniques, I'm going in the order of importance, okay. Other techniques, first we will see sensitivity analysis. Okay, first we will see sensitivity analysis. And okay, second one will be got it. Okay, and second one is certainty equivalent, and third one is risk adjusted discount rate. Okay, very quickly we will complete. It is very simple. Just the names are, the name sounds difficult, but actually the concept is very simple. Now if I say, okay, if I say I am having a cash flow of 100 rupees, if I say I am having a cash flow of 100 rupees, okay, for year 2, for year 1, okay, if I say for year 1 I am having a cash flow of 100 rupees, I can ask a question, right? How can you be very sure that the cash flow in year 1 is 100 rupees, correct? So to answer that question, okay, what will say, okay, yeah, you're correct. So what we will do, we will apply probabilities. So 100 rupees there is only 80% chance, okay. 120 rupees there is a 10% chance, there is 10% chance that 20 rupees will come, and there is a 10% chance that 50 rupees will come, okay. There is a 80% chance that 100 rupees will come, there is a 10% chance that 120 rupees will come, and there is a 50% chance that 10 rupees is the cash flow. Now this is what is the information that we are given in the question. Now in first year cash flow, will I take 100 rupees, or will I take 120 rupees, or will I take 50 rupees? What probability? It can be 100 also, it can be 120 also, it can be 50 also, correct? So here statistically what we will take the mean, okay, we will take the weighted average, which means it is also called as expected value. It is also called as expected value. So what we are doing the cash flow into probability, and this is called expected value, okay, expected value. So 100 into 80% is 80, 120 into 10% is 12, and 50 into 10% is 5. So my cash flow for year 1 will be 97. My cash flow for year 1 will be 97, okay. I should not take 100, I should not take 120, I should not take 50. I have to adjust all the probabilities, and then I will take the cash flow as 97. This is what is called as expected value. Are you all understanding this concept? Now if you see here, this is what is the expected value method, okay. See here, project A, first year cash flow, okay, end of the 1 year, first year cash flow is given. Now this cash flow you discount and you bring the net present value, okay. Now this is the first year cash flow, this is the cash flow 1. Now what you do, you discount this cash flow. Now what you will do, into present value factor, suppose at the rate of 10% for 1 year. So 97 into 0.909, you will get some value, say you will get 95 rupees. That 95 rupees is the net present. The 95 rupees is the discounted cash outflow, okay, discounted cash outflow or discounted cash inflow. So since this is a project return, so this is discounted cash inflow, okay. So this is what is the concept. Now I will show you the problem. It is very simple. Whenever you see this problem, see project at the end of first year, okay. So this is the first year cash flow. 2 projects are there, and first year project we have so much probabilities. So what you will do, you first multiply cash flow with probability, and then you find something called as expected value, okay. Once you found the expected value, you total this expected value, So this will be the expected cash flow. Okay, expected cash flow for year 1. Okay, expected cash flow for year 1. This also will be expected cash flow for year 1. This is for project A and this is for project B. Now what you have to do, you have to find out the net present value. Okay, you have to find out the net present value. To find out the net present value, first you want to find the discounted cash outflow. What you have to find out, discounted cash outflow and discounted cash inflow. So this is the cash inflow for year 1. Okay, this is the cash inflow for year 1. You have to discount this. So discount, what you have to do, present value factor at the rate, how much percentage, 10% for year 1. Okay, for year 1 it is 0.909. Here also it is 0.909. Once you do this, you will get discounted cash inflow. Now discounted cash inflow minus discounted cash outflow is equal to net present value. You will get the net present value amount. Okay, and wherever the net present value is more, that is the project that you have to select. Now see, cash flow probability, multiply cash flow with probability, you will get expected value. Once you found out the expected cash flow, these are the expected cash flow. This expected cash flow, you multiply this with present value factor. So this will become discounted cash inflow. Discounted cash inflow minus discounted cash outflow is equal to net present value. The net present value of project B is higher, so select project B. Are you all understanding? Very simple. Are you all understanding, online students? This thing, are you all understanding? Very good, pa. Very good. Now see, this was one period. Okay, this was one period. Year 1 cash flow is given. What if multiple year periods are given? Now here see, cash flows for 3 years are given. Okay, cash flow into probability, cash flow into probability. So what you do, cash flow into probability, this will be the expected cash flow, this will be the expected cash flow, this will be the expected cash flow. This will be the expected cash flow for year 1. This will be the expected cash flow for year 2. This will be the expected cash flow for year 3. Okay, expected cash flow for year 1, year 2 and year 3. Done. Year 1, year 2 and year 3, you got it. So if you are having year 1, 2 and 3 cash flow, you are having, suppose this is the cash flow, what you have to do, you have to multiply it with present value factor. Once you multiply this with present value factor, you will get discounted cash flow. So you have to multiply this with present value factor for first year. This will be the present value factor for second year. That was horizontal, this was vertical. Okay, this is the only difference. This is present value factor for third year. Okay, and the discounting rate is 10%. So this will be 0.909, 0.8, 0.7. Okay, once you do that, you will get the total. This total will be discounted cash outflow. Discounted cash outflow. What is the investment amount? This. So minus discounted cash inflow, you will get the net present value. Now see this, year 1 cash flow, you will get the expected value. This is the expected value for year 2. This is the expected value for year 3. Now year 1 cash flow discounted with present value factor number 1. Okay, this is nothing but present value factor number 1, present value factor for year 2, present value factor for year 3. The total amount that you are getting is 12,573. 12,573 is present value of cash outflow. Okay, present value of cash outflow minus present value of cash inflow is equal to 2573, which is the expected net present value. Okay, which is the expected net present value. Simple expected value method is nothing simple. Only 2 types of problems are possible. That is what we discussed. Now we are going to see variance and standard deviation. Variance and standard deviation. Okay. I hope I'm not going very speed. Variance and standard deviation. Always do standard deviation first, then square the standard deviation, you will get the variance. What is the formula for standard deviation? X minus x dash. Okay, x minus x dash, the whole square. If probabilities are given, then into p. Okay, into p, this you have to do square root. Okay, this you have to do square root. This is what is the formula for standard deviation. Okay, this is what is the formula for standard deviation. X minus x dash, the whole square. Okay, into probability. If you total that and if you do the square root, okay, summation. Summation of x minus x dash, the whole square into p. Okay, summation of x minus x dash, the whole square into p. If you do the square root, that is what is called as variance. Now for example, if you have always do in table method, okay, in textbook it is done in formula method, always do in table method. If you have year cash flow, year 1 2 3 4, we are having a cash flow of say 10,000 rupees, 20,000 rupees, 30,000 rupees, 30,000 rupees and 40,000 rupees. ₹30,000 and 40,000 rupees. Okay, say probabilities are also given. Okay, say probabilities are also given. Let us see directly question only, you will get to know. Now see this problem. Cash flows are given, probabilities are given. First find out the expected value. Okay, you found out the expected value. This expected value is nothing but x dash. Expected value means mean means x dash. Okay, this expected value is nothing, but you would have studied, right? Expect x dash na sigma x by n. See, sigma x by n will come when probabilities are not given. When probabilities are not given means what we are assuming? We are assuming equal weights, but here different weights are there, correct? So that's it. That is why we are doing weighted average, okay, conceptually. But now x dash, okay, cash flow into probability is equal to expected value. That's the total of this expected value will be x dash. Okay, say this will be another this is second, you have to do one by one. Okay, so first cash flow, first you do cash flow into probability, you will get expected value. Okay, you will get expected value, and that will be x dash, okay, this is the x amount, that will be x dash. Now what you do x minus x dash, then you do x minus x dash the whole square. Okay, then you do x minus x dash the whole square into p. All the steps you can also do at once also. Okay, you can directly do x minus x dash the whole square into p, but if you don't feel confident, you can do 2 columns or 3 columns also. X minus x dash the whole square into p. If you total this, you will get sigma x minus x dash the whole square into p. Okay, if you square root this amount, you will get standard deviation. If you square this amount, you will get variance. Okay, this is standard deviation and this is variance. Now here what they have asked variance and standard deviation. Always first calculate standard deviation. Whatever is asked, first calculate standard deviation. Now how to calculate? First for project A. Okay, first for project A, cash flow, probability, expected value. After expected value, prepare one more column and do x minus x dash the whole square. Okay, into p. Do this. Okay, x minus x dash the whole square into p. This is what they are doing. See, 8,000 is x, minus x dash is 12,000, the whole square. Okay, into p is 0.1. This is what they are doing and this is what they are adding. You do it in table format, so it will be easier for you to present also and easier for you to calculate also. Okay, so this is how we have to calculate standard deviation and variance. Standard deviation and variance, nothing great. Okay, nothing great. For project A you have to create and project B you have to create. Okay, project A and project B you have to create. Now the question will be asked, sir, how to take a decision? Standard deviation, variance vechi how to take a decision? If standard deviation is more, which means risk is more. Okay, if standard deviation is less, which means risk is less. Done. So we completed all the statistical techniques. One more technique is there, coefficient of variation. Coefficient of variation is nothing but standard deviation divided by mean. Standard deviation divided by expected value. If somewhere coefficient of variation is asked, what you have to do? Standard deviation divided by mean. Clear? Online students, are you all clear with this? Because I am going bit speed, I think. Okay, or is the speed good, or do I have to slow down?
Okay, sir.
Clear. Okay, done. Now we completed this. Now let us come to other techniques. Okay, first technique what we are going to study is sensitivity analysis. Okay, sensitivity analysis is what we are going to see now. What is sensitivity analysis? Sensitivity analysis is nothing we have to find, we are calculating NPV for different situations. Okay, we are finding NPV for different situations. Okay, different situations. What are those situations? Okay, what are those situations is what we are going to discuss now. Under sensitivity analysis, what they will say, if selling price is changed by this, how will it impact the NPV? If my variable cost is changed by this, what will be the impact on NPV? Like this, questions will be asked. I will tell you how. First, an income statement will be prepared. Okay, first an income statement will be prepared. Say sales minus variable cost, contribution minus fixed cost. Okay, you will get profit. You will get profit. Okay, now from this profit, 1 minute. Okay, contribution minus fixed cost, you will get profit. It is also cash flow. Okay, it is also cash flow. Now this cash flow you will multiply with present value factor. So once you multiply with present value factor, what you will get? You will get discounted cash flow. So you will get discounted cash flow. Discounted cash inflow. Okay, discounted cash inflow. From discounted cash inflow, if you reduce discounted cash outflow or initial cash outlay, okay, or initial cash outlay, okay, or initial cash outlay, you will get NPV. Okay, you will get NPV. You will get NPV. Now listen to me very properly. What is sensitivity analysis? Sensitivity analysis means they will give you some information. Sales is 100, say variable cost is 80, contribution is 20, say fixed cost is 10, so this will become 10, say present value factor is 0.9, okay, so this will become 9, say the initial cash outflow is 5 rupees. Okay, just for an example, initial cash outlay is 5 rupees, then you have an NPV of 4 rupees. Okay, now what will happen? They will tell you what will be the impact on NPV if your sales is reducing by 10%. Okay, if your sales is reducing by 10%, if your sale is reducing by 10%, now what will happen? This will also become 90. Okay, this will also become 80 into 10. Okay, this will also become 72. So 20 minus 10%, this will become 18. Fixed cost will be same, this will be 18. Okay, and then this will be 0.9. You will get some amount. If this is the case, if sales is reduced by 90, (18 minus 10 is 8). Okay, 18 minus 10 is 8. Then you will have 0.9 here. This will be 7. This will be 7. You have to reduce 5. Your NPV is becoming 2. Now what you have to do? You have to do percentage change in NPV. You have to calculate something called as percentage change in NPV. How much is NPV is changing? Okay, percentage change in NPV. Now NPV has changed by, if you see, minus 50%. Correct? How to calculate this? This is nothing but 2 minus 4 divided by 4. Okay, 2 minus 4 is minus 2 divided by 4. So 1 by 2 minus 50%. So which means I can tell, if my sale is reducing by 10%, my NPV is reducing by 50%. Correct? If my sale is reducing by 10%, my NPV is reducing by 50%. So that is how, different factors they will check. First, sales factor they will check. Then fixed cost, if it is fixed cost is increasing, now what I have to do? If my initial cash outlay is increasing, now what will be my changes in NPV? And wherever this changes in NPV is more, that is more risky. Okay, wherever the changes in NPV is more, that is more risky. Correct? Because that thing we have to take care. Correct? This is what is sensitivity analysis. This is the explanation of sensitivity analysis. Once you see a problem, you will be able to understand what I'm actually trying to tell. Okay, now sensitivity analysis, if we see one problem, now see this problem. See, this problem is very big. Okay, in exam there is no chance that this problem will come. Usually only 3 factors will be asked. Okay, only 3 factors will be asked. Okay, not all the 5 factors will be asked, only 3 factors will be asked. Any factor can be asked. Okay, and mostly any 3 variables or 3 factors can be asked. Now read this question. You have all the details. Annual sales you have, selling price you have, variable cost you have. Okay, now annual sales, selling price, variable cost, selling price minus variable cost is equal to contribution, contribution into annual sales is equal to contribution amount minus fixed cost, you will get profit. Correct? Same thing you have to do. So profit you are getting, discount rate you are having. Once you discount that profit, you will get the initial capital cost. Okay, life of the project is 3 years. Life of the project is 3 years. Done. So if you see, you have to use present value annuity factor of 3 years. You have to use present value annuity factor of 3 years to find out the net present value, which is 134.6. Okay, this is 134.6. This is the normal NPV computation everyone knows. I hope everyone knows this normal NPV computation. No doubt till here. Normal income statement, normal NPV computation. Now, what is the question is? The question is, compute the impact on project's NPV considering 2.5% adverse variance. 2.5% adverse variance, which means if all the factors are changing by 2.5% negatively, 2.5% negatively, if things are changing, then what will be the impact on NPV is what they are asking. Okay, so we will see what are all the factors. Okay, see, one factor can be initial capital cost. Okay, initial capital cost. Another factor can be selling units. Okay, sales units. Another factor can be, okay, sale unit is not, sale unit also you can put, but we will put selling price per unit. Okay, selling price per unit. Then we can put fixed cost. Okay, we will put fixed cost will put. Okay, for now we will keep this. Now if initial capital cost, okay, initial capital cost is 400. If I want to have an adverse variance na, my initial capital cost, I mean if it should impact negatively, my initial capital cost should increase or decrease. Come on, you guys reply, online students. My initial capital cost should increase or decrease if I should have a negative impact. My initial capital cost should increase. Okay, my initial capital cost should increase. If I am telling 2.5% adverse variance, which means 400 is my cost. Now if 400 plus 2.5%, if I put 410 rupees, this 410 rupees, then this is an adverse variance for me. Correct? See, if my cost is reducing, that is beneficial for me. Which is unfavorable for me is what is the question is. Okay, so increase in capital cost is unfavorable for me. How much increase? 2.5% increase. Are you all understanding this point? Online students, sensitivity analysis, are you all understanding? If you get this question, you are very lucky. Okay, selling price per unit, when it will be adverse for me, when it will be unfavorable for me. If selling price is reduced or selling price is increased? Reduced. Correct. So if my selling price is reducing, that is unfavorable for me. Okay, how much it should reduce? 2.5%. So 100 will, how much it will become? This will become 97.5. If it becomes 97.5, then it is adverse for me. Are you all understanding? Now fixed cost. How fixed cost will be unfavorable for me? If fixed cost increases or fixed cost decreases? Fixed cost increase, right? Yeah, so if fixed cost is increasing, then it will be unfavorable for us. Now what is the fixed cost? 50 crores. If this 50 crore is becoming plus 2.5%, 51.25 crores, then it is unfavorable for me. First I am just finding what is unfavorable for me. Okay, what is unfavorable for me? Sales units. Okay, sales units. If sale unit increases, it is unfavorable, or sale units decreases, it is unfavorable for me. Increase or decrease? decrease, correct? If sale unit is decreasing, then this is unfavorable for me. Okay, now what is sale units? 5 crore. If 5 crore is becoming 4.875, this will be unfavorable for me. Okay, this will be unfavorable for me. Now if you see, I have taken 4 factors. What I have taken? I have taken some 4 factors. You see, initial capital cost increased to 410 crores, selling price per unit reduced to 97.5, variable cost per unit increased to 51.25, fixed cost per unit increased to 51.25, units sold have been reduced to 4.875. okay, fixed cost, variable cost also, it is one more factor. Okay, variable cost is 50. If variable cost is increasing, that is unfavorable for me. So 50 is becoming 2.5 percentage, 51.25, then it is unfavorable for me. Okay, so all these are the factors. Now what you have to do, this base is the normal NPV we already calculated. You write it again. Then initial capital cost 410. So what we will do, we will just change this 400 to 410 rupees. All others are normal calculations. Okay, everything is normal calculation. Just change this 400 to 410. Okay, then calculate the new NPV and calculate the percentage change. Now selling price is reduced to 97.5. okay, so just this from 100 you change it to 97.5. all others keep same. So all others keep same. Now you cannot change contribution as same. Variable cost you keep it at same, so contribution will change. Okay, then number of units will be same, total contribution will change because this is multiplication of this into this. So if you do this, everything else is same, then you will get the NPV as 101.9. the change is 24.872. Same way, variable cost alone you increase from 50 to 51.25. only variable cost alone you increase, all others you keep same. Okay, this will become 100 only. Okay, don't take 97.5, this will be 100 only. Fixed cost from 50 you increase to 51.75. see, fixed cost from 50 you increase to 51.75. clear? Now unit sold you reduce. Okay, unit sold you reduce. Now what is the unit sold? 5, you reduce it to 4.75. all others are equal. If you change all these variable, you will get new NPV. And this percentage change in NPV, wherever the percentage change in NPV is more, if you see the percentage change in NPV is more, and in which factor it is more? Selling price. So you can say selling price is more sensitive to NPV. Selling price, the change in selling price has maximum effect on NPV. So it is more sensitive. Selling price is more sensitive. Are you all clear, online students? Are you all clear? Sensitivity analysis, very simple. Clear. Very good, very good. See, this big problem will not come in the examination. Okay, in examination only 3 factors will be asking, and that 2 factors will also be given. Okay, here you assume 5 factors, but their factors will also be given. Change selling price they will tell, change discounting rate also they will tell. If change discounting rate, 10% is the discounting rate, 2.5% adverse variance, na discounting rate should increase or decrease? Discounting rate, when it will be unfavorable for me? Discounting rate, when it will be unfavorable for me? Increasing discounting rate or decreasing discounting rate? Excuse me, online students, if I am having a discounting rate, if discounting rate is my factor, and if I am telling unfavorable variance 2.5%, should I increase my discounting rate or decrease my discounting rate? Decrease your discounting rate. Are you sure? Decrease your discounting rate. Why? Because what we are doing, cash inflow. Okay, cash inflow. So this will be my cash inflow. If 10% I discount na, if I decrease na, my cash inflow will become more. So this is favorable or adverse? This is favorable or adverse? This is favorable, correct? So what you have to do, increase or decrease? I have to do adverse variance, correct? So should I increase my discounting rate or decrease my discounting rate? You have to increase your discounting rate. Okay, 10%. See, what is discounting rate? Cost of capital. If my cost is increasing, then it is bad for me, correct? So if 10% is this 10% is becoming 2.5%. If this 10% is becoming 2.5%, which means 10.25 percentage. If this 10% is becoming 10.25 percentage, then this is adverse for me, correct? See, always have the concept clear in your mind. What is discounting rate? Discounting rate is cost of capital. It is the cost Cost, if it is increasing, it will be unfavorable for me. Okay, so if I want to increase my discounting rate, this will become unfavorable for me. Are you all getting this point? Yes, no? Online students, clear?
Yes, sir.
Very good, Pa. Very good. Sensitivity analysis is completed. Okay, sensitivity analysis is completed. Okay. Scenario analysis is nothing, it is same as probability only, right? It is same as probability, just different scenarios will be given and they will tell you which cash flow, which scenario it will go. If you see, you will understand this. Now let us see the other two. Let us see the other two. Okay, other two, certainty equivalent, and risk adjusted discount rate. Okay, risk adjusted discount rate. See, whenever you want to find out the discounted cash flow, you only have two factors, pa. One is cash flow. Okay, one is cash flow and other is present value factor. Okay, other is present value factor. Present value factor, that is what will give you discounted cash flow. Okay, now your cash flow is risky. Okay, first year, second year, third year, your cash flow is risky. Your cash flow is risky, which means your cash flow is uncertain. Okay, your cash flow is uncertain. Now these two are very simple and logical concepts. What they are telling, see, your cash flow is uncertain, we will allocate some certainty equivalent. This 100 rupee first year cash flow is equivalent to 90 rupees. So certainty equivalent is 0.9. Okay, this will be given in the question, certainty equivalent. What you have to do, these are uncertain cash flows. Okay, uncertain cash flows, you have to multiply it with certainty equivalent and you will get something called as certain cash flows. On that certain cash flows only you have to apply present value factor and you will get the NPV. Okay, as simple as that. Okay, certainty equivalent is nothing but cash flows are uncertain, you are not applying any probability, you are just putting the equivalent amount ko or factor put, you are just multiplying and you are getting the amount as discounted cash flow. Correct, this is certainty equivalent. Okay, so cash flows are risky and the rate is risk free. Okay, this rate is risk free, always this rate will be risk free. Okay, risk free. Now what will happen in risk adjusted discounting rate, cash flows are risky. Okay, cash flows are risky, so instead of touching the cash flow, what they are doing, let us increase the discounting rate and then that will mitigate the risk. Correct, what they are telling, let us increase the discounting rate, that will mitigate the risk. So risk adjusted discounting rate means the risk adjusted discounting rate is equal to risk free rate plus risk premium. Okay, plus risk premium. So they will evaluate something. Okay, 10% is the risk free rate. For this risk cash flows, I have to, like, I want to earn at least 4% premium. So what I will do, 10 plus 4, I will discount at 14%. I will not discount, even though my discounting rate is 10%, I will discount at 14% because that 4% amounts for the risk of the cash flow. So two types risk can be mitigated. First, directly you mitigate the risk in the cash flow. Second thing, keep the cash flow intact and you mitigate the risk through discounting rate. This is what is these two concepts, certainty equivalent and risk adjusted discounting rate. Okay, nothing great is there. Certainty equivalent and risk adjusted discounting rate, nothing great is there. I will show you. If you see certainty equivalent problem, you will actually laugh. 1 minute. All the problems are so simple. See certainty equivalent problem. Investment proportion. So this is the outflow 45 lakh. Risk free rate is 5%. Certainty equivalent, always risk free rate is taken. Why? Because cash flows are risky. Okay, cash flows are risky, so discounting rate is risk free rate. So these are the expected cash flow and this is the certainty equivalent coefficient. This is the certainty equivalent coefficient. What you have to do, you multiply this and you calculate something called as certainty equivalent cash flows or certain cash flows. Okay, certainty equivalent cash flows. Okay, certainty equivalent cash flows you calculate. So this total, okay, This is the, I mean, not this, this is the certainty equivalent cash flows. Then you multiply present value factor, you will get the discounted cash outflow. You reduce discounted cash inflow, you will get the net present value. This is what they are doing. Always follow table approach. This is what is formula. What they are doing, 10 lakh into 0.9 and then they are discounting. Okay, 15 lakh into 0.5 and then they are discounting. Total all this. Okay, this is the discounted cash outflow minus discounted cash inflow. You will get something called as NPV. Clear? Certainty equivalent method clear. Now risk adjusted discounting rate also. If you see the problem, you will laugh. Okay, risk adjusted discounting rate. Nothing great is there. See, 100 lakhs is in the project. Risk free rate is 7%, risk premium is 7%. So what you have to do, you just discount this value in 14% and you got the answer. Okay, find out the NPV for discounting in 14%. See, the answer is calculate net present value, yeah, based on risk free rate and also on risk adjusted discounting rate. So first calculate in 7%, which is the risk free rate. Then calculate on 14%, which is the risk adjusted discounting rate. You all know how to calculate NPV. Nothing great is there. Okay, I will show you one more risk adjusted discounting rate. See, you will see very big problem, sir. You said risk adjusted discounting rate is nothing. What is this? This is also nothing, pa. Calculate risk adjusted net present value, which means present value using risk adjusted discounting rate. What is risk adjusted discounting rate? Risk free rate plus risk premium. But here what is there? Net cash outlay is there, which is nothing but present value of cash outflow. Project life is there. Project life and annual cash. Annual cash na present value annuity factor you have to use. And coefficient of variation is there. Okay. The company selects the risk adjusted rate of discount on the basis of the coefficient of variance. So you have to apply risk adjusted discounting rate. Now see, coefficient of variation is 1.2. Now risk adjusted discounting rate should be 16%. Correct? So you discount these cash flows with 16% rate. If coefficient of variation is 0.8, then use 14% discount rate. You discount this cash flow with 14%. If coefficient of variation is 0.4, then use 12% discounting rate. Okay, this is the risk adjusted discounting rate. So what you have to do, you have to 70,000 into present value annuity factor of 16. Okay, 3.274 minus, so this will be present value of cash outflow minus present value of cash inflow. You will get NPV. Simple. Same thing they have did. Okay, 70,000 into 3.274 minus 2,10,000. Okay, see, 70,000. Okay, 70,000 into 3.274 minus this 2 minus this 2,10,000. You will get the net present value. Clear? You got the net present value and everything is calculated. Online students, are you all clear? Risk analysis and capital budgeting we completed. Are you all clear with this?
Yes, sir.
Very good. Okay, nothing great we are doing. Now see, this was the sensitivity problem I was talking about. Initial project cash flow is there, annual cash flow is there, project life is there, cost of capital is there. Okay, annuity factor for 10% and 11% is also given. Okay, 10% is the normal discounting rate. Which of the three factors the project is more sensitive? Okay, which of the three factors the project is more sensitive? What are the three factors? First factor is initial project cost, second factor is annual cash inflow, third, what is the factor? Cost of capital is the factor. Okay, cost of capital is the factor. Okay, already they are given initial project cost, annual cash inflow and cost of capital. So initial project cost, adverse variance, right? Adverse variance. So variable is adversely affected by 10%. Okay, so project cost should be increasing or decreasing? Clear? Please tell fast. Project cost increasing or decreasing? Should be increased or decreased? Increased. Okay, project cost should be increased. Annual cash inflow increased or decreased? Annual cash inflow should be increased or decreased? Decreased. Clear? Now cost of capital increased or decreased? Cost of capital increased or decreased? Increased. Okay, see, logically also you can tell 10 and 11% is already given in the question, so definitely increase. That is why it is given. Okay, so initial project cost you increase by 10%, annual cash inflow you decrease by 10%, and cost of capital you increase by 10%. You have to find out three NPVs and changes in NPV. Clear? So project, yes, yes.
Sir, in case of seeing from investors' point of view, the cost of capital must be increased, right? For favorable.
Why are you
And
seeing from
decrease
investor point of view? You are the company.
No, just for logical purpose, I'm asking.
What you're asking?
In case of favorable, cost of capital would be increased. In case of adverse, cost of capital would be decreased. That is the discounting rate.
No, no. If it is adverse, cost of capital should be increased.
No, from the point of view of investor.
Why will investor will discount with cost of capital? Only a company can discount with cost of capital. An investor will always take IRR.
Okay, so what if it's the case of IRR? Then it's the other way, right?
Yeah, yeah. If it is IRR, then it's the other way. Clear? See, always see logically. Logically, where you will apply the discounting rate. You will apply the discounting rate with cash inflow. Correct? Cash inflow. Cash inflow is a profit to me. Okay. Cash inflow is an inflow to me. Okay. Inflow only you will apply present value factor. Okay. If present value factor 10% and present value factor 11%, I am increasing. Okay. I am increasing. My present value factor of 10% will be more or 11% will be more. 10% will be 0.909 and 11%, okay, 11% will be 0.090. Okay, sorry, 1 by 1.11. So this is 0.900. Okay, this is 0.900. So 10 will be more. So this here annual cash inflow will be more. Okay, here annual cash inflow will reduce. Correct. So as I'm increasing my cost of capital, my inflow is reducing. If my inflow is reducing, which means it is unfavorable to me. Now are you all understanding? So this is from the cash flow logic. If you take it from the percentage logic, 10% discounting rate is the cost of capital. If 10% is the cost, 10% is the cost, then 11% is unfavorable to me. Clear? Or I have confused you? Okay, online students, are you all clear this concept? Okay, pa. Now risk analysis in capital budgeting is completed. Pa. Risk analysis in capital budgeting is completed. Now let's go with next chapter, which is dividend decisions. Okay, next chapter, which is dividend decisions. Dividend decisions, you know, Sigrama will complete. Why? Because this is a completely formula oriented chapter. Okay, formula oriented chapter. Then after this, okay, after this what I will do is, after this all other chapters and all are computation based. This ratios, okay, this ratios is a computation based chapter. And what other chapter left is management of working capital. Management of working capital. Okay, it is one more lengthy chapter. You can have a read. So in this marathon we will complete this much. So dividend decision, and then I will give you some approach of how to solve and what to do, and then end of the day I will consolidate everything. Clear? Let's go to dividend decisions. Okay, pa. Dividend decision. What are all the types of problems possible? Okay, what are all the types of problems are possible? First type of problem, calculation of price. Okay, calculation of price and optimum dividend. Okay, calculation of price of share and optimum dividend. Okay, and optimum dividend. This is the first question possible. Okay, this is the first question possible, which is nothing but calculation of market price of the share and then calculation of NPV. Second question is calculate the value of the firm. Okay, second question, calculation of value of the firm. Calculation of value of the firm. So what we will do, we'll just take a small break and we'll continue dividend decisions. Okay, now it is 3:25. Okay, 3:35 we will meet again. At a stretch we will complete dividend decisions. Okay, at a stretch we will complete dividend decision. Then I will consolidate few discussions, few formulas I will speak, few consolidate, I'll consolidate the discussion, and then we will wind up our concept class and we'll meet tomorrow for solving problems. Okay, so let's take a 10 minutes break. Let's meet at 3:35. Okay, 3:35 we'll meet. Clear? Is he coming? Haris is coming, huh? Okay.
Sir, will you take working capital in tomorrow's class?
We will do problems of working capital.
But no concepts?
I think it will be covered only in the problems. See, working capital management, we have different types of problems. So I will do some 2 or 3 important problems. So while discussing problems, we will be discussing the concepts.
Okay, this is not in today's class, right?
Not in today's class. It will become very heavy then.
Okay, sir.
Or you want working capital also in today's class? Huh?
No, sir, no. We'll go with the sum itself.
Mm-hmm. Ratios, definitely there is no concepts to discuss, only problems alone will do. It is sufficient. Ratios, there is no concept to discuss. Straightforward. Okay. So we'll continue. We'll continue with dividend decisions. Okay. So dividend decisions, 2 types of problems are possible. First is calculation of price of share and the optimum dividend. Second is calculation of value of the firm. Okay, calculation of value of the firm. We have different models. Okay, we have different models for calculating dividend. We have different models for calculating the price. Okay, we have different models for calculating the price. We'll go in the order of importance. Walter's model, just give me 1 minute. Huh? Okay, bro. Let's do here. I hope this will not be Okay, so we are discussing dividend decisions. Okay, so dividend decisions, what I said, two models we will discuss first. Okay, Walter's model and Gordon's model. What these two person are telling, okay, what these two person are telling. Walter's model and Gordon's model. Now, what these two persons are telling? These two persons are telling to find the price of the share. These two persons are giving formula to find the price of the share. Okay, to find the price of the share. Now, what is the formula? What is the formula for Walter and what is the formula for Gordon? So Walter is having the formula D, okay, divided by K. D plus E minus D into R by K. Okay, so this is the formula for Walter. What is the formula for Gordon? The formula for Gordon is E1 into 1 minus B divided by K minus B into R. Okay, so these both are telling the price formula. The first formula is D plus E minus D into R by K, the whole divided by K. The second formula is E1, okay, E1 into 1 minus D divided by K into BR. Sir, what is this, sir? Formula and all you are telling. Don't worry, I'll just explain it in some way, okay? I'll explain it in some way. Price formula already we studied, okay? Already we studied. For equity, okay, in cost of equity, we studied realized yield approach alone. You leave, you know 4 formulas, correct? You know 4 formulas. Can you tell me the 4 formulas? Anyone, please unmute and tell me the 4 formulas that you studied, okay? 4 formulas that you studied for KE. Anyone, please unmute yourself.
Constant dividend approach, D by P naught.
Okay, yeah, dps by p naught, clear. So d by p naught, okay. Then second one, anyone else, please tell.
Constant equity approach, EPS divided by MPS.
Correct, okay. EPS divided by MPS. You can also write EPS divided by P0 because market price per share is nothing but P0. P0 means price today means market price per share, okay, or E by P0, whatever you will write. Then third formula, come on, third formula, anyone else? Third formula, or you can even tell Priya.
Dividend growth model.
Dividend growth model, yes.
D1 divided by P0 plus G.
Very good, okay. D1 divided by P0 plus G. Fourth formula,
RF plus beta into RM minus RF.
very good. Definitely exemption, Pavanaka, okay, definitely exemption. So clear. So you know 4 formulas, okay, 4 formulas. Now if you see, we already know the formula for price. If I want to find P0, what is P0? P0 is D divided by K, correct? If I want to find P0 here, what is P0? It is E divided by K. If I want to find out P0, what is P0 here? P0 is nothing but D1 divided by Ke minus G, okay, Ke minus G. How? You just bring Ke here, so it will become Ke minus G, okay, it will become Ke minus G. Bring P0 here and Ke minus G down, okay, D1 divided by Ke minus G, understanding? So P0 formula, here no P is there, so P0 formula we cannot, because here price is not there. So P0 formula we already knew, okay. From that chapter, we already knew how to calculate price. How to calculate price, we already knew. Okay, P0 is equal to, first is D divided by KE, second is earnings approach, E divided by KE, third is dividend growth model. Okay, dividend growth model, D1 divided by KE minus G. Okay, D1 divided by KE minus G. All this formula we discussed. Okay. Now, what is Walter doing? Okay, what is Walter doing? What is Walter telling? This D divided by K I am accepting. Okay, I am accepting D divided by K. I am now explaining Walter's model. Okay, Walter's model. What he is telling, D divided by K I am accepting. I am accepting D divided by K, because see, growth also we have to consider, but constant dividend. Okay, dividend I am getting present value of dividend, D divided by K. What is this? This is present value of dividend. Okay, cash flow divided by R, D divided by K. Any logic you understand, but this is I am expecting. But what is happening? Suppose 100 rupees you are earning. Okay, suppose you are earning 100 rupees and you have distributed only 50 rupees. So retained amount is 50 rupees, correct? Retained amount is 50 rupees. On this retained amount, I will earn something, correct? On this retained amount, I will earn something. What I will earn? I will earn the return on investment, which is IRR. So on this retained amount, suppose I am earning 10%. Okay, my R is equal to 10%. So my earnings on this retained amount is 5 rupees, correct? My earnings on this retained amount is 5 rupees. Yes. So this 5 rupee ka present value also I will get it, correct? This 5 rupee, which means E minus D is the retained earnings into R. Okay, into R is the return that I am earning on this retained earnings divided by present value of this. Okay, this is something that I will earn. This is something that I will earn on this year, the present value of this plus also D, and that amount I will earn every year. That is the reason I am doing present value of that also, correct? So this is dividend. Okay, this is dividend and this is retained earnings, correct? What you are doing, this is dividend and this is retained earnings. This is dividend and this is retained earnings. Are you all able to understand this formula? How Walter is getting this formula? Online students, are you all able to understand, or am I confusing you?
Yes, sir. Understood.
Clear.
Understood, sir.
Very good. So when you have to do, see, I also don't remember Walter's model, to be very honest. How I wrote, if you just see 1 minute earlier how I wrote, I also recalled, okay, what is Walter, how Walter will think and how he will write. Like that only I wrote what? First I wrote D divided by KE. Okay, then dividend, then what he will get? Retained earnings. So E minus D is the retained earnings. This will be the earnings. This will be the present value of earnings on the retained earnings. The whole divided by KE is P0. This is Walter's model. Okay, this is what is Walter's model. D is dividend. Okay, E is earnings per share. R is return on investment. K is cost of equity. Okay, K is cost of equity. Clear Walter's model? Are you clear? Walter's model, online students, clear?
Yes, sir.
Very good. Now let us go to Gordon's model. Okay, Gordon's model. See, that person stole that formula. Gordon's model stole the growth formula. What is the growth formula? P0 is equal to D1 divided by online students, D1 divided by K minus G. Okay, D1 divided by K minus G. You all got it, right? How I got P0 is equal to D1 divided by K minus G. Online students, are you all getting it? How I got this?
Yes, sir.
Okay, see. Now, what Gordon is telling, okay, B is equal to retention ratio, okay? B is equal to retention ratio. Suppose I am earning 100 rupees, okay, suppose I am earning 100 rupees, and then if I am retaining, suppose my B is 10%, okay, which means I am retaining 10%. So what is my dividend? What is my dividend percentage? What is my dividend payout ratio? My dividend payout ratio is 90%, correct? If I am retaining 10% and other amount, what I will do? I can't throw. It is my dividend payout ratio, correct? So dividend into 1 minus B is equal to dividend amount. Are you all getting this? My earnings into 90% is what is my dividend. Are you all getting this? Yes or no? Online students, yes or no?
Yes, sir.
So B is equal to retention ratio. Okay, B is equal to retention ratio. 1 minus b is equal to dividend payout ratio. So earnings of first year, okay, because it is D1. So earnings of first year, which means next year earnings, expected earnings into 1 minus b is D1. Okay, this is nothing but dividend. Okay, this is nothing but expected dividend. Okay, this is nothing but expected dividend. You all will be asking a question, why you are complicating it too much? Directly you write it D1. No, he want to use it B. Okay, he want to use B. So you also write B. Why is using B? Because some other place also is using B. Now this is KE. KE minus G. What is G? G is B into R. You all know, right? G is equal to B into R. How G is equal to B into R? Whatever is retaining, on that retained amount he will earn something. There also we saw that, correct? E minus D into R. Okay, E minus D is equal to B into R. He have calculated growth on numerator. He is reducing growth from the denominator. Okay, that is the only thing what. So both are having different assumptions. So this is B into R. Now you understood this formula, how the Gordon's formula is coming. E1 into 1 minus B divided by KE minus B into R. KE minus B into R. Okay. E1 is equal to expected earnings. B is equal to retention ratio. KE is equal to cost of equity. B is equal to retention ratio. R is equal to return on investment or IRR. Online students, clear?
Yes, sir.
See, there are two types of classes, and under revision classes what you can do, directly you can write the formula and you can start doing the problem. Once you get the problem correct answer, student will become happy. Sir, I got the correct answer, okay, but you won't understand the formula. What if you forget the formula in exam? No one, they are not worried, they are worried only about today's class. So today's class they will write the formula, they will apply all the numbers into that formula and then they will get the answer. See, getting the answer even 6th standard student can do, but understanding the formula is what you are sitting here for. Okay, so now you are understood the formula for Gordon's model and Walter's model. Okay, see, always whenever you are learning formula, okay, test your brain. Okay, test your brain. I always used to do. Then I will test my brain. Okay, Walter and Gordon. Walter formula. What is Walter's formula? Walter's formula is he will put D divided by KE and then plus on retained earnings. So E minus D into R, he will earn something, R by KE, so present value of that amount. Okay, this is Walter's model. What is Gordon's model? Gordon's model, he is playing something with dividend growth model. Okay, dividend growth model. So something KE minus G is equal to BR. Now instead of D1, he is putting E1 into 1 minus B. Clear? Walter's model, Gordon's model, clear? Everyone, Walter's model and Gordon's model, clear? Very good, very good. Now second one, how to take a decision. Now this is what is called optimum dividend. Okay, optimum dividend. Now what is the optimum dividend that you have to pay as per Walter and as per Gordon? Now both of them, okay, as per Walter and as per Gordon, both of them, if R is more than KE, okay, what is R? R is the return. R is the return that I am generating. What is KE? KE is the return that the shareholder is expecting. Whatever the shareholder is expecting is the cost of equity, correct? So R is the return that I am expecting. K is the return that shareholder is expecting. If the return that I am expecting is 15% and the shareholder is expecting 10%, then don't pay any dividend. Okay, 0% dividend. 0% dividend. Why? Because shareholder is expecting only 10%. I can earn 15%. So if I keep the money and if I earn 15%, shareholder will become happy and my price will increase. Okay, shareholder will become happy and my price will increase. So what is the optimum dividend? If R is more than KE, then 0% is the optimum dividend. If R is less than KE, then 100% is optimum dividend. Then 100% is optimum dividend. Okay, which means if R is 15%, but shareholder is expecting 20%. Okay, if R is 15%, but if shareholder is expecting 20%, even though if I keep the money and then I will be earning 15%, shareholder will be unhappy because he will be asking, you give me money, pa, I will earn 20%. Okay, so R is 15% and KE 20%. Now 100% dividend is the optimum dividend ratio. Is the 100% dividend is the optimum dividend ratio. If R is equal to K in any ratio, okay, any ratio is optimum. Okay, any ratio is optimum. So if in the question it is asked, find out the optimum dividend payout ratio as per Walter, what you have to see? You have to see R and KE. If R is more than KE, right, 0% dividend is the optimum payout ratio. Paying no dividend is optimum. If R is less than KE, pay 100% dividend, that is optimum. Okay. Now if you see the question, you will understand. Walter and Gordon completed. Okay. Walter and Gordon is actually 75% of dividend decisions. Okay. 75% of dividend decision is Walter and Gordon, probability times. Okay. Just 1 minute. Let me get the textbook. Dividend decisions. Just 1 minute. Dividend decisions. Okay, well. Now let's see in dividend decision. I will show you. See this question. X Limited earns 10 rupee per share. So this is EPS. Okay, E is given. Capitalization rate and rate of investment. So capitalization rate na KE, rate of investment na R. Okay, E is given, K is given, R is given. Okay, if these three values are given, what they're asking, determine the optimum dividend payout ratio. For both optimum dividend payout ratio is, we have to find out whether R is more than KE or R is less than KE. Here R is more than KE. So what is the optimum dividend payout ratio? Online students, what is the optimum dividend payout ratio? R is more than KE. What is the optimum dividend payout ratio?
0.
Correct? Okay. Because R is more, so I will be able to earn more. So it is better not to give any dividend. Okay. So 0%. So paying no dividend, dividend 0, dividend payout ratio 0% is optimum dividend. Okay. Dividend payout ratio 0 is optimum dividend. Now find out the price. Okay. Find out the price. See, when you have to find out the price, use Walter model. What is Walter model? See, for Gordon model also you can use, but Gordon model is dividend growth model. Okay, there next year expected dividend should be given. Here nothing, no details like that is given. Okay, here Walter Gordon is not given. Usually in the exam it will be given calculate price as per Walter Gordon, but here if next year growth rate is not given or next year expected dividend is not given, then don't use Gordon, because Gordon expected earnings you want. So here what formula you will use? Walter's model. What is the formula for Walter's model? D divided by KE, D plus E minus D into R by KE into, okay, into R by KE. Okay, what is D? D is equal to 0. What is earning? 10. What is D? 0. What is R? 12%. What is KE? 10%. What is KE? 10%. Okay, now what is the price? What is the price? Okay, 10 into 12% divided by 10%, the whole divided by 10%, you will get the price as 120 rupees. Okay, so as per Walter the price is 120 rupees. Okay, as per Walter the price is 120 rupees. Okay, determine the, now there's the optimality. No, they are just checking 125%, 50%, 75% and 100%. if they are taking na, their share price will keep on reducing. As I said, they have to, if they are giving dividend na, their share price will decrease. So they are showing, see, they gave dividend, their share price decrease. They again gave dividend, their share price decreased. Then 75% they gave dividend, their share price decreased. 100% they gave dividend, their share price decreased. Okay, so this is what they are trying to prove as per Walter's model. Now again, see, this is also by Walter's model. By Walter's model, if you see, this is the annual report. This is the annual report. First, you have to find E. E is equal to EPS. So find EPS. Okay, you to find EPS, what you have to do? Return on investment is 20%. Okay, return on investment is 20%. This is R and this is KE. This is R and this is KE. Compute approximate dividend payout ratio. Here price is given. Okay, here price is given. So here P0 is given. Okay, P0 is equal to D divided by KE. Okay, plus E minus D into R by KE, okay, into R by KE, into R by KE. Now what is happening here? 1 minute. Yeah, here P0 is given. What is P0? 42. 42 is given, okay. D is what you have to find out, okay, dividend payout. So this is dividend per share, D plus. Now E minus D, okay, E minus D. What is R? R is 20%. What is KE? KE is, what is KE? KE is 16%, okay, 16%, the whole divided by 16%. Where net profit is given, they have taken net profit as 30. Just 1 minute. Yeah, okay. Net profit, see, it is in the heading, okay, I was searching. Net profit is 30 lakhs, okay, net profit is 30 lakhs. Printing mistake, net profit is 30 lakhs. So net profit less preference dividend, you will get earnings available to equity shareholders divided by number of equity shares, you will get earnings per share, okay, you will get earnings per share. Now what is earnings per share? 6 minus dividend is what you don't know. Now all the values you know, D alone you don't know, correct? All the values you know, D alone you don't know, you solve it and you will get the D, okay, you will get the D. As you see, D plus 6 minus D, 0.2 divided by 0.16, the whole divided by 0.16 into 42. Once you do, you will get dividend as 3.12. But what they ask the dividend payout ratio. So dividend payout ratio is nothing but DPS by EPS, okay. Clear? This question is clear. Walters and Gordon model is clear. Online students?
Clear, sir. Yes,
Okay,
sir.
very good, very good. Same thing, same thing. These things are very easy, okay. These things are very easy. Following annual report, following annual report, calculate the price using Gordon's model. Return on investment is given, R is given, K is given, number of equity shares is given. Here also net profit is 30 lakhs, okay. So net profit is 30 lakh, you will and number of equity shares is given, you will be able to find out EPS, okay, you will be able to find out EPS. Now from that EPS you find out Gordon share model, okay. So 6 rupees, you just assume 6 rupees is equal to 6, okay, 6 rupees is equal to 6, and then you find out Gordon's model, clear. So done. Walters model completed, Gordon's model completed, okay. Optimum dividend ratio, that is also completed. Now second one, we have approach, okay. Approach. means Modigliani Miller, okay. There are two different persons, Modigliani Miller. They actually got Nobel Prize for, you know, whatever the findings or research they did in the fields of financial management. So has contributed. Even in capital structure we have approach, even in dividend decisions we have approach, okay. So approach, two formulas, okay, two formulas are there. First one is the P1, which means price at the end of the first period, okay. What is the formula for P1? The formula for, sorry, P0, what is the formula for P0? D1 plus P1 divided by 1 plus KE, okay. This is first formula. Second formula, value of the firm formula. What is value of the firm formula? N plus delta N into P1, okay, into P1 plus E minus I divided by 1 plus K. Na sir, avlo periya formula. Are you all understanding this formula? Yes, no. Are you all understanding this formula? Online students? Online students, you can reply. Are you all understanding this formula? Everyone is silent. Can I take it as positive or negative, huh? Sorry?
Once you explain, sir.
Yeah, I'll explain. I'm actually scared of silence. Okay, whenever someone is silent, I'll be scared. What is happening? If it is going into your head or going somewhere else. Now, approach. Okay, two formulas. Approach, two formulas we have. P0 is equal to D1 plus P1 divided by 1 plus K. Value of the firm is equal to N plus delta N into P1 plus E minus I divided by 1 plus K. Now, what is this formula? First, let us understand this P0 formula. Okay, this P0 formula, it is nothing but what they are doing. They are finding out what is the amount that, as the shareholder, what is the amount that I am earning on the year end. If year end I will sell the price, what I will get? P1 is one amount that I will get, correct? P1 is one amount that I will get, and dividend also I will get, correct? If I am purchasing a share now at 100 rupees, if I am selling that share after 1 year, okay, 1 year, P1 means end of 1 year. If I am selling the share P1, this 110, if the share price is becoming 110, then 110 is one amount that I am getting, cash flows, okay, 110 is one amount that I am getting, plus if 10 rupees is the dividend, then 120 rupees is I am getting, correct? For 100 rupees share, okay, 100 rupees is P0, P1 100 rupees I am getting, and D1 10 rupees I am getting, okay. Now if this is P1, but if I want to find P0, then I have to discount it, correct? I have to discount it. I have to discount it for how many years? I have to discount it for how many years? Online students, I have to discount it for how many years? Perpetual, 1 year, correct? Because this is P1 plus D1, correct? So 1 plus K. 1 plus K is nothing but discounting rate for 1 year, correct? 1 divided by 1 plus I, discounting rate for 1 year. So P0 is equal to P1 plus D1 divided by 1 plus K is simple, okay? This is nothing but 1 year model, okay? 1 year model. So he took the 1 year model, 1 year discounting model, and he took the price, okay? 3 different people take 3 different prices from 3 different assumptions, okay? So he only took 1 year model. What he is assuming, at the end of 1 year I will sell the share. What I will get? 110 rupees, 1 cash flow I will get. 10 rupee dividend, 1 cash flow I will get. 120 rupees I am having. This cash flow is at the end of year 1. If I want to find the price today, I have to find as at today. Now today P0, P1 converting to P0, I have to discount. Discount, because this is a 1 year model, I have to discount for 1 year. So divided by 1 plus KE. If it is P2 plus D2, now 1 plus KE the whole square. If it is P3 plus D3, now 1 plus KE the whole cube. Are you all understanding? So this is P1 plus D1 divided by 1 plus KE. This is the formula for P0, okay? This is the formula for P0. Clear? This is the formula for P0. Now, what is happening here is that, according to MM, okay, according to MM, what he wants is, he wants to find the value of the firm. According to MM, what he wants is, he wants to find the value of the firm, okay? He wants to find the value of the firm. What is the link? Suppose I am earning, okay, suppose I have earned 10 lakh rupees, okay? Suppose I have earned 10 lakh rupees. Out of those 10 lakh rupees, I distributed dividend of say 5 lakh rupees. Okay, I distributed dividend of 5 lakh rupees. Now, what is the amount that I am having? Okay, amount available. What is the amount available with me? 5 lakh is the amount available with me. Okay, but I want to invest somewhere. I want to invest 20 lakh rupees. Okay, somewhere I want to invest 20 lakh rupees. Correct. What is my investment required? I is equal to investment. How much I have to invest, pa? 20 lakh amount I have to invest. Okay, 20 lakh rupees I have to invest. 5 lakh rupees I am already having. So what is the funds required? Okay, what is the funds required? Online students, answer me, what is the funds required? Amount available is 5 lakh rupees. I have invested 20, I want to invest 20 lakh rupees. What is the funds required? 15 lakh rupees is the funds that I required. Okay, now according to MM, these funds you won't take a loan, you issue equity share price only. Okay, you have to issue equity only. So what you have to do, actually N and delta N, okay? N means number of shares at the beginning, okay? N means number of shares at beginning. Delta N, okay? Delta N means new shares, okay? New shares to be issued, okay? New shares issued, okay? N means number of shares at the beginning. Delta N means new shares to be issued. Now, first, always apply first step by step. What is the first step? First step is calculation of funds required, okay? Calculation of funds required. Any MM problem, just use this approach, calculation of funds required. Okay, calculation of funds required. Second one. Second step is calculation of delta n. Delta n is nothing but new shares issued. Okay, new equity shares. New equity shares. Now, what is the funds required at the end of 1 year? What is the funds that I want? The funds required is 15 lakh rupees, correct? Funds required is 15 lakh rupees. This 15 lakh rupees, how many shares I have to issue now? Divided by price of the share. If I divide this by price of the share, suppose if price of the share is 1500 rupees, okay? Suppose 15 lakh rupees, the price of the share is 1000, now I have to issue 10,000 shares. Are you all understanding? Suppose funds required was 15 lakh rupees and I have to do funds required divided by P1. Okay, P1 I have to do. Okay, because I am not issuing today. Okay, this is the investment that is required in the future period. If I were to if you issue the price will be divided by P1. Okay, so what is P1? P1 is 1500 rupees. Example. Okay, P1 is 1500 rupees. So how much shares I have to issue? 10,000 shares I have to issue. Clear? 10,000 shares I have to issue. Third one, finding of the value of the firm. Third one, finding of the value of the firm. Okay, calculation of value of the firm. Now, how will you calculate the value of the firm? Okay, calculation of value of the firm. Okay, value of the firm. Here, no debt is there, only equity is there. Okay, so value of the equity is equal to value of the firm. So, first one, some shares I was already having. Okay, N, which was nothing but 1 lakh rupees. Just for an example, 1 lakh shares I was having plus delta N. Now, 10,000 shares I have now. So my shares have become 1,10,000 rupees. Okay, 1,10,000 rupees. 1,10,000 rupees. What was my price? P1. Okay, P1. So this is my this is my share price at the end of 1 year. I have to discount also because this is first year cash flow. So I have to bring it to the 0th year. I have to find the value of the firm today. Correct. Now, according to me, this should be the answer. N plus delta N into P1. Okay, N plus delta N, because this is what is the market value of share at the end of first year. Correct. Total number of shares into price is equal to market value of shares. Correct. Market value of shares. N plus delta N into P1, the whole divided by 1 plus KE. Okay. But actually we also earned something and also we invested something. Okay. We earned something and invested something. So plus earnings minus investment. Plus earnings minus investment. If you do this, divided by 1 plus K, you will get the value of the firm. You will get the value of the firm. Okay. Now, if you see the formula, N plus delta N into P1, okay, plus E minus I, the whole divided by 1 plus K, you will get value of the firm. I'll write the formula again. If you are able to understand, then you tell me whether you understood or not. Okay. First is total number of shares. Okay. N plus delta plus N into P1. So this is the price at the end of 1 year. 1 plus K, I have to discount it because I want to find the value of the firm today. Then plus whatever I'm earning minus whatever was my investment. Okay, this is my formula. Now, online students, are you all understanding this formula?
Yes, sir.
Understood, sir. Yes, sir.
Very good, ma'am. Very good. Clear. Very good. Now, I will show you one problem and then I will also show you one special trick where nowhere this problem, if problem is coming, you will be very happy because you know one trick which will help you to never go wrong in approach. Okay, pa. Now just see this example. Okay, just see this example. Belongs to a risk class, capitalization rate. So this is K. K is 10%. Outstanding shares. So this is N. Okay, N is 10,000. Selling at 100 rupees each today. So this is P0. Okay, P0 is equal to 100. Firm is contemplating declaration of dividend of 5 rupees per share. Okay, declaration of dividend of 5 rupee per share. Firm is contemplating declaration of dividend of 5 rupee per share at the end of the current financial year. So end of the current financial year. So this is okay D1. Okay, at the end of it expects to have a net income of 1 lakh rupees. So this is E. This is E, net income of 1 lakh rupees, and has a proposal for making new investment of 2 lakh rupees. So this is I. Okay, 2 lakh rupees. Calculate the value of the firm when dividends are not paid, when dividends are paid. Dividends are not paid, even though 5 rupees given, you just take it as 0. Okay, you just take it as 0 because dividends are not paid, you just take it as 0. Okay, understood the question till now? Online students, are you all understood the question? Whenever they ask the value of the firm, it means that it is an approach. Okay, it is an approach. So first find out P1. See, first find out P1. What is the formula? There is no direct formula for P1, but you have formula for P0. P0 is equal to P1 plus D1 divided by 1 plus KE. You know what is P0. P0 is 100 rupees. Okay, P0 is 100 rupees. What is P1? P1 you don't know. What is D1? D1 is 0 because now you are doing for the first case not paid. Okay, divided by 1 plus KE. What is KE? KE is equal to 10%. So 1.1. Okay, 1.1. So you will get 110 rupees as P1. Clear? 110 rupees is what you're getting as P1. Second step, calculation of funds required. Okay, first calculation of P1, second calculation of funds required. How much you have earned? 1 lakh you have earned. How much dividend you have paid? No dividend you have paid. Okay, because dividend not paid, first case. Then what is the funds available now with you? 1 lakh is total amount available with me. What is the investment that I have to make? 2 lakh is the investment that I have made. Okay, funds available is 1 lakh, investment I have to make 2 lakh. So what is the funds required? Funds required is 1 lakh rupees. Okay, now how you will get the funds? You have to issue equity shares. Third step, calculation of delta n. Okay, calculation of delta n. What is calculation of delta n? Funds required divided by P1. Okay, funds required divided by P1. 1 lakh divided by 110. Okay, 1 lakh divided by 110. How many shares? How many shares? 1 lakh divided by 110. How many shares? Okay, 909.09 shares. Okay, 0.09 shares. But actually you should not write shares in fractional form. You should not write shares in fractional form. That is the reason we put this as delta n. I think recording stopped now. Okay, I think some speed limit exceeded. Okay, not an issue. Okay, so delta n is equal to 1 lakh divided by 110. So 909.09 shares. Clear? Now you have n also. Now you have delta n also. Now you have to find out the value of the firm. Okay, value of the firm. Okay, VF, value of the firm is equal to n plus delta n. What is n? N is equal to how many shares you were having in the beginning of the period? How many shares you were having? You were having 10,000 shares. Okay, 10,000 shares you were having. Okay, so n is 10,000 shares. Delta n is 1 lakh divided by 110, or you can also write 909.09. They don't want any round of amount. That is the reason they are taking directly here. What is P1? P1 is 110. Okay, P1 is 110 minus what plus whatever I earned minus whatever I've invested. What I earned? I earned 1 lakh rupees minus what I invested 2 lakh rupees divided by 1.1. Okay, divided by 1.1. Clear? Divided by 1.1. If you do this, you will get 10 lakh rupees as value of the firm. You will get 10 lakh rupees as value of the firm. Now come to the second case. Second case, just take D1 as 5. If you take the D1 as 5, you will get P1 is equal to 105. Okay, once P1 is 105, because you will paying dividend, balance fund required is 1,50,000. Because you are paying dividend, you don't require no 1 lakh, you require 1,50,000 because 50,000 you already paid as dividend. Now 1,50,000 you issue shares at 105 rupees. You issue shares as 105 rupees. So how much share you are issuing? 1,50,000 divided by 105, you are issuing 1428.57 shares. Okay, now what you are doing? 1 lakh shares I was already having, 1428 shares. Okay, 10,000 shares plus delta n into P1 is equal to 105 plus E 1 lakh minus I 2 lakh divided by 1.1. You will get the value of the firm 10 lakh rupees. Always in approach, whether you pay the dividend or do not pay the dividend, value of the firm will remain the same. Okay, value of the firm will remain the same. This is approach. Okay, this is approach. This is hypothesis. Is giving you this hypothesis that dividend payment is irrelevant to the share of the price. Okay, whether you pay dividend or do not pay dividend, your share price will be the same. I mean your value of the firm will be the same. Okay, your value of the firm will be the same. Okay, now I told you I will tell you one trick. What is that trick? See, value of the firm. What is value of the firm? The value that I am having today, which means the number of shares that I am having today into the price that I am having today. This is also value of the firm only. Okay, n into P0. Here what is n? 10,000 is n. Okay, what is P0? What is P0? 100 rupees is P0. So what is value of the firm? 10 lakh is value of the firm. Clear? 10 lakh is value of the firm. Even before solving, you already know that value of the firm is 10 lakh rupees. Okay, so this you are just cross checking. So whenever you are getting any different answer in value of the firm, you can directly cross check by putting n into P0. Okay, this is the only problem in entire financial management, where in 1 second you can find out the answer. How much? 1 second. Just take 10,000 into 100, 1 lakh, 10 lakh rupees, you got the answer. You got the answer. Clear? Online students, are you all clear? Hypothesis, are you all clear?
Clear, sir.
Very good. Very good. Okay. Value of the firm n into P0. Okay. So you will always get 10 lakh rupees only. Any problem you take, this is the only case. Okay. Now yeah, sure. Okay. Now, dividend decision. Gordon's model we completed. Walter's model we completed. Hypothesis we completed. Okay. Walter's model, Gordon's model, hypothesis we completed. We have two other traditional models. Okay. So those were modern. Why modern? Because time value of money was used. Traditional model, no time value of money will be used. It is also less important in an exam. But why I am doing? Because many people leave. If many people is leaving, ICL is becoming happy, ICL will become happy, he will ask question and many people will leave, many people will lose mark, ICL will become happy. So we should be happy by doing that problem. So once this problem comes, so we should be, have a competitive advantage. So there are only two models. Okay, nothing great. Okay, worst formulas. Okay, both are worst formulas. I am telling you this, both are worst formulas. Just apply and get the numbers, no need to ask for logics and all. Okay, one is Graham and Dodd model. Okay, Graham and Dodd model. Another one is Linter's model. I hope it is not heavy for you all, right? We are going in a proper structural way, right? It is not heavy, correct? Online students, please give me a feedback.
Yes, sir.
Yes, sir.
Yes, it is heavy, huh?
No.
Okay.
No, sir, we are going in a time.
Clear. Okay, very good. Now, Graham and Dodd model. Okay, Graham and Dodd model. I'll just tell you little information alone. I will tell you so that you'll be able to understand the formula. Otherwise, you just have to know the formula. Okay, according to Graham and Dodd model. Okay, dividend is given more weight. Dividend is given more weight, and earnings is given less weight. Okay, according to Graham and Dodd model. So what Graham and Dodd model is telling, if I am receiving dividend, I will be happy, so I will increase my price. But if you are not giving me dividend, so earnings I will give less weight, dividend I will give more weight. Okay, this is what is Graham and Dodd is telling. Okay, this is what is Graham and Dodd is telling. So what is the formula for P0? He is giving 100% weightage to dividend. Dividend is something that I will put it in the price, plus earnings I will do divided by 3. Okay, earnings I will do divided by 3, because this I will only give 1/3 of weight. Dividend I will give 100% weight. Okay, earnings I will only give 33% weight. Dividend, here no time value of money concept is used. Okay, everything is statistical. Okay, D plus E by 3. Okay, not statistical also. This is just based on what we say, that statistics. They will ask 2,000, 10,000, 20,000 people, and then they will get that statistics. Okay, I think I don't remember the word, some random statistics is called. Okay, so D plus E by 3. Okay, D plus E by 3. I will multiply this with multiplier. Okay, I will multiply this with multiplier. This multiplier is nothing but the multiplier which I am giving to the stock. Okay, this will be given in the question. Okay, this will be given in the question. Understood the formula? D plus E by 3 into multiplier. Understood the formula? Yes or no?
Yes, sir.
Yes, sir.
Clear. Okay, so they are giving, so this is the weight they are giving into dividend. E by 3 is the weight they are giving it to retained earnings. Okay, E by 3 is giving the weight they are giving to retained earnings. Since they are not doing any time value of money, they will have one multiplier. That multiplier alone they will multiply, so to get the price. Okay, so to get the price. So this is Graham and Dodd model. Now see Linter's model. Linter's model is not giving any price. Okay, Linter's model is not giving any price. Instead, Linter's model is giving the dividend. Okay, the dividend that you should give. Okay, Linter's model will give the dividend that we should give. Okay, dividend expected. He is giving the formula for dividend expected, which is D1. Okay, which is D1, which is D1. Now, what is Linter's model formula is D1 is equal to D0. Okay, D1 is equal to D0. This D0 is something that I have to give. Okay, D0 is something that I have to give. Then I have to give something extra. What is something extra? It will be EPS into target payout minus D0 into adjustment factor. Okay, into adjustment factor. Okay, into adjustment factor. Now this is the formula. This is the formula. I know you all will not understand, but little bit explanation I will give. Why I am giving you explanation is that you will be able to retain the formula in the back of your head. Okay, at least by explanation you will be able to retain. Okay, by numbers you are not able to understand, but at least by explanation, even if one person is understanding, it will be happy. Okay, if you are not understanding, then you try to mug up. Okay, now according to Linter. Okay, according to Linter, my next year dividend, okay, my current year dividend is based on last dividend. Okay, my current year dividend, okay, my current year expected dividend, my current year expected dividend is based on last year dividend. Okay, my current year expected dividend is based on last year dividend. Okay, this is one point that I want to tell. Okay, and second point, over and above I should give some extra dividend. Okay, over and above I give the target payout dividend. Now I will explain you the formula. What Linter is telling is how much dividend a shareholder is expecting. What he saw is that if I received last year dividend as 4 rupees now, this time I should receive 4 rupees plus something. Okay, if I am receiving 3 rupees now, I will reduce my share price. Shareholder will not become happy. Shareholder will think something wrong is happening. Okay, so 4 rupees to definitely I will give. Okay, 4 rupees definitely I will give. More than that, I have to give dividend which will be based on my earnings. Okay, which will be based on my earnings. Okay, last year dividend and current year earnings, okay, last year dividend and current year earnings. So D1, okay, D0, this 4 rupees to definitely I will give, plus I should give something extra based on my earnings. So every year they will have some payout ratio. Okay, they will have some target payout ratio. Suppose this time I have earned 10 rupees and my target ratio is 60%. Okay, suppose this time my EPS is, okay, this 4 rupees, suppose this time my EPS is 10 rupees, okay, and into my target payout ratio is 60%. Okay, this is my target payout ratio. So how much you should give? 6 rupees you should give. Okay, so according to him 6 rupees he should give. According to him 6 rupees he should give, but 4 rupees we already added here, right? So you just reduce this D0. Okay, you just reduce this D0. So what is happening is this is called extra dividend. Okay, this is called extra dividend, which is over and above last year based on current year earning. Okay, this is extra dividend. D4 last year dividend. Okay, D4 last year dividend. This time how much I have earned? 10 rupee I have earned. What is my target payout ratio? 60%. So what is my dividend amount? 6 rupees is my dividend amount. 4 rupees I already gave. So what is the extra dividend? 2 rupees the extra dividend. Okay, now this is adjustment into adjustment factor. What is adjustment factor? The speed at which I am reaching the target payout ratio. Okay, now right now if my EPS is less now, my adjustment factor will be more because I want to reach close to the target payout ratio. So this adjustment factor will be given in the question. This is nothing but it is just a ratio of how much we have earned till target. Okay, if my target was this and if I have reached till here now, how much more I have to reach? So this is one adjustment factor that they will do to find out D1. Okay, this is nothing but the adjustment factor. Okay, this is the adjustment factor. So that is why we are reducing D0. On this extra amount, this adjustment factor should be applied so as to give the extra dividend adjusted to target. Okay, adjusted to target. Now are you able to understand the formula? D1 is equal to D0 plus EPS into target payout ratio. Okay, this is the target payout ratio minus D0, which is my extra dividend, into adjustment factor. Now are you all able to understand this formula, online students, or struggling?
Okay, sir. Understood.
Yes, sir.
Very good, pa. I'm actually very happy, you are actually understanding, because I understand that these classes are very heavy because everything I'm dumping today only. Okay, but as I said, the prerequisite is that you already know things. Okay, you already know few things you will know today, few things you already knew. Okay, few things you already knew, few things you will know today, not because I didn't teach you, it's because that you would have forgot. Okay, you would have forgotten everything I already taught. Okay. So all the models we discussed. Okay, all the models we discussed. Officially dividend decisions is completed. Okay, officially dividend decision is completed. Now if you see, substantially module 1 is completed 90%. Okay, substantially 90% module 1 is completed. Substantially 90% of module 2 is also completed. Okay, so this was a comprehensive revision that we did for module 1 and module 2. Okay, now I will give you some, how you have to approach the subject and how you have to study the subject, and what I as a student used to do. Okay, what I as a student used to do, I'll tell you. See, and I will also do a master revision. So what different revisions? See, now only I'm going to do what I as a student used to do. What I used to do is that I always used to take a plain paper. Okay, whenever I always used to take a plain paper. Okay, on that plain paper I used to write whatever I knew, whatever my brain is able to remember, whatever my brain is able to retain. I just write it and see whether I'm able to recall things or not. Okay, and only if I write it, I will get to know where I'm struggling and where I'm not struggling. Okay, where I'm struggling, where I'm not struggling. I'll just give you an example. Okay, in the next 10 to 15 minutes, you see entire financial management I'm able to consolidate. Okay, I'll be able to consolidate. Okay, if you're very lucky, you can see this part alone before the exam, just to have some kind of revision. Okay, so let's see how it goes. See what's happened. We started with cost of capital. Okay, so let's see, this is how I as a student used to do. Okay, cost of capital, we found cost for different, cost for different capitals. So first was KD. Okay, KD, irredeemable, redeemable, different formulas. I into 1 minus T divided by NP. Okay, this NP can also be market price. Okay, market price, and some adjustment you have to make. What is that adjustment? The adjustment will be flotation cost if given. Okay, flotation cost if given. Same NP adjustment you will do for here also. Here redeemable formula I will put I into 1 minus T divided by RV plus NP divided by 2, here plus RV minus NP divided by N. It is nothing but capital gain. Okay, it is nothing but capital gain, KD. Now KP is similar, preference dividend by NP. Same, this NP adjustments will come here also. Okay, and for redeemable it will be preference dividend by RV plus NP divided by 2. Okay, RV plus NP divided by 2 plus RV minus NP divided by N. Clear? So this is the second. Then we have KE. KE, you all remember we did 5 formulas. Okay, we did 5 formulas. The first formula is KE is equal to DPS divided by MPS. Okay, or D divided by P0. KE is equal to EPS divided by MPS, E divided by P0. KE is equal to D1 divided by PO plus G. Okay, KE is equal to risk free rate plus beta into RM minus RF. Are you all able to recall? Are you all able to recall? Yes. These are the 4 formulas we discussed. Then we discuss cost of retained earnings. Cost of retained earnings is cost of equity into 1 minus if any flotation cost are there. Okay, if any flotation cost are there, or if any brokerage is there. Okay, if any brokerage is there, or if any 1 minus personal income tax is there. Okay, personal income tax is there. Personal income tax is there. Everything we completed. Then we did something called as WAC. WAC is nothing but, okay, value into weight. Okay, I mean the value, with this value you have to find out the weight, and weight into cost is equal to WAC. Okay, weight into cost is equal to WAC. This value can be book value weights, okay, book value weights and market value weights. This is the only thing that we discussed in cost of capital. Okay, this is the only thing we discussed in cost of capital. And then we did leverages. Okay, leverages I already said only 7 formulas are there. Okay, operating leverage, contribution divided by EBIT. Okay, financial leverage, what is financial leverage? EBIT divided by EBT. This is how you should remember. Why I am doing this? This should be your level of preparation. Okay, this is just a benchmark. This should be your level of preparation. What is combined leverage? Combined leverage is equal to contribution divided by EBT. Okay, what is the second formula? What is the second formula? Okay, percentage change in EBIT divided by percentage change in sales. Is this correct? Is this correct? Yes, right? Percentage change in EPS divided by percentage change in EBIT. Clear? Here it will be percentage change in EPS divided by percentage change in sales. Online students, is this formula correct or wrong? Online students, are you all there?
Yes, sir.
Okay. And then combined leverage is also equal to operating leverage into financial. Are you all tired? Online students?
No, sir.
Okay, fine. So combined leverage is equal to operating leverage into financial leverage. Clear? Now if we have preference dividend, now this financial leverage alone will become EBIT divided by, okay, EBT minus preference dividend 1 minus T. Okay, one simple adjustment. Simple. Okay, leverages we completed. Then we went into capital structure. Okay, then we went into capital structure. Under capital structure, first we studied EBIT, EPS, MPS analysis. Okay, this is nothing but table, and then you have to find out wherever is maximum. Okay, this is nothing but optimum capital structure. Optimum capital structure where EPS or MPS is maximum. Okay, where EPS or MPS is maximum. Then we did indifference point. What is indifference point? EBIT minus I1, okay, minus I1 into 1 minus T divided by N1 is equal to EBIT minus I2 into 1 minus T divided by N2. Okay, this is the formula for IDP. This is the formula for indifference point. Now third one, financial break even point. Financial break even point na only fixed cost. What is the fixed cost? Interest. If preference dividend is done na, preference dividend divided by 1 minus T. Okay, preference dividend divided by 1 minus T. Everything we discussed. Okay, then net income and net operating income approach we discuss. Okay, net operating income approach. Net income na KE is constant. Okay, K is constant. Net operating income approach na KO is constant. Okay, KO is constant. Then we discuss the formula. Value of the firm is equal to value of equity plus value of debt. Value of debt is equal to I divided by KD. Value of equity is equal to EBIT minus interest divided by KE. Value of the firm is equal to EBIT divided by KO. Okay, then we discuss if tax is coming now what, then value of levered firm is equal to value of unlevered firm into debt into tax rate. Okay, debt into tax rate. Value of levered firm plus, okay, value of levered firm is equal to value of unlevered firm plus debt into taxes. This is what we discussed in capital structure. Okay, this is what. Then we went into capital budgeting. Okay, then we went into capital budgeting. Okay, in capital budgeting we discussed the techniques. Okay, we discussed the techniques. First one is ARR. ARR is equal to average profit, which is nothing but average PAT divided by average investment. Okay, average investment. Second, we discussed payback period. Okay, second we discussed payback period. Payback period, I said year cash flows. Okay, cumulative cash flows. Okay, then based on the cumulative cash flows you do the interpolation. Okay, you do the interpolation. This is payback period. Okay, third one what we discussed, discounted payback period. Okay, just listen to me. Okay, don't worry if you're not able to, just listen to me. Year cash flows. Okay, once you have year and cash flow, then you put present value factor at the rate X percentage, then you put discounted cash flow, then cumulative discounted cash flow, then based on the cumulative discounted cash flow you do interpolation, only this value. Okay, you do interpolation. This is discounted payback period. Okay, then fourth one we studied NPV. What is NPV? Sum of discounted cash inflow minus sum of discounted cash outflow. Then what we studied? Then we studied profitability index. Okay, profitability index, also called as desirability factor. Desirability factor. Okay, what is this? PI is equal to sum of discounted cash inflow divided by sum of discounted cash outflow. Clear? Then what I said, then some, you know, these petty points are there. If net profitability index is asked, net profitability index or net present value index, if this is asked, na, it is sum of, okay, it is sum of, I mean not sum, NPV divided by sum of discounted cash outflow. Okay, this thing we discussed. Second thing is IRR. How to calculate IRR? Two NPV rates. Okay, year cash flow. From this cash flow, first present value factor at the rate X percentage and then discounted cash flow for X. Okay, find out the discounted cash flow, then present value factor at the rate Y percentage and then DCF for Y. Okay, this will be say higher rate and this will be say lower rate. Okay, this will be say lower rate. You will find out NPV. Okay, you will find out NPV. Okay, you will find out NPV. This is NPV for higher rate, this is NPV for lower rate. Once you got all these values, you have to do interpolation. So IRR is equal to, how to do interpolation? Lower rate plus NPV at the rate lower rate divided by NPV at the rate lower rate minus NPV at the rate higher rate into higher rate minus lower rate. This is the formula. Okay, or if you want to do the conceptual method, you just put this. Okay, you just put this. This is NPV negative. Okay, this is NPV positive. Okay, this will be higher rate. Okay, this will be lower rate. Correct? NPV negative, this will be higher rate and this will be lower rate. Then you just have to draw a table. If increase in this much percentage is decreasing my NPV with this, then how much will be the decrease? Okay, then how much will be my decrease to calculate the IRR? Okay, plus IRR, I mean increase in IRR. Just then you do IRR is equal to this lower rate plus this increase in IRR. Clear? Conceptual method. IRR is completed. IRR is completed. Then where we went? Then we went 8.1 is modified IRR. What is modified IRR? Modified IRR is nothing but what we are doing. We are doing a future value. So here cash flows you are having, okay, here cash flows you are having. What you will do, you will do future value factor at the rate reinvestment rate, okay, reinvestment rate, okay. Then this will be the future value numbers, okay, this will be the future value numbers. So once you total, this will be the future value numbers, okay, this will be the future value numbers. Then what you do, present value into 1 plus I to the power n is equal to future value, okay, is equal to future value. Solve for n, solve for n, n is equal to MIRR, okay, MIRR. So how to find nth root also you already know. How to find the nth root also you have already know. In the calculator, okay, in the calculator put the number, okay, put the number x. First you put the number x, okay, first step put the number x. Second what you do square root 15 times, okay, do square root 15 times. Third step what you do, you subtract 1, okay, you subtract 1. Fourth one what you do, you divided, okay, you divide by what is the number of roots that you want. Fifth step what you do, you add 1. Sixth step what you do, press into and equal to, press into and equal to 15 times. Once you press into and equal to 15 times, you will find out the nth root, okay, you will find out the nth root, okay, nth root, you will find out the nth root in calculator. Clear? MIRR also we completed. Now capital budgeting, these are the only techniques. Now I found approaches, okay, approach. First will be initial cash flow, okay, first will be initial cash flow. Now initial cash flow, I already said initial cash flow can be the cost of new machine, okay, cost of new machine, that will be an outflow, okay, scrap of old machine, okay, scrap of old machine, this will be an inflow. If plus or minus tax expense or benefit, tax expense or benefit on scrap, okay, either positive or negative, this can be some plus or minus, okay, this can be plus or minus. Then what else? Working capital investment, okay, working capital investment, this will be negative. So all these can be initial cash flows. Clear? Second one, you have to find out annual cash flows, okay, annual cash flows. In annual cash flows, 1 minute, in annual cash flows, what you have to do, you have to find out the cash flows, okay, you have to find out the cash flows. How you have to find out? You have to add all the non-cash expenditure, okay, non-cash expenditure. Example, depreciation, okay, example depreciation, okay, plus or minus all the incremental, okay, incremental benefit or cost, okay, incremental benefit or cost you have to do plus or minus, okay, incremental benefit or cost you have to do, okay. And then sunk cost, okay, sunk cost you should not consider, okay, sunk cost you should not consider, but opportunity benefit and cost you should consider, okay, opportunity benefit or cost you should consider. Clear? If you do that, you will get the cash flows, okay, if you do that, you will get the cash flows. Then third step, what you have to do, you have to calculate the terminal cash flows. How to calculate the terminal cash flows? At the end of the year, you will sell, okay, you will sell. So one will be the scrap value, scrap value can be the input. Then plus or minus tax impact, okay, plus or minus tax impact on scrap, okay, tax impact on scrap. This is one thing, okay, this is one thing that you will be having. And then what else you will be having? You will be recovering this working capital, okay, working capital recovery. Working capital recovery is another input. So all these are terminal cash flows. Once you do these 3 steps, then you have to do NPV schedule, okay, NPV schedule. What is NPV schedule? 1 2 3 4 5 you put. First is initial cash flows, okay, initial cash flows, okay, 0, okay, initial cash flows, 0 will be your initial cash flows, okay, 0 will be initial cash flows. Then you have to put annual cash flows, annual cash flows, some amount you will have in annual cash flows, okay. And then terminal cash flows, terminal cash flows you have to do. Fourth one, any other adjustments if you want to do, you can do here, okay, terminal cash flow you have to do. Any other adjustment, this will be your cash flows, okay, this will be your cash flows. Now you are having this cash flow schedule in vertical format. Okay, you are having this cash flow schedule in vertical format. Do present value factor at the rate that X percentage. After doing that, you will get discounted cash flow. Once you total this, you will get NPV. Okay, you will get NPV. NPV positive means accept. Okay, NPV positive means accept. NPV negative means reject. Okay, with this we completed the capital budgeting chapter. Okay, after capital budgeting chapter we did risk analysis. Okay, risk analysis in capital budgeting, risk analysis in capital budgeting. Okay, first point what we saw, expected value. Okay, expected value is nothing but cash flow into probability. Okay, cash flow into probability, and then do present value. Okay, and then do present value, and then do discounting. Okay, and then do discounting. So this is what is expected value. Second one, standard deviation and variance and coefficient of variation. How to calculate it? First, always you have to do standard deviation. Standard deviation, sigma x minus x dash the whole square into p. Okay, the whole square into p, the whole square into p, divided by nothing, divided by root. Okay, nothing divided by root. Okay, this is the root. Sigma x minus x dash the whole square minus p, the whole root. Okay, this is equal to nothing. Okay, this is equal to, I mean, variance is equal to sigma square. Okay, variance is equal to sigma square. Coefficient of variance is equal to standard deviation divided by expected value. X dash is nothing but expected value. Okay, x dash is nothing but expected value. Okay, x dash is nothing but expected value. Completed. Now after that we did sensitivity analysis. Okay, after that we did sensitivity analysis. Sensitivity analysis is nothing but NPV at different situations, changing the variables. Okay, changing the variables. Okay, changing the variables. Example, sales volume change. Okay, sales volume change, or you can have cash inflow change. Okay, cash inflow change. You can have fixed cost change. Okay, you can have fixed cost change. You can have selling price change. You can have discounting rate change. Okay, then find percentage change in NPV. Find percentage change in NPV. Okay, then wherever percentage change in NPV is maximum, that factor is more sensitive. Okay, that factor is more sensitive. Sensitivity analysis we did. Then what we discussed, certainty equivalent. Okay, certainty equivalent. What is certainty equivalent? Nothing. Okay, cash flow into, okay, cash flow into certainty equivalent factor. Okay, certainty equivalent factor. Okay, then you will get the expected cash flows. Okay, you will get the, I mean, the cash flows, and this cash flows you do present value factor, you will get the NPV. Okay, this cash flow, if you do the present value factor, you will get the NPV. This is certainty equivalent. Okay, fifth one is nothing but risk adjusted discounting rate. Okay, RADR. Okay, RADR. So this, where you have to discount this, you have to discount the risk-free rate. Okay, risk-free rate, always discount in risk-free rate. Now risk adjusted discounting rate is nothing but RADR is nothing but risk-free rate plus risk premium. Risk-free rate plus risk premium. So discount at RADR. Okay, discount at RADR and find NPV. This is risk adjusted discounting rate. Then we completed risk analysis in capital budgeting. After risk analysis in capital budgeting, we did dividend decisions. Okay, we did dividend decisions. Under dividend decisions, first one we saw Walters model. Okay, first one we saw Walters model. What is Walters model? P0 is equal to D divided by KE. Okay, D plus E minus D into R by KE. Okay, this is Walters model. Second one we saw Gordon's model. Okay, Gordon's model. Gordon's model, P0 is equal to E1 into 1 minus B divided by K minus B into R. Okay, this is Gordon's model. Third one, we saw Graham's and odd model. Okay, Graham's and odd model. Okay, according to Graham's and odd model, P0 is equal to dividend less weight, so dividend more weight, earnings less weight into multiplier. Okay, into multiplier. Then we saw Linter's model. Okay, we saw Linter's model. What is Linter's model? Linter's model is telling about the dividend. Okay, so D1 is equal to D0, definitely I should give. Then extra dividend. How to find out extra dividend? Based on current year earning. What is my current year earning? EPS into target payout ratio. Okay, EPS into target payout ratio. So extra dividend na, this EPS into target payout ratio, I should do minus D0. Okay, I should do minus D0 and multiply that with adjustment factor. Okay, multiply that with adjustment factor. This will become my Linter's model. Okay, this will become my Linter's model. Then hypothesis. Okay, hypothesis. First step is find P1. How to find P1? The formula is P0 is equal to D1 plus P1 divided by 1 plus K. Okay, 1 plus K. Second one, find funds required. Find funds required. How to calculate? First you calculate earnings. Okay, first you calculate earnings minus dividend distributed. Okay, minus dividend distributed. What is the dividend distributed? You will have funds available. Okay, you will have funds available. Now you have to minus investment required. Okay, investment to be made. Okay, investment to be made. Okay, what is the investment to be made? This will be, okay, this actually will be negative amount, this actually will be negative amount, but this will be the funds required. Okay, this will be funds required. This will be a negative amount, which is nothing but, therefore funds required is equal to this amount. Okay, funds required is equal to this amount. Okay, third step, find delta n. Third step, delta n. What is delta n? The new equity shares to be issued. Okay, delta n is nothing but funds required. Okay, funds required divided by P1 that we already calculated. Okay, fourth one is nothing but find the, okay, find the value of the firm. Okay, find value of the firm. Value of the firm is equal to n plus delta n into P1, okay, plus whatever I have earned, E minus I, the whole divided by 1 plus K. Okay, 1 plus K. I'm not able to move the page. Then you just have to check. Then check whether VF is equal to n into P0. This is just, mind check. This is just mind check. Okay, to check whether the answer is correct or not. With this, we completed and consolidated the entire financial management. Okay, in I think half an hour. Clear? Online students, was that too much for you all?
Yes, sir. Okay.
Clear? This should be your level of preparation. See, I close my book, everything. See, okay, I would have studied 3 or 4 times, so that is the reason. But you should be at this level. What you should do, you should take a paper. Close your eyes. Okay, not close your eyes. I mean, you should close all the books, and then you have to write whatever you know. Whatever you know. So from here, somewhere you will stuck. Then you take that page, then you study that again. Like this, you have to do. Gamify the subject. I always say gamify the subject. How to gamify the subject? Play with yourself. Okay, play with. Some paper you take, some question you solve, something you do. You do something so that you will be able to try to bring interest into the subject. How to bring interest into the subject? Some paper, some random paper you take, some random question you solve, you will not be able to solve. If you are not able to solve, then see the textbook, see the answer, read all the relevant topics, relevant concepts. So if you know, with this you will be able to complete this FM. So now you don't have time to test new things, but at least you should study, and you should you should study, and also you should try to recall, try to retain. Now this thing, this plain paper, this is what is I called as plain paper approach. This plain paper approach you should not do only in FM, you should do in all the subjects. You just have to, whatever you studied, just try to write it down. Anything, bluntly try to write it down, whatever you know. This will be your best revision. This will be your best revision. Okay, this revision I did today, Before exam, this revision you should do, okay? Before exam morning, this is the revision that you should do. This will gain confidence, okay? Listening to me, you gain confidence, yes or no? Online students, listening to me, you gain confidence, yes or no?
Yes, sir. Yes, sir.
Yeah. So just imagine how much confidence you will gain if you will do it on your own. Clear? So with this, I would like to end this class. And before that, if you have any feedback for me, how was today's class? Whether it was too much for you or it was too less for you, please tell me.
Your favorite quote, seat your heart and mind.
Yeah, so I always tell this quote that you have to, you have to fool your heart and brain. So how I used to fool my heart, how I used to fool my brain is that I just, I just wake up at any point in time, any paper I take, okay, RTP, MTP, some random paper, some random question paper I will take, some random question I will take, okay. I don't have a specific plan. Suppose I am taking question number 6A, that this question number 6A is for dividend, okay. It is for dividend Gordon's model. What I will do, I will try to recall the Gordon's model formula. I will not be able to recall. Then what I will see, I will see the suggested answer. I will see, okay, this is the answer, this is the Gordon's model. I will try to solve. Now I will be able to solve. Then what I will do, I will open the textbook. When I open the textbook, what I will see, Gordon's model formula I will see. Then before that, Walter's model is also there, Graham's and Dodd model is also there. That also I will read, that also I will try to solve this problem. Some 2 to 3 hours I will spend, and then by fooling myself, I completed dividend decisions. Okay, by fooling myself, I completed dividend. I didn't even want to study, but just because I tried to gamify it, I am completing the subject. So this is how you have to do. In 3 Idiots, in Nanban, this thing is that you have to fool. Okay, you have to fool, and otherwise you will not be able to study. You have to fool yourself. Okay, you have to fool your brain. You have to fool your heart that you have to do something because this is there. Because this is there. If you don't do this, something will happen. Something something interesting should be there. There should be some dopamine rush into you so as to prepare the subject properly. Clear? Now you guys want to tell something, please, be open.
See you tomorrow, sir.
Sure.
Tomorrow also 8 o'clock, huh?
Yeah, tomorrow 8 o'clock, or maybe if you want, I can extend to 9 o'clock. I'm thinking to extend to 9 o'clock so that, everyone will be comfortable. For 8, someone is pretty early, but let's see. If there is anything, I will inform in the group.
Okay.
But for today's revision class, how you felt? Today's concept revision class, how you felt?
Yesterday itself I told you.
Yeah. Great. And Vasundhara, what about you?
Yes, sir, the session was good. A long day, long back, I read FM. Now everything it got refreshed in my mind. So when I'm revising it again, it will be very easy for me.
Very good. Clear. Amarjit, if you're there, you can also, give some of your feedbacks, if any. Okay, pa. So see you tomorrow. See, tomorrow's class, I will not be speaking much, okay. I will not be doing much. Tomorrow's class will be little bit peaceful, okay. It will not be as heavy as today's class or as bulky as today's class. Tomorrow's class will be little bit peaceful. Why I kept tomorrow's class is that, a little bit of a calm mind. If you are able to solve the problems with me, so it will be a great deal that few problems, few points here and there, few adjustments I'll be able to explain. So entirely the circle of revision I will complete. If I complete the circle of revision, I will get satisfaction, okay. I will get satisfied that yes, my students, I have given the best what I can do. I don't think so any faculty will put this much. Many faculty will put, but what I thought is that I want to put so much effort that end of the day I should be satisfied of myself that yes, I have given the best to my students. So with this intention, I would like to close this class. Let's see you tomorrow, and let's see, I will give you some problems and then we will be able to solve those problems. Tomorrow's class I won't be able to extend, and maybe I actually thought that today I will complete it early, but still it is 5 o'clock. Not an issue. I thought it was worth it. Okay, pa. Clear?
Okay, sir. Thank you very much.
Sure. Thank you very much. See you tomorrow. Okay, see you tomorrow. Try to attend tomorrow's class. Okay. Okay. Bye bye.
Yes, thank you.
Okay. Bye bye. Thank you.